that's a company that's going to get its own multiple. There's a lot of comps out there. Morgan Stanley put out a nice research paper on what they thought just this deal was worth, which was over half our stock price. And then we have a crypto business, which is, we're down in DC. I spent a day and a half down there this week. I fundamentally think a bill is going to get done in the next few weeks. The Democratic senators in earnest want to get something done. The Republican senators in earnest want to get something done. These are complicated bills. It would be complicated if me and you sat down and tried to write the bill. But when everyone is pushing for their own agenda.
Right. Well, let me ask you about the bill, because I think there's maybe many more sticking points than that. But the two that people focus on right now is just what authorities the CFTC has versus the SEC, and perhaps maybe the bigger one. And you hear people like Brian Moynihan get asked about it, and others, just about stable coins and what, how they will work and whether, depending on what they're allowed to be able to do, whether ultimately you're going to have a lot of money coming out of the banking system and what that means to credit in the country.
Yeah, listen, this is an issue that the banks have brought up, and they have an amazing lobby army, right? So they have come down, and one of the reasons the bill is stalled is the banks are saying, oh my goodness. If you go to JP Morgan right now, or Bank of America, or any of the big banks, you put money in a savings account, you get about 11 basis points, or 1 basis point. So the banks are making a tremendous amount of money, holding our savings, and depositing at the Fed at 3.5%, 4%. They worry that stable coins could have deposit flight. The reality is,
but just to be clear, they worry if stable coins are allowed to effectively accrue interest or some other kind of points or other things, that there would be deposit flight. That is right now. That's the central issue, because they're not allowed to technically yet.
Yes. Or the banks would have to raise their interest, pay the consumer maybe a fair rate, and make less money, right? It's so interesting. Whenever you have a new technology that's disruptive, the incumbents say, no, we don't want to give up our monopoly. They are using community banks as a shield, saying, oh my God, it's supposed to be deposit community banks. The reality is, if people wanted to move out of community banks at low interest rate, they could move to SoFi or tons of the neobanks that already offer much better deposit rates. Deposits are sticky. There will be deposit flight that will happen slowly. Stablecoins are mostly a way of U.S. projecting power to the rest of the world. Right? Stablecoins are used overseas, and if you don't allow some interest or some mechanism to generate interest on stablecoins, you're going to continue with this monopoly where Tether has the majority of overseas stablecoins, and so hard to compete with the incumbent unless you can offer something different. I do think that there will be a compromise on this. I don't think it will be great for crypto, but I think it'll be fine. And for me, I just keep saying, we got to get this bill passed so we can move on and the industry can start growing. And if it's not perfect, who cares? We'll fix it in time.
When you think about where Bitcoin is now, we've been looking at the price of Ethereum, Solana. We had Tom Leon earlier this week. Where are you on what's happening? We're now back to $95,000 on Bitcoin.
Yeah, listen, I think Bitcoin pricing and crypto pricing has gotten harder to call in some ways, right? Last year, if you had said stocks are going to be on the highs, gold are going to be on the highs, Bitcoin you would have thought would have been a lot higher. And something happened. I think what happened was a lot of the old owners decided to sell. And they're big chunky positions. We had one $9 billion seller ourselves, just one client here at Galaxy. And I think that digestion is happening. It feels like most of the selling is done. But you're not going to have kind of technical enthusiasm or confidence unless you break back above 100,000 and stay there for a week or so. And in that case, I think you can go a lot higher. And so we're watching that level pretty closely. We're watching the flows closely. I do think once this bill passes, you're going to turn Wall Street into a selling machine. I'm getting calls, the Galaxy is getting calls from almost every trade buy player either partner, understand things, since we have this checklist. Are they a competitor? Are they a collaborator? Are they a partner, right? But the pace of that activity is picked up 400%. And so JP Morgan, they're all getting into this business. And they're not getting in this business just to be able to trade Bitcoin. They see tokenized equities, tokenized mortgages, tokenized money market funds. As the world moves onto blockchain.
Mike, what's that going to be tokenized on? That's what I was going to ask you. You think Ethereum or Solana? And what do you think of Tom Lee yesterday? I'm still trying to figure it out. You got like a treasury company for Ethereum, and you like invest in Mr. Beast. Did that make sense to you?
Listen, I think all these treasury companies need to figure out what their business model is. And just being an ETF isn't going to work anymore. And that's why a lot of them are trading at 85 cents to the dollar, 90 cents to the dollar or lower. And so, these are asset management companies in lots of ways. They own a bunch of assets. They're going to have to turn these things into businesses. I love Mr. Beast. I don't know if that's the move I would have made, but I do love Mr. Beast. He's got a big following, and so Tom has been the most successful of the treasury companies. Post Michael Saylor.
Yeah. So. But Solana or Ethereum or both? I guess they both have uses, right?
I think it's too early to tell, right? The Solana, Ethereum, they're new blockchains. Canton people are using in the institutional world. A lot of companies feel comfortable having private blockchains, and so I think this is not going to be decided for the next few years.
Okay. Michael Novogratz, always good to see you. Appreciate it. Congratulations on what is a transformative transaction for your company.
Thanks so much.
All right, when we come back, our CNBC Cures initiative puts the spotlight on regulatory hurdles to drug development in the rare disease space. John Crowley, who is the CEO of biotech industry group Bio and a rare disease parent, spoke to us about how he's fighting for change inside the industry. We will hear from him next. Squawk Box will be right back.
Time now for today's Aflac trivia question. In 2000, Honda introduced a humanoid robot that could walk, run, climb steps, and communicate in sign language. What was the name? The answer when Squawk Box returns. answer to today's AFLAC trivia question. In 2000, Honda introduced a humanoid robot that could walk, run, climb steps, and communicate in sign language. What was its name? The answer? ASIMO, which stands for Advanced Step in Innovative Mobility.
As part of the CNBC Cures initiative, we're spotlighting the biggest issues facing the rare disease community, talking to some of the most influential voices in the space about where they see bottlenecks that are preventing life-saving treatments from getting to the people who need them. Bio CEO and rare disease parent John Crowley sat down with me for a conversation about his journey as both a rare disease parent and a CEO fighting for change within the industry. Long before entering the world of science, Crowley was a parent who discovered that both of his very young children had Pompe disease, and the only path to treatment would be developing one himself. Crowley has dedicated more than 20 years of his life working on treatments for Pompe disease and other diseases as well, and he's the reason that his kids are not only both alive today, but also thriving. It took him 3 years and grueling funding rounds to develop a treatment, but he says that the path to new treatments today is much different, with new challenges on a federal level and globally.
We're in the golden age of medicine. We're not on the cusp anymore. Take cystic fibrosis. We're curing these diseases. And the biggest challenges, Becky, are man-made. We're getting in our own way. You know, we're denying capital to innovators. We're putting risk and uncertainty in the regulatory process where it doesn't need to be. It's gotten to the point where it just takes too much time, too much money, there's too much uncertainty and inconsistency to develop medicines, which raises the cost of capital, which means that fewer companies get formed, fewer new technologies move forward, most of which we know are not going to succeed. They're going to fail somewhere along the way. So it's never going to be without significant risk.
Crowley says our outdated drug regulatory policies are slowly weakening the United States as the global leader in developing new treatments for rare diseases, and he's helping give rise to what he sees as one of the biggest threats to the U.S. biotech industry. That's China. Over the last 2 decades, China has streamlined its drug development regulatory process, making it cheaper and faster to develop new treatments there. That sent a flood of capital away from the United States innovation centers like Boston and San Francisco and into China's booming biotech industry.
I go back to even just a year ago, or 10 years ago, maybe working in China. There were maybe a couple of hundred true R&D biotech companies in China. By our count, there's over 4,000 today. It used to be, you know, Me Too products or lower technologies. Now it's very high technology, and they're doing things better and faster. We don't need to out-China China, we just need to out-compete China. Don't apply the same standards for a rare disease with 100 kids to a disease with millions of people. And it's not just flexibility, it's a unique regulatory environment, and that's what we need, and that's the leadership we need at FDA.
Crowley says we need a modernized and efficient FDA in order to keep ahead of China in biotech innovation that will ultimately bring hope to millions of people who are living with rare diseases. We take a deep dive into the rise of China's biotech industry in this week's edition of the CNBC Cures newsletter. You can sign up for it and get details on the CNBC Cures Summit at cnbc.com/cures, or you can scan the QR code that's on your screen right now. We'll have a lot more of our conversation with John Crowley in the coming weeks, along with some other really moving conversations. And guys, I should point out, John Crowley is the one who was the CEO of Amicus Therapeutics from 2005 to 2022. That was the company that was just sold the last 3 or 4 weeks for $4.8 billion to BioMarin. He was the executive chairman there until the end, but he's also been the head since 2022 of this biotech industry group, Bio. But it's a pretty amazing story how, you know, he switched into biotech from marketing because his 2 children were very sick with this Pompe disease, which is a disease that doesn't allow your body to clean out, to break down complex sugars that are called glycogen. It damages the cells in the heart, the skeletal muscles, and respiratory. It's a progressive disease, and without treatment, it leads to death.
Unbelievable. I remember before he had successfully found something for it, he was set out to do it, and then he went and did it. Still young, amazing. Well, we will I'd like to have him actually in studio.
Yeah, we will. We'll get him. We've had him before, but we'll get back.
I think I remember. Next week, we're headed to the World Economic Forum in Davos, Switzerland, and we'll have an interview with President Trump. That will be on Wednesday, the 21st. So mark your calendars. It's right after his. Looks like he's already thinking about what kind of things he's going to come up with. That after his speech.
In Davos.
At 2:30.
2:30 Davos time, 8:30 a.m. East Coast time.
Yep, two dominions. I remember the last interview. There was one COVID patient in the state of Washington when we were in Davos, and
You led with that question.
I led with that
which was
question.
Really kind of amazing at the time. What would you say? There's this case in Seattle. Is that what?
We had Paul Tudor Jones on.
He had talked about it.
And he
Yeah.
said, here's a black swan that everybody is not paying attention to. So we asked him. No one knew at that point whether we were prepared or not. And I guess the rest is history. Coming up, Crockbox will be coming back. That's what's coming up.
That was your.
As America celebrates its 250th anniversary, CNBC spotlights the business leaders who forged American industry and an extraordinary legacy of philanthropy.
John D. Rockefeller Sr. was a titan. He built America during the Industrial Revolution and helped, together with others, create the modern country we have. In doing so, he, of course, went from being someone who came from modest resources to the world's wealthiest individual, and decided he would use that wealth to give back to society and help shape a future that was hopeful and optimistic, not just for the winners of that age, but for everybody. The Rockefeller Foundation was established more than 100 years ago. We were founded to do scientific philanthropy because John D. Rockefeller believed that science applied to health, agriculture, energy, and even social sciences applied to governance could really help transform society and make it an environment where everyone flourishes, not just the select few. The very first big project the foundation took on was eradicating hookworm in the American South. They in fact successfully eradicated hookworm, went on to tackle malaria, and that process created both huge successes in modern public health, but also seeded the American public health system in county by county across this country, and presented the antecedents of the Centers for Disease Control based in Atlanta. We focus today on bringing science, innovation, and partnership to lift up vulnerable populations across the planet. To me, what really propelled America's rise over the last 250 years has been innovation and inclusion, because a long time ago, we created a nation based on the basic idea that everyone matters.
the Fed's path and the markets. Goldman Sachs Vice Chairman Rob Kaplan, who also served as Dallas Fed president, does not expect the central bank to make a move later this month, if he ever expects them. He'll tell us why when Squawk Box will do. Joining us now, Goldman Sachs Vice Chairman Rob Kaplan, who served as Dallas Fed President. It's good to see you.
Good to see you, Joe.
I only call Austin Goldie you'd be Mr. Former President anyway, I guess, Rob. We had some recent data that all of us saw that seemed to bolster what I now know is your opinion, that any Fed cuts this year might be at least suspect. At this point, the last one wasn't a given, and there was some dissent. Do you think we'll have any this year?
Yeah, I think we probably will. And just to remember, the Fed cut 75 basis points in the fall, including one in December. And the reason it did that, it wanted to protect against a weaker labor market, and it did that despite the fact that inflation, while not getting worse, has been sticky around 2 3/4. The issue is they're now at neutral. And when I say neutral, I think the real neutral Fed funds rate is about 3/4 to 1%. Add the inflation rate, so the nominal neutral rate is say 3.5, 3 3/4. They'll be willing to cut, and I would be willing to cut, but they're going to need to see more improvement in inflation. We may well get it. Our own economic forecast is we will get improvement, but they're not going to want to anticipate it. They're going to want to cut rates when they see that improvement, and we do believe that will happen during the year, but they're going to want to wait to see it.
You think that the concern that you talked about, which justified the cuts, and that is the labor market, has that resolved itself? There's some people that think that we're we're already on the other side of a slowdown in the labor market. You look at claims, things like that.
Yeah, listen, our forecast for GDP growth, and the Fed's own forecast, is that GDP growth is going to be 2.5%, 2.75% this next year. Our own forecast is 2.75%. In other words, we're going to get a significant firming in GDP growth. You got significant tax incentives, tax on tips, overtime, tax refunds from last year, accelerated depreciation. You've got the AI infrastructure boom, and so in that context, my own view is more likely the labor market will firm. There might be structural issues between people looking for jobs and open jobs and a lack of matching, but I don't think you're going to see a cyclical slowing. But the Fed leaned into it anyhow by doing those 3 cuts last year, and I think it's ready to do more, but it wants to see it. And the tension will be, the new Fed chair and the administration probably wants them to anticipate improvement, and I think they're more inclined to make moves when they see improvement.
Rob, it was pointed out by, I guess, Fed critics to some extent that for 5 years, we've been well above, really, 2% inflation, and yet we've had the cuts that you just outlined. They would argue the goalposts have not been moved. I guess there's one-off instances that they cite for why we're supposed to be able to understand why they would do that. If they purely were doing coincident inflation indicators, we would have never cut.
Well, listen, the fact is you got 2 big disinflationary forces in the world, and you've got to look forward. One, despite we've had goods disinflation for the last 2 or 3 years, the tariffs may have paused that, but we've got enormous manufacturing overcapacity driven by China. You saw China's trade surplus. We've got a lot of global overcapacity. That's going to reassert itself. That's disinflationary. And AI and productivity improvements from AI will, over the horizon, be disinflationary. So there are factors that are increasing costs, but there's some disinflationary forces. I think it's the right thing to have anticipated those, and also the labor weakness. I think it was right to deal with that. And so I think the Fed's in the neighborhood at the moment, it thinks of where it should be. But if the forecasts are right, there'll be more cuts, but they won't happen until you see evidence of inflation improvement. And we may well get it.
Do you have a feeling on how this plays out with the new Fed chairman? And it's now muddied a little bit. We've had individuals say they want this issue with Jay Powell resolved before they'll consider anyone. One person said, I wouldn't even consider my mother. I don't know why. I mean, no one's considering your mother, but I guess he was using an expression that nobody's going to get it until we have that resolved with Jay Powell. You expect this to get resolved and then we'll move forward, because it's supposed to happen soon.
I expect it to get resolved. As an observer, I expect it to get resolved. I think the brouhaha over the weekend and into this week, I don't know that we're going to be talking about 3 or 4 weeks from now. However, the one imprint that might persist from what just happened is I think there'll just be a greater onus on whoever's going to be the Fed chair or the candidate to demonstrate that he or she is politically independent. You might have strong views, and will have strong views, but won't be influenced by political pressure or political consideration, at least as it relates to the Fed funds rate. I would emphasize on regulatory policy, that does change with administrations. It has for many years. And I could see it with a new Fed chair. You'll see more collaboration between the Fed and the Treasury on managing the portfolio. But on the Fed funds rate, it'll raise the bar for the new chair to show he or she's going to stand on their own 2 feet and get in the room and debate it out and keep the culture of the Fed of debate and disagreement, keep it alive without regard to political pressures. And I think that'll be the one imprint of what just happened earlier this week.
I don't know how you can necessarily take anyone's word for it. I mean, we've seen with the Supreme Court, nominees say, are you going to do this? We try litmus tests about all kinds of different things, and they may convince us one way, and then critics say that they don't stick to what they said. Do you think Kevin Hassett could get in at this point, Rob?
I think I'll be careful about talking about individual. I think any of the candidates have the opportunity, but the onus is on each of them in different ways, just to show that there's going to be views from the White House and other officials, as there should be, and they will listen to those views. But when they get in the room, they're going to debate it out and go through the process, and the committee is going to make decisions without regard to political pressure or fear or political considerations. I think any of these candidates could do that job. The bar will be higher for them to demonstrate it, particularly in order to get confirmed.
Right. All right, Rob Kaplan, we appreciate it. Thank you.
Good to talk to you.
Oh, good to talk to you.
Okay, coming up, NBC Sports about to kick off what it's calling Legendary February. The network has the Super Bowl, the Winter Olympics, and then the NBA All-Star Game. It's all happening in 1 month. The month of February. We're going to have more on the Sports Blitz next. And then in the next hour, ARK Invest, Kathy Wood, with her outlook for 2026, the mega cap, tech stocks, cryptocurrencies. We're going to talk about all of it. That's coming up at 8:10 Eastern Time right here on Squawk Box. We're coming back right after this. Welcome back to Squawk Box. NBC is about to have its biggest February yet with exclusive rights to 3 marquee sporting events. The network is calling it Legendary February with The Olympics opening ceremony taking place on February 6th. Then the Super Bowl happening literally just 2 days later on the 8th. And then a week later, NBC is going to be broadcasting the NBA All-Star Game. CBC's Alex Sherman caught up with NBC Sports President Rick Cordello. Cordello's got believes the sports is where the network still holds a clear advantage. Take a look.
Where the competition has come from, at least in the latest media, it's been, the entertainment side, right? Like scripted dramas, and you see Apple and Netflix and Amazon producing fantastic dramas and other shows. Sports is harder. Sports is relationships. Sports is production. Sports is reach of broadcast. And so we have a little bit of an advantage in the sports category that we may not quite have in other ones.
Alex Sherman joins us now with more. So a big deal for NBC.
Yeah, I mean,
how much of this, though, I was going to ask, is going to ultimately, you think, win on linear versus Peacock?
It's definitely a dual-pronged strategy. There's no doubt that part of the huge investment in sports is to keep people in the Peacock ecosystem and signing up for the Peacock service. And I think there has been a slight shift, actually, in NBC's strategy. They may not totally admit this to you publicly, but what we've seen in the past year from NBC is billions of dollars spent on the NBA and Major League Baseball, which have come back into the fold. 2 years ago, NBC bought a wild card game exclusively for Peacock. And the thinking at the time, this was publicly said, was we hope these people that subscribe to our service for this NFL wildcard game will then stay and watch all of our great scripted and unscripted programming and movies. Now, those people can stay to watch exclusive NBA and Major League Baseball games. That seems more logical to me, that the NFL fan would stick around to watch basketball and baseball games rather than suddenly discover they're a huge poker face fan or something else on Peacock.
How had they been having? I mean, there were these sporting events, including the Olympics, which were bringing in lots of subscribers. But then were there people who were 2 or 3 months later saying, you know what?
Yeah, so I think they were very happy initially with the churn, because in the first couple months, I think I remember the number being something like 70% stuck around. But the churn definitely increased on that bunch as the months went on, as you might suspect. Look, this is not really NBC's fault per se, but the media landscape has changed. If you go back and listen to what the head of sports, Rick Cordello, said there, it's sort of a tacit admission that NBC is no longer the media company it once was. You think about, what do people think about when they think NBC from the past 30 years? I would think the first thing people think is must-see TV from 25 years ago. Seinfeld, ER, Friends. That rolled right into The Office. This Is Us. Like, a lot of scripted shows that were very popular, critically acclaimed shows. If you look at NBC's primetime schedule now, those shows just don't exist anymore. There has been a shift in spending to sports and to unscripted. The Voice, America's Got Talent. Those shows are still fairly highly rated, but they're cheaper to make. So the real money has gone into sports. So NBC might tell you, in fact, I spoke to Mike Cavanaugh, the de facto CEO of NBC, co-CEO of Comcast, and he pushed back on this, and he said to me, like, have you seen St. Dennis Medical? Have you seen Slumped? Like, have you heard of those shows? Have you? Have any of you, have you watched St. Dennis Medical, Joe?
I see what some other networks,
Right.
also what they're trying to, it's like, you would have to strap me in a chair to get me to watch that.
It ain't Seinfeld, that's my point. And so,
You know what it's not? Bonanza.
it's not Bonanza, right? And it's not Sunday Night Football, which gets 25 million viewers.
That was so good.
This February, how much, when we look back at the advertising revenue that's going to come in this February to NBC and to Comcast, what's that going to look like?
A lot.
A lot.
It's going to
Will the
be.
Winter Olympics be as successful, more successful than previous Winter Olympics? You can't compare the Winter Olympics typically to Summer Olympics, which I think are in a whole different league.
No, you can't. But this idea of this legendary February has allowed NBC to sell advertising in tandem, where buyers are not only buying into the Winter Olympics, but they're also buying the Super Bowl and they're buying the NBA All-Star Game. And that has allowed for a synergy that has not existed in previous Olympics. NBC gets the Super Bowl every 4 years, so it does sometimes line up with the Olympics. But it's
So is it actually interesting? Is it helpful or hurtful
They think
to have the Super Bowl this time because you have the Olympics already, you have NBA already, and the question is, would have you preferred to have it like next year, for example, to keep You see where I'm going?
Clearly, NBC thinks it's helpful. It's not a coincidence that it happens to line up with the Winter Olympics every 4 years. So they feel like there's a giant benefit in selling all of this stuff in tandem.
Alex, there's a 50th Survivor
Yeah,
coming up.
that's true.
I need to get caught up. I only have to catch up on 49.
Not on NBC.
No, I know.
gotta go, folks.
I'm talking about old.
Alex, thank you, and you can check out his video cast, newsletter. Check it out. CNBC.
It is 8 a.m. on the East Coast, and you're watching Squawk Box right here on CNBC. I'm Becky Quick, along with Joe Kernan and Andrew Ross Sorkin. Welcome back, everybody. It's a Friday. JP Morgan out with its annual Global M&A Outlook. This year, it's titled From Turbulence to Transformation. Joining us right now is JP Morgan's Global Head of Advisory and Mergers and Acquisitions, Anu Iyengar. JP Morgan, we're very glad to have you here.
Happy to be here.
All right, so the leads the Wall Street Journal is about how deals power a record year for the big banks.
Yeah.
It was the investment activity that really picked up, the M&A activity. So a lot of things that happened, and it did turn out for very big numbers. You would characterize the year a little differently, at least where we were 6 months ago.
Yeah, because I was here about 6 months ago, and it was a very turbulent year. And I think much has been said, including in this forum, about, year of the mega deals. You had 71 deals north of 10 billion, more than 5 trillion in volume. I thought what we may do is double click on why it is that scale matters. Why is it that companies are doing large deals, right? Because just scale for scale's sake kind of doesn't make that much sense. So in a world, from a company's perspective, in a world you have tremendous amount of uncertainty and risk. Geopolitical risk, macro risk. I need to have more control over my supply chain. I need to be tech enabled. I gotta think about AI. I gotta think about disruption. When there's that level of risk, more levers that you have to pull, the more amount of money that you have to reinvest in your business, the more scale you have in your business, you're able to navigate that environment a little bit better. And at the same time, on the investor side, and you all talk about it, right? Companies hitting $1 trillion of market cap. The size of a company, of what it takes to be in the S&P 500, 600, has doubled, tripled in the last 5 years.
Really?
So you see that, and the number of...
We have $4 trillion plus
Yeah.
market cap companies. I remember talking about who's going to be the first to break $1 trillion.
Exactly. The number of public companies has also declined. So if you're an investor, and you're an active investor, trying to beat these indices which are hitting all-time records, it's kind of hard to do that by investing in a $1, $2, $3 billion company.
That's true. I think I just heard Jamie Dimon say that in an interview too, where we've gone from, I think, 8,000 publicly traded companies to 4,000.
That's right. And at the same time,
Like, where are the companies to buy at this point?
well, at the same time, the private companies, right?
Getting bigger.
When you look at the number of companies which are either in private equity hands or new company formation, founder-owned companies, you have more than 30,000 companies in that ecosystem. And that ecosystem, if you go back to the same 8,000 to 4,000 time period, was like 5,000 or so. So that has grown. And this private capital ecosystem, whether that's private credit, private equity, private capital solutions, that part of it has become a much bigger part of the market. So as a company gets very large, and we are talking about some very large IPOs coming to market this year, and these large mega deals, there's a place for that. And then for the smaller companies, the private capital market has been a much better solution.
Do you see, a lot of companies that say they're going public? Used to be that sometimes you hear about a company that planned to go public and all of a sudden there'd be a takeover
Yeah.
of that company because it was like, okay, now it's for sale. With some of these big companies though, are there other companies that even can do such a thing? And is this regulatory environment, even though I think President Trump has talked about trying to open the spigots for certain types of sort of headline grabbing deals, he could be more in the sort of Bernie Sanders camp of things in certain cases.
Yeah, so I think the regulatory environment has actually been, it's not that every deal gets approved, right? But when you hear the head of the FTC, head of the DOJ talk about what it is that they want to see, they talk about wanting to be constructive. They are responding both to structural remedies, behavioral remedies, want to understand the deal. Every deal does not have smooth sailing. So it's not, come on, this is bonanza, everyone announced deals, which is also a healthy part of the market, right?
We just talked about bonanza. That's funny that you recently we had an interview about, are we doing something wrong to keep in terms of regulations, or not making it, is it not conducive to public owners? Because we need it. And there are, for investors and everyone else, there is a scarcity of public equity. Is it something we're doing wrong? Is a regulation still too stringent? What is causing people?
So I think for a company to be public, one is, you do have to deliver on a quarterly time frame, which is a bit harder. So when you have to have transformations in companies, which takes a longer time period, right? We talk about the classic case of why a company goes private or why a company stays private. And historically, some of the reasons why you could not do that is because you didn't have enough money in the private markets. So you said, oh, I want to grow, I need to use my currency, and so I need to be public in order to do that. Whereas today, the private capital sources are large enough. And we just talked about the secondary market growing 60% year over year.
Yeah.
So you said, earlier, exactly as you said, there would be companies which think, I can go public or I can sell. Whereas today,
It seems like in terms of inequality and everything else that we talk about, probably not good that
If you're an average investor, you can't get access.
or you got to open up the private markets, which also you get blowback from that.
Right.
That they're not.
having a robust public market is a good thing, and having more companies be public is a good thing. At the same time, having plenty of private capital that's available, and all private capital is not just these large private equity firms, right? Because you have several middle market private equity firms, several founder-owned companies who are raising money from friends and family and are able to do that in today's environment versus 20 years ago. where you wouldn't think about doing that. So several new companies getting formed, several founder-owned businesses, and that ecosystem being very strong.
Okay, what would slow down the deal activity this year? We're expecting some really big numbers, probably a record year. What would slow that down, and what's the likelihood of any of those things happening?
Look, I think we still have a lot of risk and a lot of changing policy.
Yeah.
So that impacts, I think, the psyche of people, and deals beget deals as well. So currently we're in a little bit of an environment where you see one deal happening in a sector, you see more deals happening. The financing environment has been very favorable. The investor community has been favorable. And the synergies that people have said that they're going to get out of those deals, there is a lot of thought and work that goes into it, and boards have been supportive. So the ingredients that you need all of this to be pulling in the same direction. Anyone in this ecosystem has a shock, then you have to deal with that challenge.
Right.
And likewise, I think you may see a lot more of deals in this in-between spectrum. Because you saw, I think, over $1 trillion of minority deals last year, right? That's 20% of the overall M&A deal volume. So deals which are structured, which are not straight, just I sold 100% of the company, I merged this much of the company. Structured deals, staggered deals where it's not 100% sale at one point of time.
Right.
You do it over time, partnership deals.
Right.
All of those types of flavors that we'll see as well, more creativity and innovation in deal doing also, not only in the businesses that companies run.
Anu, thank you for coming in.
Thank you very much.
Good to see you.
Let's check on the future, see if anything has changed. Not so much. We do have the Dow now off a little bit. It was up earlier, but the Nasdaq still trading in positive territory, triple digits, and the S&P up about 10 for more on the markets. Let's get to Mike Santoli. He's at the New York Stock Exchange. Hey, Mike.
Hey, Joe. Yeah, the S&P yesterday did manage a positive session. It was up about 0.2%, but had been down off of a larger gain intraday. Semis and big banks that got a bounce. It sort of helped out the S&P 500, but it's been hesitating right under the 7,000 level over the last 6 trading sessions. The intraday high on 5 of those days has been between 69.75 and 69.90. That's a tiny span. Clearly, there's a little bit of hesitation, or at least maybe a little bit of a few knocks on the ceiling before you get through it. Today, we have an options expiration. See if maybe market can move more freely going into next week. Take a look at the emerging markets ETF relative to the S&P. It's actually a similar chart on a one-year basis, but then you have, this is 2-year actually, then you have takeoff from the EEM just in this last little stretch. And I keep emphasizing the EEM is very levered to the AI trade, the AI hardware trade outside the U.S. It's obviously Taiwan Semi is the biggest holding. A lot of the Korea chip makers are in there. A lot of the Chinese market now being driven by AI excitement. In addition to this sort of commodities boom that's helping some of the metals and mining areas. Take a look here at micro-cap stocks relative to the mega-cap tech group, which is the NASDAQ 100. This is the micro-cap ETF. This is showing you that just in the last little while, this is a 9% year-to-date even, it's only 2 weeks, it shows you that there is still this speculative flow in the kind of darker precincts of the market where there's a little bit less in the way of fundamental basis for it, but definitely risk appetites are rising, and it's part of this broadening out of the market. It's just getting exaggerated in the very smallest stocks, guys.
Yeah. All right, good information there, Mike. We appreciate it. See you later. Thanks.
Okay, coming up, a wide-ranging interview with the tech and Tesla bull Kathy Wood. We're going to talk AI, crypto, and so much more. And speaking of Tesla, later this hour, we're going to speak with Elon Musk biographer Walter Isaacson. Stay tuned. You're watching Squawk, and this is CNBC. Joining us right now on the markets, tech, crypto, and her outlook for 2026. Kathy Wood is here, ARK Invest CEO and CIO. 2025 was quite a year, both up and down and back again to some degree. When you look at some of the big holdings that you have, whether it be Tesla, maybe we get into crypto and everything else, where do you think things are headed? And to the extent that there were things that you were wrong about, frankly, in 25, what was the lesson?
Sure. Well, great to see you. Happy New Year, Andrew, Becky, and Joe. So yes, last year, Morningstar, in the Morningstar rankings, I think we had 3 of the top 5, or 4 of the top 5 were ARK funds, top performing. Of course, we had 2 big corrections. We had the trade turmoil in April. That was an amazing buying opportunity. And what we do typically is concentrate towards our highest conviction names when we have an opportunity like that. We did that. Same with the government shutdown. That was a little less severe. What did we learn? Well, one of the things that we've learned over the last few years is we can see inflation coming down clearly, but in the reported numbers, it is stuck. And I think a lot of people are wondering, wait a minute, this market is near record high valuations. How can this be? This is a setup for a correction, and we're looking at other periods in history. If you look into the 90s up to 97, I think it was, and in the 2000s, the early 2000s, we had very strong markets as the multiple moved down. So what does last year teach us? We must assume that valuations are going to compress. And we do. We do that in our bottom-up analysis for every company. But we're pretty excited about the inflation outlook thanks to oil prices, housing prices big time. You see the home builders, KB Home cutting its prices by 7%, and others following. And productivity gains, unit labor costs coming down dramatically. I think on a year-over-year basis, they're up 1.2%, but the last quarter reported they were actually negative. So there are a lot of deflationary pressures, and the last one I'll cite is technology. Our focus is exclusively on technologically enabled innovation, and in each of the 5 major platforms, robotics, energy storage, artificial intelligence, especially blockchain technology, and multi-omic sequencing, healthcare. I saw the CEO of Bio, very good. Those are all very deflationary in their impact. So pretty excited. We think the surprises are going to be on the low side of inflation expectations.
Tesla has always been one of your big holdings. In terms of just sales, obviously things have been challenged, but there's a lot of excitement about autonomy. There's a lot of excitement about the Optimus robot. What is your sense of where things stand at Tesla right now?
Yes, the EV sales environment has been challenged, but the market is shifting its focus to the robotaxi opportunity. So we're moving from 15% gross margins in autos, the hardware, to more of a SaaS model where robotaxis, recurring revenue model, is those margins are more in the 70s and 80s. And I think as analysts understand that that's where Tesla's going, and they start building in the model for robotaxis, they see a tremendous opportunity. So it's been interesting to me to see upgrades, even by some auto analysts, now that they're beginning to understand that this is not an auto company. Maybe they're working with their tech analysts and understanding the stock a bit better.
So when you think, though, about autonomous robotaxis, and you think about robots, what does that look like? And is there an argument? Look, some of the critics would say, cars aren't working the way they're supposed to be working right now in terms of what's happening with the EV market, and some of these other ambitious efforts are going to take a long time to get to a meaningful escape velocity.
Well, we're keeping an eye on how quickly Tesla's footprint footprint is expanding here. And it's expanding a lot faster, I think, than many people expected. And it's interesting to watch Waymo as well. We draw in Texas. We draw the footprint, and they're competing with each other. Competition is a good thing. So I think this is actually going to happen faster than most analysts think. In terms of the proliferation of robotaxis, especially if we get more federal legislation instead of just state by state. On the Optimus robot side, there's a lot of excitement in robotics. That in the private markets has been a huge space this past year. We look at an Optimus robot. Our chief futurist, Brett Winton, working with Sam and Daniel, have concluded that an Optimus robot is going to be 200,000 times more difficult to get working correctly relative to a robotaxi. So you'll have waves of Optimus improving with time, but full human is going to be quite difficult. Nonetheless, the robots that we're seeing, pick and pack and right. Lifting things, they're starting to make waves.
Should we talk about Bitcoin? Or we can talk about SpaceX. I mean, that's going to probably go public this year. What do you think it's going to go public at?
Well, this next round is about $800 billion, so a near doubling. And we wouldn't be surprised to see it become the first $1 trillion company, and especially now that there's a new opportunity, data centers in space. To avoid all of the not in my backyard obstacles that Tesla and others are facing. So we're starting to do the modeling work on that.
How realistic do you think that is, and what do you think the timeline for something like that is? I mean, I know Elon's talked about that, but then there's lots of people who have asked questions about just the practicality of making something like that work.
Yes, we spent our last brainstorm on a good chunk of it on exactly that. And as I said, we're doing our modeling work. As with everything that Elon Musk does, he's going at this from a first principles point of view. He's not looking at how things are done on Earth. He's trying to figure out what's possible in space. So, as I said, we're doing our modeling work. We shall see. Before getting on to Bitcoin, Andrew, I want to compliment you on your book in 1929. I'm in April 29, and it's been fascinating for me to say, okay, wait a minute, are we at all in a situation like that? I think maybe in the private markets we have been, the whole idea, not literally, but of stock clubs back then. But it is fascinating, the Fed and the stock market and others wrestling with one another. I don't think we're in the same situation at all, but I wanted to compliment you, and I can't wait to finish the rest of the book.
I hope you enjoy the rest of it. But you're right. There are what feels like parallels in certain ways, but hopefully there's other things that actually don't parallel at all. So,
Kathy, Andrew has raised a point a lot that when you got more bullish on stable coins being maybe would supplant some of the uses of Bitcoin, and I mean, stable coins aren't going away. And that caused you, I think, to even slightly lower your very bullish forecast on Bitcoin. Can you just
Yes, that broadcast kind of propagated, and everybody thought we were becoming negative on Bitcoin. Not at all. Stablecoins are usurping one of the roles that we thought Bitcoin would serve in emerging markets, especially. But on the other hand, if you really believe Bitcoin is like gold, digital gold, look at what just happened to gold. If you assume that Bitcoin is going to usurp a lot of gold's role as we get this intergenerational wealth transfer, then our price target net, both for stablecoins and gold, would actually be going up. We're holding it where it is, our bull case at 1.5 million, base at 750. But I'll tell you what has happened to Bitcoin and all other crypto assets. There was a flash crash on October 10th, 10/10. And from what we understand, there were a lot of leveraged individuals, investors, others hurt. We think that it has washed out of the system. We actually think, we have it on good sources, that it has washed out of the system, that correction. It was about a $28 billion hit. We think we're on the other side of that. And so we're seeing the crypto asset ecosystem stabilize, and it was a very good test, actually, very good test. We didn't see Bitcoin go down 75, 80% like we have in other corrections. It went down 35%, which I know is not comfortable, but that's a victory in this market.
And where do you land? I mean, we've been watching all sorts of folks come up with, new treasury companies around Solana and Ethereum and all sorts of other things. How much of that do you think could ultimately crowd out Bitcoin or not?
No, I don't think so. I actually think that DATs are clarifying who the big three are out there. It's an interesting, whereas in the past you'd have a proliferation, you still do, of all kinds of assets and coins. From an institutional point of view, the DATs, primarily Bitcoin, through Strategy, Ether, and Solana, we own Bitmine and Soulmate. Those are focusing the institutional mind on the big three, and maybe we've got another one coming up in Hyperliquid. We will see. So I actually think it's doing the opposite than what we've seen happen in other, or will do the opposite than what we've seen happen in past bull markets.
Fair enough, Kathy. It is always good to talk to you. So thank you for the book. I appreciate that very much. Look forward to seeing you in person very soon. So thanks again. We'd love to. We'll talk to you soon.
Thank you so much, Andrew.
All right, when we come back this morning, we will talk to the co-founders of a company that is using artificial intelligence to renew prescriptions in the state of Utah without a human in the loop. We've got that story next. Squawk Box will be right back.
Welcome back to Squawk Box. The major averages currently on pace for their second negative week out of the last three. But futures in some areas are higher today. I haven't checked the Dow recently. It had just briefly turned, and now it's back positive again. I mean, a little bit, if you recall, 17 points positive. Not much on the Dow, but let's not forget, are our hats ready? Why are we not getting any?
I think that's frowned upon. You look like a cheerleader, right?
We used to do Dow 20,000, Dow 30,000, Dow 40,000. This is the biggie, Dow 50, and we're not very far.
Like the year 2000.
We're not guaranteed to get there. Yeah, we're not guaranteed to get there. But anyway, might be down. NASDAQ is still strong.
Right. AI is being integrated into more parts of the U.S. healthcare system. In Utah, for instance, AI technology is now able to renew prescriptions without a human being ever being in the loop, aside from you, the patient. Joining us right now is Dr. Adam Oskowitz and Matt Pavel. They're the co-founders of Doctronic. That's the AI health tech startup behind Utah's program. And gentlemen, welcome. It's great to see both of you.
Thank you so much.
Thanks for having us.
There are so many things that people talk about with AI and medicine and how that's going to potentially speed drug discovery. But what you guys are working on is something that makes sense, and it seems like it's been some low-hanging fruit. Doctors spend a lot of their time doing paperwork and not necessarily doctoring. Why don't you talk about how Doctronic works, how you guys came up with the idea?
Sure. So Doctronic is an AI doctor, and we've seen 20 million patient consultations so far, but we have a primary care practice behind it. So you can always talk to the AI doctor for free, and then you can see our primary care doctors if you want. And those doctors are available 24/7, licensed to practice in all 50 states, and we see thousands of patients a week with our human doctors too.
It can prescribe anything to me, or I think you have a list of certain medications, the ones that are pretty easy to do.
Yeah, so the program in Utah is a little bit different, right? That is an AI system without a human in the loop. And we have a formulary that we've come up with the state of Utah. It consists of about 200 drugs, most of them low risk.
Most of them low risk, meaning
Yeah.
you're not going to give somebody antidepressants necessarily, or any narcotics?
So yeah, no scheduled medications, nothing that could be addictive. We do prescribe antidepressants. Those are medications that we would consider low risk. And a lot of people are on those for chronic conditions.
What is the speed issue? What's the problem issue? Where's the bottleneck, shall we say, in terms of people just going to the regular primary physician?
Yeah, so it takes about 26 days for somebody to see their primary care physician today. That causes a lot of bottlenecks. The U.S. government pays about $100 billion because of medication noncompliance every year. Improving access can actually solve that pretty quickly.
How often do I have to see a doctor right now? Because it strikes me that when I have a prescription that's up, I just call my doctor's office and they renew the prescription for me. It's probably only an annual visit that I have to make to the actual doctor themselves.
Yeah, I think that's about right. There's going to be visits in between where you do need to renew your medications, and it's going to take a long time to do that. And so by filling in those gaps, we can allow doctors to practice what they really want to do at the top of their license.
But when I call my physician's office, I don't talk to the physician usually for a refill. I just talk to the assistant in the front of the office.
Yeah, it depends on the doctor that you're talking to in the office that you're talking to and the medication. I have high cholesterol, so I'm on statin. Every 3 months I have to have a conversation with my doctor because that's what she wants, and that's fine, but it's cumbersome.
And part of the problem is that people in rural areas in particular don't have access to physicians as easily.
Yeah, that's correct. And I think most people out there have realized that it's actually hard to get in front of a physician. Right? A lot of people actually don't have primary care doctors, and so they go to the emergency room for these refills.
Right. Is there a situation where the AI doctor would tell me, no, you can't have that prescription, or is this an automatic yes every time I call?
No, that obviously wouldn't be AI at that point. That would just be a rubber stamp. So the AI does go through a process of making a clinical decision, right? It gathers a bunch of information and decides, yes, this is safe for a refill, or if it decides it's not safe for a refill, it escalates you to a human doctor so that you can talk to them and actually get that medication if needed.
An important aspect about this whole process in Utah too is we're only charging $4 for the AI to do that whole renewal process, and that will be reduced at scale. So it's really helpful for people who don't have health insurance or have health insurance with high copays. The cost of seeing a doctor is also a barrier to getting a refill.
Yeah,
especially when you then have to pay for the prescription.
So what about these mistakes that we see in AI from time to time? How do you guarantee those mistakes either don't happen or happen at a very minimal amount when you're dealing with someone's health?
Yeah, I think it's important to realize that the product you're using
when you are in the state of Utah is fundamentally different from what you would use if you went to ChatGPT or Anthropic.
That's what I was going to say. This is
There are guardrails within our product that are not powered by AI. So the AI is sort of the engine. We built a car around it so that it's safe and effective. And so there are about a dozen checks that happen on the back end when you come and see our system so that we can't prescribe things that are not appropriate.
Our team.
Is it a small language model, not a large language model?
It's multiple large language models streamed together with a number of models that we've built ourselves.
And I'm sorry, you were going to say what?
I was just going to say our doctors are overseeing some of this and making sure that things are working. And they say that the AI is asking more questions than they could possibly ask during a refill process. It would take them half an hour to do this, but the AI is doing all of these things by itself.
Can I ask just one question about the refill process itself?
Yeah.
I have a doctor who, like your doctor, who wants you to call every 3 months
Yes.
or see you every 3 months,
Yes.
and it seems insane. And it seems like I don't know if they're doing it for actual medical reasons or they're doing it to try to get me into the office so they can charge me by the. No, I want to actually just speak to the actual thing because there are doctors who I think are using this process not just for medical purposes but possibly to rip people off.
Yeah, I mean, there is certainly a component that some physicians will use it to come and see them, right?
Right.
They generate revenue when you see them. That's for sure. The vast majority, though, are actually checking in with you, just making sure everything's okay, because they don't know if you're actually taking your medication. They don't know if the medication is working, and so it's really just a check.
Right.
And that's why AI is so important here, because that's something it can do.
Oh, it's so interesting, like statins, for example. There's no question that when you first start on a statin, you do want to come back to make sure that it's actually working and your cholesterol is going down and all of those things. But after you have figured out that it actually works, the idea that they're not prescribing you, a year's worth or 2 years worth of this stuff makes a lot less sense.
That's right. I have to have an annual blood test, right? Because I'm on a statin. Great. The AI will know that and say, okay, you've had enough refills. Now you need to get your blood test before we give you another renewal.
Most of mine will just give it to me when I call
A year,
them.
for sure.
Yeah,
Right.
for a year at a time.
I think
some do, but I'm just saying there is a use. I've seen it where there are certain doctors who just will not help you. By the way, I had an eye doctor. I needed to get new glasses, oddly enough, and I hadn't seen the eye doctor for a year. They said, "Oh, the prescription is no longer."
Every year, and that's every eye doctor.
And we
They
can't.
won't give you context for
You know,
I'm thinking this is insane.
The
All
other
I
big
do is
scam
go by the-
around here, if you don't want to go every 6 months or 3 months, you can have the concierge service. And that's like 15 grand a year.
You can afford that.
But apparently the office will take your calls.
Day and night.
No, business hours. Right.
Oh, well, interestingly, we're day and night.
Yeah. Let me ask you, how do you guys make money? If it's only $4 for every visit that comes through,
So we actually
this
have a
stuff is
margin
pretty
on that
expensive.
because it's mostly AI, right? We're not paying for the medication itself, but the AI running and everything that goes
I just
in-
thought it was expensive to develop large language models and stuff that goes on top
It's
of it.
expensive to develop, but it's not expensive to run. And that's the secret.
So what's your break-even level? How much do you have to make to be like, okay, this is profitable at this point?
I mean, our margins on 4 are enough. And frankly, a lot of that is some of the things like the identity verification we have to do, which is only that first time. Once you're a customer, we don't have to do that again. So we should be able to drop those prices in the future after you've already started using the system.
Matt, Adam, thank you guys both for coming in. Appreciate it. Yeah.
All right, coming up, a new push from the Trump administration to address sticker shock at car dealerships. Phil LeBeau has that story next. Then Walter Isaacson will join us on how the American dream has changed over the years and whether it's affordable for most Americans. Squawk Box will be right back.
Welcome back to Squawk Box. The Trump administration making a push for more affordable cars and trucks. Phil LeBeau joins us now with the latest. Good morning, Phil.
Good morning, Andrew. You guys mentioned before the break sticker shock and the administration's efforts to remove some of that sticker shock by making vehicles more affordable. Take a look at what the average price paid is for a new vehicle right now. If you went out, this is according to Cox Automotive, if you went out to a dealership, you'd be paying $50,326. That is an all-time high. And for the Trump administration, they realize, and they've heard the complaints from people across the country, wait a second, it's too expensive to buy a new vehicle right now. Heck, used vehicle prices are close to a record high as well. And so this is the beginning of their efforts today to say, look, we need to make vehicles more affordable. The average monthly payment, and this is how most people look at buying a vehicle. The average monthly payment, according to Edmunds right now, is $781. You really want to be surprised? Look at the percentage of auto loans that include a monthly payment of at least $1,000, if not more. It was 5% back in 2019. Now, 1 out of every 5 auto loans, according to Edmunds, has a monthly payment of at least $1,000. For GM, Ford, Stellantis, they're going to be part of the tour today with the administration, where representatives will be talking about auto affordability. Look, their profits have been growing. And the argument that you will hear from people in the auto industry is, it's not my job to tell people they can't afford a particular vehicle. My job is to give the market what it wants. And right now, the market is willing to pay more for vehicles. So later on this morning, we're going to be talking with Transportation Secretary Sean Duffy, as well as EPA Administrator Lee Zeldin, U.S. Trade Representative Jamison Greer. This is going to be a first on CNBC interview coming up on Squawk on the Street. You don't want to miss what they have to say. Guys, I think the big question is, what does the federal government want? What does the Trump administration want from the auto industry? Are they looking to mandate a certain number of vehicles are sold at a certain price point? I don't think they want to get into setting prices on vehicles, but it is a real interesting question and a bit of a dilemma for the auto industry.
Fair enough. Phil, we appreciate it. It's very interesting to see what's going to happen next, and I'm sure you'll keep us updated. Thank you.
All right, coming up, we're going to talk to Walter Isaacson about affordability and the American dream. That's next. And then make sure you tune in next week. We'll bring you live coverage of the World Economic Forum in Davos, including an interview with President Trump on Wednesday. Squawk Box will be right back. According to a recent Politico poll, 49% of Americans say that the best times of the country are behind them. Join us now to talk about the current state of the American dream. CNBC contributor Walter Isaacson. He's a professor at Tulane University and the author of the biography Elon Musk and an advisory partner at Perella Weinberg. And it's good to see you, Walter.
Good to see you again, Joe.
You can explain what you think. We had Arthur Brooks on earlier in the week talking about what's wrong with I guess it's cross-generational, but some generations seem to be less happy than others. And this is the greatest time to be alive in the history of the world. And I'm not even talking about all the great apps you can get on your iPhone. But I look at what Google Maps do for me, trying to drive around. That, in and of itself, makes me the happiest I've ever been in as long as I've been allowed to be able to do things like that. What are we missing right now?
Well, you're right. In terms of goods and services, amazing things, cell phones, apps, it's a great time to be alive. However, there's something about the American dream, and you showed it in your poll, which is, and it really gets down to housing costs and basic costs. About 40 years ago, half the people in America, when they hit 30, were able to own a home, be married, have a car, start having kids. Certainly when I was 30, I was part of that majority of people, my age cohort, who was able to have a home, be married, start and have kids. Nowadays, that's less than 15%. I think it's largely housing costs. However many Google Maps you have on your iPhone and wonderful games you have, if you feel you can't afford a house, housing prices have gone up 50% since before the pandemic. But much more generationally, when you talk about it, our parents, kids, grandparents, on one salary, generally could own a home, have a car, start having kids.
I wonder, I mean, obviously it depends on where you want to live. There must be, but not everyone wants to move to, I guess, the middle of the country where you can afford a.
Well, hello from New Orleans. It's not that bad here.
No, it's not. And I know I could live like a king in my hometown of Cincinnati on a lot less money than one of these bedroom communities in New York City. I don't know what the answer is necessarily, Walter. I remember
I think the answer is pretty simple when it comes to housing, which is build more housing. We have all sorts of restrictions, we have zonings, we have regulations. We've made it harder to build housing. Clearly, that's half the equation. The other half of the affordability is people's wages have stagnated over the past 40 years in globalization. But if we really wanted to do what happened to my father's generation, which is build huge amounts of housing and have VA loans and FHA loans, we could have housing that's affordable again.
It's not like there's no land. Good God, all you got to do is, just drive out. The minute you get 10, 20 miles out of a city, it's like you look around, it's like, it's empty in so many places. I thought when I was just entering college, I thought I could never buy a house because mortgage rates were up at 15%. That's when I was really sure you could never buy a house. That's not the problem right now. So that's been supplanted by something else. Is it beyond housing, Walter? Because with AI and a lot of jobs just perhaps going by the wayside, we start hearing about UBI and things. I don't know if anyone's ever going to live the American dream if it's, the government is just paying for your sustenance and food and everything else. Because
the American dream, that phrase, the American dream, was coined by James Truslow Adams. Sorry about my voice, I guess something's happening here. But he said it's not just a dream of high wages and motor cars, merely. It's the idea that your children are going to do better off than you and that you will have dignity in your life. And yes, that dignity comes from work. I'm not particularly worried about AI. I think it'll create more jobs than it will destroy. But I do think, you put your finger on it, Joe, there's an economic insecurity. I'm teaching at Tulane. Parents of the kids say, well, what jobs are going to be there? Yeah, maybe there'll be more jobs, but tell me, how do we make sure that we know not only our lives will be secure, but our kids will have an economic future?
So Walter, I assume that you are at least questioning some of the comments that Elon Musk has made in this regard. He has a view that we're all going to be living sort of a leisure life in the future because robots are going to do everything, and he believes the cost of everything, therefore, becomes de minimis. I think the question's always been, how do we then live? Who's paying the bills? How does that all work?
I remember being with him when he first, and it's in the book, these descriptions of Optimus, and watching the hands work, Optimus the robot, watching the eyes, the cameras process information. And yes, those robots will be amazing, and it will especially be important because it takes AI out of the realm of large language models and doing things that you can tell ChatGPT to do, into doing real world things like driving cars or working in factories. That said, and I'm loath to disagree with Elon Musk, but that said, every time we have a new technology, whether it's steam-driven looms or any type of productivity, you get more productivity. Therefore, you get more wealth and more demands for different types of goods and services. So I do think there'll always be a demand for humans who know how to work with AI, and there'll always be jobs.
But do you ultimately think that the money effectively will accrue to just the large language providers, the technology companies? I mean, part of the question becomes sort of how money gets distributed throughout the economy in the future.
That's exactly the right question. Whether it was globalization and free trade that had caused an explosion of wealth, but it didn't distribute it to the working class and the middle class as well as it did to heads of big corporate owners. Likewise, AI could do that. It could end up exacerbating this wealth divide, exacerbating the hollowing of the middle class. But that's a policy question, not a technology question. You can fix that pretty easily if you want, and you can just make sure the distributions of the proceeds from a booming economy are distributed not simply to the big companies.
You know what? It sounds like you're not writing it off for good, Walter. That's what I'm going to take away from this, because it should be getting better and better and better. And I watch Reagan talk about a shining city on a hill and all that kind of stuff. And I just hope our best days are ahead. I hate to hear that most people don't believe it.
I think they will be. And I think we can easily get housing costs down. And at Tulane, I'm creating companies that say will write people's biographies for them. Those are the type of new jobs that I think will be created.
Well, can they write Leonardo da Vinci's biography? I mean, then what's that going to do for you? That's not good.
It's good. We all want the next generation to succeed.
All right, Walter. Thank you. See you later.
How about
We'll have more Squawk Box right after the break.
programming note, a huge week ahead. Next week, we're going to be live at the World Economic Forum in Davos, Switzerland, all week with a huge lineup, including the CEOs of Arm Holdings, UBS, Coca-Cola, Anthropic, Cisco, Palantir, Uber, Wells Fargo, Bank of America, and so many more, including will.i.am and David Beckham as well. All of the action starts on Tuesday morning. And yes, Joe Kernan sitting down with the President of the United States, President Trump, with a huge interview that's going to make a lot of news on Wednesday. And we're looking forward to seeing you all from the out. If you want to get a pulse of what's happening around the world in the markets, this is it. Scott Besson is going to be with us, and so many more. I know we got a whole bunch of panels. You're seeing Andy Jassy from Amazon. I've got one with Ken Griffin and Larry Fink and Christina Lagarde. I'm sort of thinking through all the names. So it's going to be
Uber work.
It's going to be big. Does Uber work there?
In Davos?
Uber food.
Dara Khosrowshahi is going to be there.
I'm going to ask him because I have trouble getting food.
Well, I'll try to help.
Protein bars.
Make sure you join us on Tuesday, Squawk Box. On the street, Squawk on the Street, coming up after this.
Good Friday morning. Welcome to Squawk on the Street. I'm David Faber with Jim Cramer. We are live from Post 9 at the New York Stock Exchange. Carl has the morning off. Happy Friday, everybody. Let's take a look at futures, of course, as we get started with the final trading session of the week. As you can see, set up for, or I guess we'll call that a slightly higher open. You ready? You good? You all right?
No, I'm not ready. I've been up since 3 o'clock. What do you like talking to me?
All right, I'm sorry. I got to talk to you. It's the show. All right, let's start with our roadmap, though, this morning, because he doesn't seem to want to talk. It begins with the state of stocks as the Dow and the S&P get closer to new milestones. Plus, JP Morgan CEO Jamie Dimon says, all right, he wants to stay in the job at least 5 more years. We'll talk about that. They say he was joking. And the U.S. and Taiwan reaching a trade agreement that will allow for the building of chips and chip fabs here on American soil. The deal has a total value over, obviously, a lot of time of $250 billion. Speaking of chip manufacturing, Micron CEO, he's going to join us in a first on CNBC, talk about that company's plans for upstate New York, where it is building some big fabs as well. Let's start with the markets. Chip sector on track to extend its rally. The S&P 500 continues that march toward the 7,000 mark. What are your thoughts on this fine morning, very cold morning here in New York?
Once again, what's happened is, and we talked to Sanjay Broju, people misjudged. They misjudged the amount of business. But I think it's important to talk about. I will ask Sanjay. Last year at this time, Micron had a bad miss. Projected wrong. They projected too much. They had a lot of inventory. Obviously, since then, amazing things have happened. But this shortage is the making of the market. Sanjay, I was very bullish a year ago. I came out on this show and said some things about high bandwidth memory that were aggressive. And Sanjay called me and told me that I was too bullish. And I look back, he was too bearish, but he had the shortfall because he had too much inventory. I want people to understand why this happened, okay? This is not a shortfall that was manufactured in order to be able to raise prices. It wasn't manufactured at all. There was no way you could see this. I think that's why.
It's just, what, a result of the enormous demand coming from everything we talk about?
Look, here I'm looking at it. This is from 2024. We expect industry DRAM bit demand growth to be in the high teens. No, it's in the 20s. I mean, he said the bit supply growing roughly in line with bit demand. That was wrong. NAND bit demand growth in calendar 2024-25 now low double digits, completely wrong.
Right.
And I'm not saying that means that Sanjay was not good. He was the best. He was the best, and he got it wrong. I think that's the point.
All right. Well, we're going to have a chance to talk to him, but what's the larger point you're making here?
That we have an insane demand, whether it be power, and we're going to get to PJM, which is the utility index that's under fire, the utility group's under fire, whether it be DRAM. We just don't have enough. And people have to understand that this shortage is impacting everything, making it so that everything's more expensive. and the powers make it, the PJMs make it so everything's more expensive. This has caught everyone by unaware, including the principal company that we all needed to do with Taiwan Semi. And all I'm saying, David, is that this is one where it's people couldn't have foreseen it. Sanjay had the best vision of everyone, and he couldn't foresee it. That's how
it's not as though a year ago, Jim, we were not sitting here and talking about the enormous demand for NVIDIA chips, for all the compute you could possibly get your hands on, for data centers and power. We've been talking about that for well more than a year now.
Look at who you said saw it coming. Jensen Huang. Jensen Huang is here, and everyone else is there. Jensen knew. Jensen saw it coming. People should have listened to Jensen Huang. They should have listened to him. They did.
Well, who's the they that didn't?
Everyone.
That's not true. There are plenty of people who benefited enormously, both from. By the way, a lot of these. Right, that is sort of those stocks have been the real beneficiaries. NVIDIA, nobody's going to complain about a 41% gain over the last year.
Jensen, people thought at GTC, the conference we laid out things, that he was way too bullish. That he was, frankly, dreaming with the Vera Rubin. Dreaming with the Richard Feynman. That's the next.
Yeah, the next generation.
And he saw it, but he would tell you, my job. I see things out 20 years and then I work backward. Now, don't forget, Jensen. He's going to tell you that with the work that David Ricks and he's doing at Lilly, we're 100. Being 100.
Yeah, that caught your attention at the J.P. Morgan Healthcare Conference, where they talked about the ability to extend life and then potentially.
Well, they talked about the
extend life for a very long time. Yes.
Well, forever was discussed. I think that was a little more science fiction. Remember Asimov? It's kind of an Asimov thing.
Isaac Asimov.
But
yes.
I want to point out that Jensen did, and others didn't. He understood the demand. He went to Taiwan Semi, and they believed in him.
So what does all that have to do with the price of the S&P, my friend?
No, I'm just talking about the crisis that we have in this country right now.
Crisis?
Well, the growth, 3 times deviation, 6.7%. We don't have it on the grid. We can't do it. There's a gating factor. This is the Michael Semblis theory, the chief strategist.
We will not have enough power. By the way, I mean, you talk to them. I try and talk to as many people in this ecosystem as I can, and I have had conversations with the CEOs of, let's call them data center companies, for lack of a better term.
Yeah.
I don't think a lot of them think that, that a lot of what's being drawn up is ultimately going to be built in part because they won't have the power. I think that in the industry, it's not even a secret. It's kind of known. I mean, they're going to build a lot, but not as much as everybody says because you don't have access to the power.
Then I want to take numbers up Meta because they're the ones that are committed to spending the most. I might take numbers up Microsoft.
Unless you continue to gain efficiency that goes beyond what might be thought, and therefore you may ultimately not need as much in the out years. Let's call it 5 years from now. Or is it just, no matter how efficient the chips become, you're just going to have more and more of them because you need more compute. You're going to be doing even more things. By then, we may be at AGI. Who knows?
Right, and remember, it's behind the meter. They won't do that. They won't let them because that's a way to be able to get power with, just hog power. They're trying to stop. President Trump's trying to stop the hogging of power. PJM is a cooperative.
Yeah, it's cooperative.
Over 10. I don't know if you look
from New Jersey down the Northeast Coast.
I don't know if you've read the document.
It includes Virginia, where of course we have so many data centers. And yes, there is an effort being made now to try to figure out ways for these companies, the hyperscalers, to basically fund their own power plants. You see it there, build their own power plants.
Yeah, but
have them be a part of the grid at some point.
I'm reading the January 14, 2026 PJM load forecast. This is 60 million more payers. And it says the 2026 long-term load forecast is lower than the 2025 long-term forecast. Lower.
Meaning they won't have as much power.
Well, the forecast.
They're not expecting as much.
Yeah. Well,
that's wrong.
You are a genius.
Thank you. I thought it.
But anyway, I go here. Now, let's back. You want to talk about the market?
I want to talk about the market.
I'm sorry. I just am so hot under the collar. You made your points. And I shaved this when I cut myself so hot under the collars. I don't know if the blood came up.
No, you're fine. No, you think blood there.
So let's talk about the overall market.
Yeah, can we do that?
The overall market is being led by companies we've never heard of. Russell. When you go down, what you see are, you're seeing flying helicopters and drones, and you're seeing tertiary companies that make power plants. And you're seeing things that will never come to fruition. Oklo. But, Oklo and Sam's there. And I want to talk to you about something that's probably the most important story today. Everyone's ignoring.
Tell me, what?
What happens if Elon Musk stops OpenAI?
Well, you know that I was the one, I think last week I reported on this lawsuit actually going to trial.
Well, it was meant to be a soft pitch. It meant to be that I gave you a Dodgers versus everybody else.
Unbelievable. What are the Dodgers doing? $60 million a year?
I don't know. I thought there was like a cap. Defer. I'm going to defer. I'm deferring your answer.
What is the luxury tax going to be about? All right, but the point you're making is that this lawsuit from XAI against OpenAI, really from Musk against OpenAI, which we've talked about, alleging fraud, is going to trial a little bit later than we reported last week because the judge pushed it out a little bit.
That lawsuit.
And it is interesting that what OpenAI is saying, right? I'm trying to find it. They're saying you're going to hear a lot of things and you shouldn't believe them.
Oh.
There it is.
What is that?
Outlandish claims.
A lot of things you shouldn't believe.
But your point is the correct one, which is what would happen to OpenAI were and if Musk was to prevail. I don't know is the answer because we don't know what the remedy would ultimately be.
Well, would you be in a, let's say, $1 trillion private offering, would you be anxious to get stock in something that might be destroyed by Elon Musk?
Yeah, that's a concern. It's a risk.
Now, Elon Musk is
By the way, there are any number
plays with. It's played out.
There are any number of other risks when it comes to OpenAI. There's also a lot of opportunity. Those who own OpenAI shares right now, private company, would say.
Well, I just wanted to put it out there because I'm going for the themes that are behind the scenes. I am happy to talk about the bond market and how the 10-year stayed where it is. I'm happy to talk about these Fed lunatics who come on and think that they have the right to be able to confuse our policy. There should be a shut-up policy. A shut-up policy. They don't do us any good. We're trying to grow this country. We're not trying to say what's going to happen and what's not.
On the OpenAI or Musk versus OpenAI, they did in a letter that they sent to employees, OpenAI said they believe the case is worth no more than the $38 million that Elon donated. Were that to be the case, it obviously would not be of great importance. As you might imagine, Elon and his lawyers believe otherwise.
Yeah,
we'll leave it at
he's
that.
like the Justice Department.
As we get closer
the old Justice
into the spring, we will start to follow that a lot more closely.
Okay, I know that I truncated what we should have been talking about, but I don't believe that because I think that this PJM story, I think that the power story, I think that the Micron story are really important, more important than where the averages are right now, unless you want to decide, you know what, Boeing is the best.
Boeing shares are.
That's a long time ago. I remember it like it was yesterday.
Never forgets. Never forgives. You never forgive.
I never complain. I never explain. Who said it?
Who did
Henry
it?
Ford. Great man, maybe.
Really? You want to go there?
Not at all.
Historical record might say otherwise.
It was just a cheap shot.
Okay. Elders of the Protocols of Zion. Up next, shares of Micron have more than tripled. You just saw it. Look at that. That's over just the last 12 months. Companies set to break ground on a new chip plant in upstate New York. We will have Micron CEO Sanjay Mehrotra join us when Squawk on the Street comes right back.
Welcome back to Squawk on the Street. Rick Santelli here live at CME HQ with some of the last breaking news of the week. These are December reads on industrial production and capacity utilization. Industrial production expected to be up, well, 0.1%. Comes in much stronger, up 0.4%. And last month gets upgraded from 0.2 to also up 0.4. So back-to-back 0.4. Those are the best levels since June when we were up 0.5%. Now let's look at utilization rate, shall we? Expecting a number around 76, and that's kind of where it's been congesting, but this one comes in a little out of that range. 76.3, and last month also improved from 76.0 to 76.1. 76.3, that would be the best level going back to, well, pretty much equaling, and July was just a smidge higher. Remember, on utilization rates, they take it out a couple of decimal points. A couple of big things going on very quickly. Here we are hovering right around 419 in a 10-year. Last Friday it closed at 417. Yesterday it closed at 417. It's very, very, very tight on all the closing yields, whether you're looking at 2s or 10s. And if you look at the spreads in corporates, they are some of the tightest since 2007. Jim, David, back to you.
Thank you, Rick. This is probably the most exciting story that's happening today, David. Micron's set to break ground on a new chip-making complex in upstate New York that's funded in part by the 2022 CHIPS Act. It's the first of an expected 4 factories at this site. So joining us now, first on CNBC, Micron Chairman and CEO, and one of the most self-effacing people I've dealt with in our business, David, Sanjay Mehrotra. Sanjay, tell us what you're doing there, tell us what it means, and tell us what you see happening in the most important market, in the most important part of the data center.
Good morning, Jim, and happy to be back on your show. Today is an exciting day. Micron is breaking ground here in Clay, New York, near Syracuse, for our large manufacturing fab infrastructure. Each of these fabs will be 600,000 square feet in clean room size. That is the size of 10 football fields. And Micron last year had announced with Trump administration investments in the US for leading edge memory manufacturing of $200 billion over the course of next several years. And this is part of those investments. Leading edge memory is in high demand. AI-driven demand is accelerating, it is real, it is here, and we need more and more memory to address that demand. Today, memory is not just a system component. It is actually a strategic asset because AI-driven systems need more memory, they need higher performance memory in order to really do all the real-time contextual processing that AI systems require. And just keep in mind, this is not just in data centers. It is from data center to the edge devices, to smartphones, to PCs, to automobiles. And so memory growth is at the heart of everything driven by AI. And Micron is working hard. Today is a proof point that we are working hard to bring additional supply. I'm very excited about the historic milestone here in New York State.
All right, now you have kept us, our country, I'd say in the game, so to speak, because you build here. Will we be able to be the leader? I know that you're one of the top, but the leader in this, because I think a lot of people feel that we're not going to be able to keep up, or even maybe we fall a lot behind China, behind Korea, by Japan. Where are we going to be as a nation when you're done this?
Jim, Micron is the only memory manufacturer here in the US. And we have clear global leadership in technology, 4th successive generation of DRAM technology leadership, and 3rd successive generation of NAND technology leadership. So when it comes to technology, when it comes to manufacturing excellence, and deploying that technology and manufacturing capability into products that are really enabling, key enabler of AI today, Micron is absolutely leading on a global basis. And we are, of course, adding to our manufacturing footprint worldwide with $200 billion of investments here in the US to increase our supply over the coming years. Today we are announcing New York. We already have our first manufacturing fab in construction in Boise, Idaho, next to our R&D fab that will start bringing up production, first wafers out, by middle of 2027 timeframe. Second fab in Boise, Idaho is already in the design phases, and that will follow about a year later in 28 timeframe. And then will come the New York fab. So Micron is making the investments supported by our best competitive position ever in our global technology leadership and product positioning. Let me just give you one example, if you allow me some time here. Our high bandwidth memory, HBM4, this is the next generation that will start going into production this year. This is the highest performance, high bandwidth memory in the industry today. This is critical for AI accelerators today.
Okay. You and I had a bit of a dispute last year at this time where I was telling you I thought high bandwidth memory was going to be much bigger. You told me I was well ahead. You told me to maybe back off, back down. I look at what you were saying a year ago, and I know you had a big inventory problem, so I totally get it. It was a friendly discussion, kind of like the one we're having now. And it did seem like to me that something went very wrong. Your stock was at 99. Now your stock is at 336. There is a definitive shortage. It was not your fault, but how come people couldn't foresee this?
You know, we work closely with our customers all the time in terms of projecting in our demand, and of course bringing our supply in line with that demand. At the beginning of calendar 2025, industry expectations were that the server growth in terms of units would be around 10%. That ended up by the end of calendar 2025 in high teens. Of course, again, faster than expected acceleration of AI demand. Similarly, Jim, PCs at the beginning of the last year expected to be in low single-digit unit growth worldwide, ended up around 10%. So throughout the year, we saw tremendous demand acceleration, and it's not just about servers and PCs, smartphones, everything needs more memory, more content in order to really fully realize the experience of memory. Today, memory has become essential because if you don't have enough memory and it's not high performance, you cannot deliver the capabilities of your systems, whether it is in the data center or in consumer devices. So the demand is growing faster, and this is why Micron has planned to invest. And just the lead time to bring up these new fabs, it takes few years to build out these clean rooms and to equip them, to facilitize them, and to bring up the production. And Micron is really leaving no stone unturned in terms of bringing up more supply.
2030, I think, right? It's David, Sanjay. So given all that in terms of demand, what we just heard Jim say, what you've said, what are your expectations this year, given that you underestimated how things would look a year ago?
You know, we have always said that AI is a key enabler for memory industry, and we have said memory will be one of the biggest beneficiaries. Even in 2023, we have said that. And we see that 2026 will be supply constrained. We had said last year that we see 2026 supply to be even tighter than the supply in 2025. We see that tightness continuing into 2027. So we see durable industry fundamentals over the foreseeable future here, driven by AI demand. So the key is to bring on additional supply to meet the requirements of our customers across the market. So that's where we are driving increased manufacturing efficiencies, trying to get every increased wafer unit out from our production facilities, driving hard on technology transitions, and of course making the investments here in the US, as well as technology transition investments in our facilities overseas, to increase our supply as fast as we can to meet this growing demand.
Okay, Sanjay Mehrotra, CEO of Micron, great job. Only one in this country. Can you imagine? Great to talk to you. Thank you for coming on the show.
Thanks for bringing it on, Jim.
20,000 page environmental review dragged on for 2 years. It's important to point out, but no one foresaw it, and that's what I really want to get at.
No one foresaw the
Sandus didn't see
it.
Look at the prices. Sandus didn't see it. Western Digital didn't do it. Seagate didn't do it. And Micron didn't see it. No one saw it.
All right, we'll be back right after this with Jim's Mad Dash. right, let's get to a mad dash with Jim. We're going to talk a little FedEx because they did, now, not a surprise, but it's official. They filed their Form 10 registration for the spinoff of FedEx Freight, Jim. This is happening. They've given us now a board of 8 directors as well, a board of directors, for the company as well. So it's off and running.
Yeah, and this is exciting because we were waiting for it. Now, if you take a look at, I don't know if we can get FedEx overlaid or UPS, but Raj Subramanian has been about as good as you could be. He knew that there was to be a freight recession. He knew we were coming out of it. I do like the spinoff. I think it would be good, but I think that the FedEx actual is fantastic. And I salute Raj for really figuring out the best way to follow up on the late Fred Smith and the amazing work that Fred Smith did when he created this company. And Raj would agree. This is an amazing company. Fred built it. Raj is doing a terrific job succeeding.
All right, we'll keep an eye on shares of FedEx, of course. Again, not unexpected, but a confirmation of the plan.
10-member board.
Yes,
There's
10-member
spin-offs. Now, this is going to be sooner. Some of the spin-offs, some people feel Honeywell is taking too long. This morning, they're doing an upgrade. That's terrific. They're also spinning up, by the way, their one is completed, which is very exciting.
All right, we just heard the opening bell here for this Friday.
We said?
Take a look. No, nobody heard what we said. Take a look at the real-time exchange back at the headquarters. Of course, here at the big board, it was Singapore software company Tech Create celebrating a recent IPO. And NASDAQ, the cast of Disney's musical Aladdin. It's been around for quite some time.
Yeah.
Made some money, which is incredibly hard to do on Broadway these days if you are a musical. Almost impossible. They're going to have to rethink their business model over there. All right, but that's not what we're here to talk about.
Disney City cut price target just
on Disney?
Yeah, 145 to 140. I think it's important to point out.
Sure, it had nothing to do with Aladdin. All right, as we get started here, NVIDIA and AMD adding to the gains from yesterday. We started the show
at one point was
talking more broadly about
320. It got clobbered.
Yes.
Actually, it began around 240. It was up 6, 5, 4, 3, bouncing 3. But again, it does not have the power of who we just saw. Sanjay Rocha. No, I mean, if you want to make money, I mean, we can talk all day about policy.
And why doesn't it have the power?
Because people don't believe that the companies that are going to buy the chips are going to build all that you're talking about. Remember you said they won't build? NVIDIA needs everybody to build. One of the reasons why Jensen was out with the drug companies at the healthcare conference, he needs to have more than just the hyperscalers want chips. And he's doing it. The demand was great. Taiwan Semi did not single him out.
The demand is for their chips is it seems endless right now. It's sovereigns, obviously, that all want their own AI and are building aggressively. It's obviously the hyperscalers and others, the CoreWeaves of the world, and so many more who are then selling the capacity to the OpenAIs and the
But do you think Meta will spend the additional money? It's not clear.
Additional being what, Jim? I mean, Meta's already online for what, 70+ billion in spending.
This man killed his in the conference call. He literally killed his stock by saying, "Listen, we're not spending enough. We have to spend more." You can take a look exactly when it happened. It was right. The stock dropped just we get this. When he talked about the spending more, 755 down very quickly to 580. And it's back to where it's almost back to where it was. You can't spend what they want to spend and still deliver better earnings than we think. It's important.
It is important.
One company.
And investors have taken note, hence the fact that Meta is essentially flat as a stock for the last year.
But there's only one company. There may be only one winner.
Alphabet.
And it's incredible. When you're out at the...
I don't know that that's the case. I'm just answering the point you were making.
When you're speaking to the 14 CEOs that I did and the 3 offline, including some very good mezcal, what shocked me was that they really wanted to talk about whether Google won. And is it over?
It's funny because you and I, we do tend to have similar conversations, whether we're together or whether we're 3,000 miles apart, you on the West Coast. And I've had similar, even this week, with a number of people that at least raising the question because of Alphabet, and also raising the larger question as well, is just the enormous power this company has, the likes of which we rarely have ever seen.
3 years ago, we thought that they were finished.
In terms of how connected they are to you and what they know. It's not just Gmail and your YouTube subscription, or Waymo, where they seem to be in the lead, certainly, or of course Gemini.
Yeah, YouTube YouTube is just the most watched. You know, I'd love to get 10
And all of the data that they have and are taking in every day.
But you know what? They don't know you as well as, you know, one of the things I find disconcerting is that ChatGPT knows all about me. I said, listen, I'm meeting David Ricks from Eli Lilly. Would you like 10 really hot Mad Money questions? And I said, no, I want to do it myself. Well, I'm available for any help you want.
Right.
I appreciate that, but I don't need your questions.
Some people get uncomfortable with just how well Chat gets to know you and want to actually eliminate a lot of that because they do become somewhat uncomfortable. That said, it is seen as one of the ways to make sure that you are connected to Chat and that you don't churn off
and I like this
and move to one of the other bots.
But see, that's the problem, David. The others may have lost their relevance. Remember, Google did this once before. Now, Meta is going to dominate social. By the way, Anthropic, really good because it's business to business, right?
Anthropic has got a great place in the enterprise.
Microsoft, we're suddenly uncertain. I don't want to ever count out Nadella. No. That's foolish. And, you know, Jassy, well, you know what? Look, it makes you want to buy more things. It's just that I'll feel like buying things off Google. Now, one thing people tell me, listen to me. One thing people tell me, are you kidding me? The next iteration of OpenAI's ChatGPT will blow Google away. We keep hearing that.
Right. And by the way, because even though they've had, you know, that's been the way it's gone. They blow you away, then the next one, well, not so much, and then they blow you away, so
but how about Apple not going up when the tie? Apple spends almost nothing on this. Everyone said that was because they were incompetent. Well, call me incompetent. I'd like to be as incompetent as Tim Cook was.
I did say report yesterday they are now in the market for compute in a way they haven't been previously. But you're right, they don't spend much.
You know, I said,
their CapEx is obviously not.
I asked her to. I asked her to set it at 320. At least she gets 320. But I just feel like I don't really count on Siri for doing much. But the new Siri, I will identify myself, talk about why the Dodgers are able to invest more than anyone else, because that's a quandary to me. Talk about the Harbaugh hire and what it means, even though he's in his mid-60s.
Horrible what?
Harbaugh.
The Harbaugh.
That's how we pronounce him in Philadelphia when he was our special teams coach.
Harbaugh. He's a young man. He's only 63.
No, he's not young. And the other coaches who went in the playoffs, average ages are 44.
So speaking of young, let's move on to Jamie Dimon. A young 69. The J.P. Morgan Chase chairman and CEO yesterday during an event at the U.S. Chamber of Commerce, joined by Carlyle chairman, co-chairman David Rubenstein, who of course has really made a career now as an interviewer. He asked Dimon, not only did he ask him how long he planned to remain in the job, take a listen because he offered a number and see if you think Jamie was joking in the answer.
The question you get asked every day, 5 times a day, is how much longer do you want to do this? And the answer is 5 more years?
Yeah, at least.
About 5 more years?
I love what I do. It's up to the board how long I do it. As long as I have the energy and the spit in the eye and the fire in the gut, yeah, I want to do it.
J.P. Morgan says he was joking.
Yeah, they said like he's joking, haha. Now what is that, haha?
Didn't sound like a joke.
I think.
By the way, we should point out, the only thing from the company is less than 5 years. So it could be 4 years, 11 months, and 29 days.
Okay, so what happens to Charlie Scharf from Wells Fargo? Disputed how bad the quarter was, maybe not bad. What do you do with the people in their 50s at J.P. Morgan? The people who built their whole career. They're in the 50s, and they thought they had a shot as CEO, and now they'll be too old when he retires in 5 years. That is not succession.
There'll be yet another generation.
You are not serious people.
Listen, a board's main role, as I've said, is to think about succession, number one.
Right.
And in this case, certainly they have been thinking about it and thinking about it and thinking about it, but basically the name they seem to come up with for succession is Jamie Dimon.
Well, I just think you have to understand that this isn't Warren Buffett, this is not Berkshire. There are people who are hoping to get the job. Now, do I want Jamie to be that? I think Jamie's the best banker.
He's had, what has it been, 18 years? More, maybe somewhere in there.
Do you know what the secret
of incredible success?
What the secret of Jamie Dimon is?
Tell me.
He knows your family. You say, look, how's your sister doing?
That sounds scary to me,
your
actually.
Your father's from the west side of Philly, isn't it? No, I mean, one of the things, he has a touch that no one else has, that I've ever seen. But the problem is, David, we do have a whole group of people who really want to have a shot, and then they have to go to Wells.
Yeah, although Charlie Sharp's not going anywhere either, is he?
Charlie's young.
Oh, Charlie's young,
Yeah,
because he's only, what, 60? But Harbaugh's old at 63.
The average coach is not that old. He's the eldest. He's one of the elders. How'd Pete Carroll do?
Really, we're going to get an ageism here? You know how old you're going to be?
Shut up. Okay, so anyway, I mean, Dave, why don't we talk enterprise software? How bad is that?
Anything to move on from your coming birthday?
I was told, thank you. You want ow? I want a paper cut.
Careful. That could be an end of you right there.
No. Okay,
you know, you don't
I
plot
do.
that well as you get older.
David, can we talk about what the younger people want to talk about?
Let's talk about that. Sure. What do you got?
Space technology.
Oh, yes.
They went to about Rocket Lab, upgraded by Morgan Stanley.
Okay.
And I just think that people, when you talk to people, whatever they want to do, they want to bet on some sort of political event. I don't know. Will Minnesota be taken over by martial law? How much is that? What's that? Is that a 5-to-1 shot? But they want to talk about rockets. They want to talk about the idea of space travel. And so I give them Rocket Lab and ASTS. I give them that.
Yep.
But what kind of value added can we give people when I think Elon Musk will dominate that whole
Right. Well, SpaceX is still a private company. Somewhat surprisingly, there has been a lot of reporting that SpaceX may come public even as soon as this year.
Can I have some? No, I'm not allowed to own stocks, but wow.
Which is amazing. Because, of course, it wouldn't seem to need to from the basis of having to raise money. So it's unclear exactly. Who knows? Maybe it would not even be a money rate. Maybe it would be one of those at-market kind of deals, you know. But that's, I don't know, I'm speculating. But you're right. SpaceX is the leader. Starlink, of course, is an incredible business for them.
Can Starlink bring down the government?
It's unclear. Apparently not.
Early.
Yeah, it may be early. We hope it's early when it comes to Iran. But
can it bring down a cable company?
Yes, and it has. And by the way, there's a name I would bring up when we talk about SpaceX, and that is EchoStar. SATS. Back
You
in the
saw
control
that
room.
thing because with your loan talk.
Well, Charlie Ergen ended up, you know, we doubted him in terms of playing poker, and then he had all those licenses, and he sold them, remember? And he sold them big, and it was AT&T, but it was also SpaceX, and he sold it not just for cash. The first one went, it was I think 17 billion, 8.5 billion in cash, and 8.5 billion in SpaceX stock, and then they did another deal where SpaceX stock, unclear what their percentage is, but I will tell you there are investors who would play SAS, EchoStar, in part as a way to play SpaceX in the same way you might buy SoftBank to get exposure to OpenAI. That said, it's a small percentage, but it's been a big help to EchoStar this year after, of course, the incredible move up last year on the sale of those licenses that many thought would just be taken by the government.
Now, what do you think about the idea that one of the biggest customers, top 5, is Musk for NVIDIA? What do you think of the possibility that he is going to win the self-driving car? What do you think about the possibility that this man is going to have the best robots? What do you think about the fact he's going to dominate communications? One person.
I think it's all possible. There are plenty of people who are investing in XAI with the expectation that Musk will do what he has done prior, which is win.
Right.
There are plenty of gating issues that can come up with an XAI that, you know, in terms of the competitive landscape that it faces. But I do hear, you know, maybe in the enterprise, maybe there's going to be new software solutions from XAI as well. We haven't really heard from the company there. We know it generally is just the owner of Grok with a K, the chatbot.
Right.
And a lot of controversy around that.
I
what it allows people to do. Yeah, I know you do tend
well,
to.
I mean, but he could leapfrog. But I just, for people at home, I want them to know that, you know, when you get off the desk, people talk about GOP-1s.
Yep.
And they talk about what is Musk going to do next, as if we have a great man theory, as if he's Rockefeller in 1910.
He's conceivably going to be I mean, he could be worth $1 trillion at some point. $1 trillion. It's not inconceivable that even could come in the next year or two, given SpaceX.
Right.
We'll keep an eye on Tesla, XAI.
This broad naked capitalism.
The numbers are, we can't really even conceive of it. But we'll see, and it's a reason why we certainly keep an eye on Musk. Haven't spoken to him in a while, though.
You got to get him on the phone because this is, I just think
Well, what am I going to ask him? Now, I mean, you know, you can sit down with the guy for hours and
jive talk with him. I don't, come on. I mean, you got the most powerful person on earth, arguably. Maybe it'll speak
Most
to
consequential businessman.
Most consequential.
Yeah. Can I talk a little Netflix and then Warner Brothers Discovery?
If you mention the data, we've got a lot of people cutting numbers on Netflix.
On Netflix?
Yeah, because of what you're about to talk about.
Ted Sarandos, I'm sorry, Ted. I mispronounce your name sometimes. Sarandos did give an interview to the New York Times. I point this out because Netflix stock is down about 14.5%, 15% since they announced the deal to acquire Warner Brothers. Kind of an interesting interview. A lot of it focused on the theatrical exhibition of movies. I pulled this out. We'll run that business, the movie business, largely like it is today with 45-day windows. I'm giving you a hard number. If we're going to be in the theatrical business, and we're competitive people, we want to win. I want to win opening weekend. I want to win box office. As for where things stand right now, of course, remember earlier in the week I reported along with others that in fact Netflix was going to likely, not 100%, but very likely change the composition of its current deal to acquire Warner Brothers and eliminate what is relatively small stock portion of it, replace it with cash, the effect of which would be to significantly accelerate the shareholder vote. I haven't heard from Netflix yet on this change. Expect to. And then you get a proxy much sooner, and you get a vote much sooner. I talked about this obviously at length the other day, but I did not talk about one aspect of it that may also be a reason why Netflix is doing it, which is if you had a shareholder vote, as let's call it, late as June, there was the possibility that Paramount would already, because it has a tender offer out there, it can do this, have gotten the approval under Hart-Scott-Rodino, HSR, antitrust. That would be seen at least as a benefit, even if that deal was still not one that was under contract. In this case, with a potential vote as soon as, let's call it mid-March, maybe a little later than that, but let's say mid to late March, unclear whether either company will have anything having to do with antitrust approval anywhere. And so that may also be a benefit in some way to Netflix. And then, Jim, where we stand, because I know where you come out, you're about to say to me, $34 gets it done for Paramount.
All right, that's what that was exactly.
They are going to have to, they're going to have to raise. They're going to have to figure this out. The timeline may be truncated in terms of a shareholder vote. Again, we've yet to get the official announcement from Netflix of this change we've been discussing. And they are going to, most likely, everything I hear indicates they know that. They can fight it out all they want. They can sue them in court. By the way, yesterday, we didn't report on these headlines, but the judge said no in terms of accelerating any review of their lawsuit. Warner Brothers shareholders need the information on the evaluation of the global network stub equity. This was Paramount, sorry, saying that.
Do you know when the...
But Warner Brothers said they're pleased the Delaware court agreed with their belief and rejected the notion that this lawsuit needed special treatment and may have other serious flaws. So Paramount there putting the pressure on, but failing to get the Delaware court to move with any expeditious way. They are also putting the pressure on in Europe, already trying to sort of galvanize regulators there against the Netflix deal. I've been hearing that. They've been very aggressive, but ultimately they're going to have to raise their bid and agree, it would seem, to many of these provisions that that Warner Brothers has objected to. Make it clear on the $2.8 billion break fee. Make it clear on the $1.5 billion bridge loan, and ultimately make it clear in terms of the covenants that Warner Brothers says would shackle it during the period of time the review would take place and hurt its business. Well, not to mention raise the number.
No, that's what I want to ask is, everything you said is perfect, and I totally agree. But what's the president's view on it?
You know, interestingly, I don't know. In the interview with the Times, Sarandos says that he's spoken to the president a couple times since the election, and he thinks he's going to view it positively because it will be a job creator, or certainly not destroying any jobs.
In the United States.
Correct, which is what you imagine they care about. And then the question is, if the Europeans try to oppose it, does Trump in some way intervene also and threaten them?
Yeah, let's swap Greenland, Netflix. Greenland, that's a Mercator projector, it's not that big. It's a Mercator projector problem. Remember that from 5th grade?
Got it, Mercator projector. Hey, Meta's up.
Get out of town.
Yeah.
It's all right. Well, good. Because there's power gating. I wish Mark would come on. I mean, that whole project. Remember he was comparing it to the city, the size of the city?
Yes, of course, they put the map of the Hyperion over Manhattan.
It's just okay.
Very big. All right, let's give you a bond report before we head to a quick break. Check out how Treasuries, of course, are faring this morning. There it is. 10-year, 4.189. We've been hanging right around there. You heard Rick talking earlier in terms of spread to corporates, in terms of it being very narrow. In fact, I think he said we've got to go back to 07 for spreads that narrow. We're back right with this.
I'm here. Oh, look right where we pulled to. Right to support. 3 different times. 4. Do or die. It's do or die. What way should I go?
Take a look at the top gainers this week. Led by AMD, Jim. Look at that move. Up 15%.
Beneficiary of the shortage.
They are.
Yeah, all those are well, I mean, the biggest winners are, you can say, Lam Research, Applied Materials, and KLA. They make the machines that could alleviate the shortage.
We're back right to this.
Yeah.
Oak.
All right, and the time we have left, you know, we haven't gotten the software. We've been talking about it every day. Salesforce is a name closely associated with you, Jim, because you know the company so well. It's just in free fall.
Well, look, a lot of people just feel that this seat method, charging by the seat, that's not the way it does the agentics, is being compressed, that a lot of the people who would use Salesforce product are not needed because you can now recreate this. This is the Adobe problem. This is the, some people say the ServiceNow problem. And it shouldn't be in free fall. Well, here's what I would say. Do you have Ben Righteous from Mellius one?
I don't know if we have him on today.
Okay, so he'll talk about the compression of the multiple because of the possible shrinking of the business. Now, of course, Mark Benioff is not saying that. He's saying...
And he wrote this about the other day.
Yeah, and you know, Mark is saying, listen, the agentics business is so strong and stock is very strong and there's no degradation. There is degradation to Adobe, and by the way, Apple put out a very competitive product to Firefly the other day, I think. I may have to cancel my subscription, but ServiceNow is going to report soon. A lot of people feel that they're seeing it. Mark is not seeing it, but it doesn't matter. No one believes. And
no one believes.
No one believes.
All right, my friend.
It was a good show.
Have a relaxing weekend. Will you try and do that for me, please?
No, my wife had
See you on
knee
that.
surgery. Now she's got the new knee. I'm just going to hand and foot up the
Just take good care of me.
I will. That's something I'm going to do. I am Oxy.
There you
I am. Oxy to me is a company that's merged with Devon. Okay.
Home Builder Sentiment Data is going to be right after the break.
Was I too tough for Sanjay? I thought I was okay.
You were not tough at all.
Okay, thank you.
Alrighty. Oh. Oh, look at, oh my gosh. We're right here now. Seriously. Watch it. Spy. This is let me see what this is. This is a real good spot. I'm excited about this spot. Five-day, 1 minute. So that was after hours low.
Good Friday morning. Welcome to Squawk on the Street.
After
I'm
hours
Sarah.
low.
I'm David Faber. We are live as always from Post 9 of the New York Stock Exchange. Carl has the morning off. Today, a can't-miss interview with three principal players from the Trump administration working on auto affordability right now. Transportation Secretary Sean Duffy, EPA Administrator Lee Zeldin, and U.S. Trade Representative Jameson Greer. Plus, software stocks wrapping up a rough week of trading as fears grow about the impact of AI on their legacy business. We'll talk to an analyst who says he hasn't seen investor sentiment this negative on software in a decade.
First of all, let's get some housing data just crossing, and Rick Santelli has it for us. Rick.
Yesterday, this is the National Association of Home Builders Housing Market Index. Above 50, things are pretty good. Below 50, things are less good, maybe on the poor side. This number comes in below 40, 37. 37, we were expecting 40. In the rearview mirror, we have 39. 37 will equal where we were in October of last year. To find a lower number, you'd have to go to September when it was 32. In addition, this is the 21st number that has a thumbs down, under 50. 21st, obviously that means all last year didn't have anything above 50. The last above 50 was May and April of 2024. So in 2025, nothing above 50. When was the last time we had that? 2012. So hopefully 2026 will be a better year.
Lotto, 6.
Being a January number, we're
92's at 118.
very strong. Sarah, back to you.
Okay, thank you, Rick. Rick Santelli.
The 692's at 118.
Affordability. On Wall Street, at the White House, we know that the president has been rolling out all sorts of initiatives to try to address high housing prices, for instance. We know that there's more coming in Davos. They've teased next week in his big speech around 401ks, perhaps more around housing. One area that I think we should zoom in on, haven't heard as much about it, but I think the White House should pay attention
Sarah.
to the food at home, what people are paying at the grocery on inflation. Yes, we got an overall CPI number this week that was pretty benign for December. It was less than expected, but
Blah, blah, blah,
food, as you
blah.
can see the little tick up, the gap there is because the government shut down. We didn't get data then, but it's going up. And we had a 2.4% increase from the prior year. We got a
She's so full of shit.
7% increase from the prior month on food inflation. And that was the highest we've seen in a while. It was because of a number of different categories.
Jims and
Cereal,
Co's.
bakery products were up. Meat, poultry, fish, and eggs up 4%. That was a really big jump on December for the year. This is year-over-year numbers. Dairy was the one weak spot, but fruits and vegetables,
Okay.
non-alcoholic beverages, all food at home.
You know what?
It was the highest monthly increase
Blah,
overall
blah.
since 2020.
Goodbye.
Side. But right now, once again, that print kind of signifies the fact.
God. Okay, we're at 145. This is what I do. I make business decisions. I don't know how he does it, but I was sitting here eating my oatmeal with Ethel, and they said, Ethel, I told Ethel, don't look. It looks like Jim got that snake again. Now, this was off yesterday's after hours low. So jot that down in your notes. Yesterday's after hours low. Jim, I can barely count to 2. Now I can count to 3. I'm 39. Come on, man. Shit. Consolidating off of a tweezer top with 2 good-sized bullish candles. The 692s are now at 141. I mean, you can make a business decision. I want to see if I can get up here to the VWAP on the SPY. And also, I'm in this. Oh, I am in the SPY. Well, how in the hell? I thought it was, look at that perfect spot for the SPX. Oh my God. Oh. Jim, you dumbass. You should have been watching the SPX. We're now at 148. I think we can make a business decision and be happy here, can't we? 154. To the 21. To the 21. I can't believe we did it. Jim, you're above the 9. Yesterday you were talking about being above the 9 and being bullish. But we're not above the 9's not above the 21. Now we're at 160. So I'm up $400. Now I'm ready to go to the beach. Now we're above the 21. That was kind of funny. Beautiful. I don't know how he does it, but he does it the way she likes it. I don't know how she does it, but she does it the way she likes it. Tesla's pulled back. We got a flag on AMD. And we got a new high on Meta. We're now at 160. Should I make a business decision? Wouldn't it be nice if we just had one big old little bounce right here? You know what I'm saying? Give me 175. Uh-oh. Hey, Jim. That was a good call. I'm not sure how you do it. Not sure how he does it. 162. Vouchers. Uh-oh. My coffee's ready. Yes, he did. I never whispered until Brandon got into the scene. Now I know how important for a badass to get his point across. Do you understand? This is America. Be glad you're proud you live in America. I'm gonna go get my coffee, because I can do that in America. Woo! Oh, that's a good one, Jim. Okie dokie. I told you I would be in there in a bit. Can't you see I'm trying to celebrate here? Them me. Oh God. Room, forgive me, but I must leave for a second. I have a problem with Nancy in the kitchen. She's about to blow her top. Do it one more time and I'm going in there. And it's not going to be pleasant. Oh, you just... Excuse me for a second. I need to take care of some business.
Week high after earnings. Fourth quarter revenue pulling back slightly year over year due to lower intermodal and truckload sales. The company also pointed to a fragile freight market for 2026. We are trading just below the line at the moment, to give you time. All right, let's take a look at the winners of the session and surprises with some of the chip stocks that are flying high today, particularly in the memory space. We've got Micron up almost 7% in trade, Super Micro up at 9%. Moderna up at 7.5%, and GE Vernova also is up off the back of some announcements coming from the Trump administration around power demand, reliability and affordability. And we have Constellation Energy heading in the other direction, down almost 8% in trade this morning. Vistra is also down 7%. That's in the business of power and electricity, of course, as well. Albemarle, in the business of lithium, down almost 6%, and Amcor down 4.5% as we stand. So there's the winners of the losers on the session. Joining us now is Daniel Yu, who's the CEO of Republic Technologies, and joining me here on the floor of the New York Stock Exchange this morning. Thanks for joining me. Happy Friday.
Happy Friday. Thanks for having me, Sam. Excited to be here.
Nice to have you. Let's just talk about, how you're thinking about the overall sort of liquidity in the market right now. Obviously, we've had the end of QT, we've had this sort of mini QE coming to the Fed. What are you thinking about right now?
Yeah, I mean, for us, I think one way that we're not very different from everyone else is we are looking at these two main factors for, liquidity shifts. Obviously, just to restate, we have the end of QT, like you mentioned, as well as multiple rate cuts expected this year. And so generally, when we've seen this is good for all risk-on assets, right? And so Bitcoin, Ethereum, all digital assets are no exception. And what we see specifically for Ethereum is, given all of the various developments over the past year and a half, I'm sure we'll talk about many coming up, but we see that there should be a big wave, and we think that Ethereum has a very strong chance to outperform the others, and just given the amount of liquidity coming in and its relative size to the blockchain.
There were brief bouts of outperformance for Ethereum, I remember over the summer. I'm just wondering, you talk about this year being another good year potentially. What's the story for Ethereum this year? You talk about some of the, I guess, legislative tailwinds that we've got for the space, obviously a lot more sort of mainstream adoption, institutional appetite as well. What's going to be the biggest sort of catalyst to drive that?
Yeah, I think for Ethereum, really, there's so many things going on. The target from last year, we had stable coin kind of like 2021 Bitcoin moment, people starting to pile in. We went from about a year and a half ago with no banks recognizing these assets kind of as an alternative asset class and giving them any type of credit, to now there's around maybe 9 of the top 10 banks around the world are looking into building stablecoins on the Ethereum blockchain. And so this is something that's across the board industry agnostic. When you go talk to accountants, some from the Big Four, tech companies all have very decisively selected Ethereum. In most cases, it's very much a no-brainer for them because it is the longest-standing blockchain, never been down. It's been around for 10 years. Fees coming down, so all these benefits we see as potential tailwinds.
Right. The Clarity Act, I mean, it hit a bit of a snag yesterday. How much are you looking at that, as far as creating that sort of legal framework and also just giving the industry as a whole that clarity, as it says in the name, moving forward, as part of this whole industry and space of evolution?
Yeah, I think, in general, I would say that these types of regulations are good. Clarity is what's needed in the industry. We've been waiting for that for almost a decade for some of us. And with that said, however, I would say that looking at Microsoft's comments about why they pulled out and it's causing the delay that we're seeing now, it does make sense. I think that, at least for them, the biggest concern was how institutions or perhaps retail can choose to earn yield from stablecoins. They're saying that in the Clarity Act, particularly, won't get too specific, but they want to limit which organizations are able to provide this type of yield. Obviously, USDC
/ES seems like a good spot.
And so I think while no one expected, at least I didn't expect this to pass in the first go around, I think the feedback is good and we should expect some more clarity later this year.
Yeah, I mean, the CEO of Coinbase, Armstrong, has been very explicit in the pushback as
Well, back in 1923, there was a guy named Jim. He felt like it was proper to put a washboard in front of it. I'm watching this here snake. We got a snake breakout, pull back. So I'm watching it. $692 is now at 121. Cold. Okay. Get it together. Looks like we're pulling back to support again here. Double bottom. There's that $1. The 692s were at $1. I just missed it. They're at 108, 106. I want to see if I can get $1 with my rewards. Oh, Commerce Bank. What the hell is that for? Boost your savings. Social Security. God, I feel old. I'm gonna have to have some counseling. The law generally affects individuals with okay, what's this mean? Important. The Medicare law requires higher income persons to pay higher premiums. The law applies to premiums for Medicare Part B, medical insurance, prescription drug coverage, Medicare Part B, immunosuppression drug coverage. The law generally affects individuals with incomes higher than 109 grand, and couples with incomes higher than 218 grand. We will contact. Ooh. They're going to contact the IRS. God, that's all I needed to know. Oh. We will contact the Internal Revenue Service to get the information about your letter explaining your decision. My letter explaining, our decision. Oh. Jim, you'll be having to pay $500 a month for your frickin' insurance. If you get a representative. Oh, God. Okay. I can only take so much bad news in one day. Look at that double bottom go. We're at 135. Hello. Not again. Not again. Uh-oh. This is only the spy. Ladies and gentlemen, I sat here and sung a song about the double bottom. Well, not really, but once I saw the double bottom, I had to put it up. Now, I'm telling you right now, bingo. The 692s. There's a guy at the bar. They call it double bottom. It's not a drink, it's a stock chart pattern. So I jumped in the 692s and I took it up and sold my second scalp. I think we found us a bottom. If you can count to 3, you can trade with me. 1, 2, 3. Whoa! Look at there, already back down again. So we got snake breakout, pulled back, double bottom, tweezer bottom, up to the 63, took a break. All of a sudden we get another big knife, and we were at 106, paper trade. I jumped in, paper trade at 106. I didn't have a fast thought. That's not a very good one. I didn't have a fast thought. It wasn't fast enough to make the trade. If it drops down 106, I might jump in it again. We had 108. Damn it. Make sure you have the right amount of contracts you need in your... One time I came in here and I bought 100 and I said, oh my God. It went up 10 cents and I immediately sold it. I said, damn. Well, it didn't pull back to the triple bottom, but it had a higher low. We've had engulfing red candle. Give it a minute. Give it a minute. So I'm going to give it another minute here, just in case we come down below this one right here, because that'd make three rows. Look for like what am I trying to say here? Sequences, but look for patterns, but I just think we have possibility of coming down here, hitting a little bit below this here for a buy, and I'm going to show you how I figure that out. It's not much. About 602. So 601. What is that? 601? 60? $57. Get ready. Get ready. We have a triple bottom. If you can count to 3, you can trade with me. Brandy. Okay, here we go. The crowd's going wild here at 95 cents. This might be a little bit risky. Oh, I should go into, well, this will be my last trade if I can get it to bounce. I should start looking at tomorrow. Too late now. SPY. I want to start scalping Monday. And we're closed Monday. Short week. That might be another reason why we don't need a breakout, because you don't know what's going to happen with Iran this weekend. .98. Thought I had 97. Here we go again, another lotto. Well, there's this guy that lived near the lake. He had a pet. He called the sneaky snake. He's teaching kindergarten class. He says, is there anybody in here that can count to 3? Well, Magnificent stood up for the first time and said, Jim, I can, and I'll be glad to do it. We're going to count to 3. Don't forget it's a falling wedge. It is a falling wedge. Barely. See, if it was a little bit more higher, it'd be descending. And we wouldn't want to see that. No, not here. Okay. Right now he's at 98 cents. Jim's not looking too good in this here trade, so I just don't feel like I need to be adding on to a lot of trades today. So I got to be right. Ooh, Marley. Damn, you look hot. Whoa! Take my mind. Got baby. Okay, today she gets. Let me see if she has a freckle down there. She got kind of a little freckle right here. Could be as, oh, we're at 85. This is not good. This is not good. Now I'm down to 100. Oh. Well, 140 bucks. This really sucks. Should I sell? Give this more candle just a minute. Yeah, this ain't gonna work. It's not looking good at all. So that should have held. And we're below yesterday. Oh, we're below yesterday's close low. Before we had to pop into close. How's PLTR do today? Oh, slash ES just had another pullback. Man. It's ain't right. See, it's closer to a descending triangle than it is to a fallen wedge. So I have to, I can't, I have to give myself a C minus. Because I did recognize it, but I didn't. I had a chance to get out of it and didn't do it. Well, I'm stuck. President Trump praises Fed contender Hassett. We're at 72. I think yesterday we took 2 trades off that big long-legged hammers. Okay, Jim, what are you going to do? Well, I think I'm going to have to sell. I'm going to give it just a little bit more time. Come back. So I haven't had it on, and I don't know if I want to. I gotta get back to 691.50 before I'm probably even. Oh, 66. Well, I'm down at the bottom of the pit. Come on. Next. Yeah. Ooh, Amazon in 87. Google. TSM green. I'm at 72. I'm holding on. PLTR. Did I do PayPal the other day? Chart. What? SPX looks nasty. Slash ES. Oh, I need to call my accountant. Get my taxes ready. More lows. AMD didn't break out. We got NVIDIA at new low. And big drop on Meta after that. It was up there at that high. Just a bit ago. Oh, it's about lunchtime. Put my guitar up. Pretty little pullback. Didn't want to hold the triple bottom, that's for sure. I think I just picked up on a mistake. Yeah, I should have looked at the SPX. Well, Oh, I know. I need to go out and do my. Oh, I need my license too. Do that Monday, Tuesday. What did I count? Time to move up. Uh-oh. We're now at 67. Let's go. Don't stop.
Yeah, I mean, that's certainly been the consensus. I mean, particularly around both of these
68.
companies. I mean, operationally, it looks like many people do believe that Uber is performing pretty well here. I'm just wondering, when you think about autonomous and then that long-term picture, I mean, how are both of these companies positioned for that Uber and Lyft?
There's a lot of things that still need to be figured out. I mean, there's a school of thought that the technology of autonomous driving will be commoditized, it will be everywhere, and OEMs and private equity firms and others will put autonomous vehicles on third-party platforms, just like Uber and Lyft. And there's a school of thought that technology is the differentiator, and that there's a scale dynamic here that leads to dominance by a few companies. So in this market, you end up with Waymo and Tesla really dominating that market, extracting volume off of these services, and becoming cannibalistic to volume growth. And that's more the camp that we reside in right now, but it's early days. I mean, Waymo's in 5 markets now, going to be in 17 by the end of 2026. Tesla's in 2, but they're not functioning in any, without a safety monitor quite yet.
Okay. So obviously we're watching to see how these companies are obviously going to be trying to convince the market of how they're playing the long game here, particularly around the autonomous vehicles, etc., and particularly when it comes to technology. But just as we stand here and now, I mean, how do they compare, particularly when you look at Uber? I mean, how do you think about some of the areas that are driving growth, particularly around, the ride-hailing and Uber Eats?
So the health of the economy is a big driver, travel is a big driver, so to the extent that GDP continues to show the strength that it has and the travel industry holds up, mobility should be strong. So for the industry, we're looking at low double-digit growth, and because the 2 companies, at least in the U.S. market, are acting more as a duopoly, these days margins are expanding as well. So Uber has margins in the low to mid-teens in terms of EBITDA margin, and lifting the upper single digits. So if you're into the kind of narrative there, they likely both be screen buys. The question that I think still needs to be resolved is just how autonomous plays out. And so I think you're going to see, just like the stock chart that we showed over the last 12 months, moves up and down based on where sentiment is at any given time around those topics.
So what's the next catalyst then? I mean, what are you going to hear from these companies in order for you to sort of change your thinking around this becoming a screening buy?
So Uber's announced a few interesting partnerships, Stellantis in coordination with NVIDIA and Lucid and Neuro, but those haven't made it to market yet. So seeing how this kind of commoditization theory commercializes and whether it does or not would be something that would change our view. And then secondly, to the extent that Waymo and most notably Tesla, just take longer than anticipated to attain regulatory approvals and frankly scale their businesses, the longer that it takes, even if one is negative on the long-term implications, the better it is for ride-share industry. So I think those are the things to pay attention to as an investor.
Right, okay, we'll be paying attention to that. So thank you so much for joining us today, Scott, and getting us across your thoughts on the rideshare space today. Really appreciate it. Have a great long weekend. Scott Depp, Managing Director of Equity Research, Wedbush Securities. Let's trade it now with the host of Fast Market, Tom White. So an example trade for us this morning for Uber, Tom. What are you doing there? What's the approach?
Well, I kind of took that approach that Scott kind of mentioned. They're relatively neutral on the stock. So they reported earnings at the beginning of February. So I looked at a strategy that kind of avoids that, right? There'll probably be some additional volatility, potential for big movements or big swings to the upside or downside. So I looked at a neutral strategy, and I went out to the January 30th, the weekly cycle. So just 2 weeks to expiration. We're looking for a little bit more consolidation in this name over the next 14 days or so. So we're going to sell the at-the-money 83 strike call and put in the January 30th weekly cycle. So you're selling a straddle there, or straddle, excuse me. And then against it, because I want to say risk defined, we're going to buy the out-of-the-money 78 strike put. And then on the upside, on the call side, we're going to buy the 88 strike call. So this is a short $5 wide neutral iron condor. We sometimes refer to this as a short iron butterfly because you're selling that same common strike, the 83, on the call and the put. On this short iron butterfly, we're going to collect a credit of roughly about $3.30. That's what you could potentially make if the stock kind of settles in around this 83 level over the next 2 weeks. Now, if I collect that $3.30 credit, that means I got about $170 in risk either way, right? And that would be above 88 on the upside or below 78 on the downside. So that's where you don't want it to go. Now, if I collect that $3.30 credit, where are my break-evens? Well, I need the stock to remain between about 79.70 on the downside and about 86.30 on the upside to be profitable on this trade. It's positive time decay or theta, which means as every day goes by until expiration over the next 2 weeks, the option premium will come out of this strategy.
79 cents. We're at the resistance. One of them.
You just want this consolidation that we've seen in Uber over the last couple of weeks to continue.
On the SPX.
And earnings on this trade also. So the idea is you sell it for $3.30, it continues to go down, and maybe in about a week and a half, it goes down to $1.50 or $1 because you're going to have some assignment risk either way. Where you can buy it back a little bit cheaper. But this just takes advantage of positive theta in this type of trade with a consolidation needed for this to work out.
All right, well, thanks so much for that. Tom White, I'll check in with you a little bit later on fast to the market. Thank you. I'm going to wrap up here. Thanks so much for joining us here for Morning Trade Live. I'm Sam Vardas. Download the Schwab Network app available in the Apple Store and tune in 24/7 on Schwab Network.com. We've got Trading 360 with Molly up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Look.
Welcome to Schwab Network, where real-time
84 cents.
expert strategy from the opening bell to the
This is a good spot right here. But now we broke that up. Oh, I'm in the SPY, but the SPX, if you're in that, you still got a ways to run maybe. SPY, we could hit the top of the channel, which is under the VWAP, if we break the 63 right here. So, I mean, it's an exit idea. Hello? Jim? I'm Annie Mae. I'm the one that lives about 3 stories upstairs and keep dropping little flowers in front of your window. Well, we hit the 63 EMA right here, mister. Should I go ahead and hold it and see if I can get a few more cents out of it and come close to the VWAP? Or should I go ahead and take profit now? Well, you know the 63 has always been a good exit idea. Or scale out of some proportion. Leave a couple on your plate. And if it does start to pull back, get out of all of them. If not, you could add on, but I would probably, well, you know, it looks pretty bullish. We're at 90 cents. I think I'm going to chicken out here real soon. Okay. 60 cents and 98 cents. Come on, baby, we're done. Let me tell you something, you don't mess around with me. $65, excuse me. Oh, there it is. I'm here. Jake Paul, I'm here. Out at that resistance line that I drew up, 1, 2, 3 bits. 102. Woo! How's he do it? You know, I mean, it looked like we were just going to go to hell there, and it just kept dropping and dropping and dropping. And Jimmy says, "I'm staying in it." And then he gets the balls and he buys the dip off the tweezer bottom. Okay, dokie. He's one class act. So I became old the day that I got Medicare. I felt like an old man. I'm gonna write a song about this. I think I got it down. I just now thought about it. Well, I've smoked a little bit too much pot to be thinking about Medicare. I got too much on my mind. I don't even care. So they take a couple hundred out of my check, out of my Social Security. All I got left is you, babe. I'm getting old, thinking about Medicare. I don't care. No, I don't care. Whoa. Okay. I got that off my chest. Damn, that guy's got talent. Looks to me like we got a small cup and handle here on Tesla. Randy's at the Tooth Fairy. Oh. Randy! Make sure you get enough Demerol for us. I've been to the dentist too long. I got one tooth left. I'm about toothless. I don't care. When I get my Medicare, I hope it pays for my new teeth. Okay. What a beautiful rebound. I called it. Look at that, beautiful. Now, can you, I'm going to put a chart in the room. I'm going to ask one question. Can you see a chart pattern? I don't know, Jim. That might be too difficult. Okay, here it comes. Get ready. Randy's here. Did you get us some dilantin or Demerol for us? Okay, the question is, can you see a pattern? Pattern. It's a simple question with a simple answer. Let's see, here's the first one. Cup and handle is wrong. Triple top is wrong. But there is a triple top there. I should have been more clear about the question. Do you see the pattern that would cause a reversal? Do you see a pattern that causes a reversal? Like when the wind blows up Miss Clark's dress. Correct. It is an inverse head and shoulders. For that you're forgiven. I'm just trying to teach class a little, help them out a little bit here. This thing just dropped down a little bit. Did you see that and what it bounced off of? Can anybody tell me what that is? Room, you've got 5 seconds. Can you tell me what pattern that is? 1. 2. 3. 4. We're at 119. 5. It's an inverse head shoulders. That's what I like. Take the start, natural hike. We're almost at the 200 right now. Nope, I don't want to cancel that. Just put that down. Oh! Oh my God. How does he do it? So anybody that's new, YouTubers or room people, left shoulder, right shoulder. Now you'll hear me say, you say you jumped in at the left shoulder. You'll hear me say, okay, it broke out, wait. If you didn't jump in, wait for it to pull back and hit that left shoulder one more time. But in this case, that you were at least in that initial run, which is not very big. I mean, you could always add on, like when it retested here at the 21. There's your 9 crossing over the 21. 127. Beautiful. Oak. Okay. Right. Well, that ain't too bad. Yeah. So beautiful.
Iconic trading floor in the world.
Oh.
This is Opening Bell with Nicole Petalides.
Nicole.
Live on the floor of the New York Stock Exchange. The countdown.
Nicole.
The stories that make markets move. Minute by minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time.
Yeah.
Opening Bell live at the NYSE right when it counts.
Believe me, when it comes to investing,
She's right.
I love Carl's Way. Take a left here, please. But there's a Carl's Way is the best way.
Carl's Way's better way, though.
At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
This, I think this was hard how they did him here.
I'll get out here.
Where are you going?
Schwab.
Son of a bitch.
Modern approach to wealth management.
We went to the VWAP.
Welcome back to Trading 360. I'm Marley Caden. It's time for the big three. We've got
Marley!
3 charts and 3 trades. Rick Ducat will take us through the charts as
What are
always,
they?
here to take us
through the trades
You ready?
is Tim Bowen, Chief Technical Trainer at stocks2trade.com. Great to have you both with us. Tim, I'm watching the board. We were entirely in the green 2 minutes ago. Now we've got a bit of a mixed picture, a little bit of seesawing around the unchanged line this morning. But I'd love to get your thoughts, and also where are you joining us from today?
Actually, Northern Michigan, Point Resorts, got some ski activity behind us, but yeah, so beautiful. We're supposed to get almost like a foot of snow, so should be good on the slopes. But back to the markets, you know, the biggest sectors that I'm the most bullish, you know, kind of a lot of these are those repeat themes, etc. But you know, if you recall, 2 weeks ago, I talked about that drill baby drill, energy boom. And gave out ExxonMobil as an idea.
Oh, you did?
It's kind of crazy how the chart kind of predicted the Venezuela situation. That happened, you know, I was on Friday. That happened over the weekend.
Damn, you got lucky, didn't you?
Oil and gas and energy plays pop off. And then, you know, we also had that news of, you know, Trump's talking about making the AI companies pay for the energy expansion, which I agree. Like, that's a huge thing. And then I just really still love all of these military, aerospace, you know, a lot of the stuff that Anduril is doing, Palantir is doing, big Palmer Luckey fan. You look at the Delta Force raid, well done Delta Force. You know, it sounds like they had a lot of these like heads up, like advanced technology, drones, etc. And then the last sector that I'm most bullish about is all of these things around the SpaceX IPO, and space exploration, nuclear reactors in space, AI data centers in space. And one of the things that makes me most excited is, you know, I grew up in the 70s and 80s, and, you know, we were always supposed to have moon bases and flying cars by the year 2000. That never happened. I thought that I was going to fall into that quote that, you know, I thought I was going to be one of the middle children of history. Born too late to explore the Earth, and born too early to explore the stars, but it looks like that's going to change. We've got that second space race, and obviously I've got Rocket Labs as an idea. But going back to your previous guest, he was awesome. I mean, there's just so much to be bullish about right now that doesn't mean be irrational. That doesn't mean just throw money at anything. But I think that going into the midterms, 2026, we can look back as one of the most biggest, you know, most bullish markets in my 22 years of trading.
All right, that's quite a setup you just laid out for us, Tim. Incredible overview there. So let's jump into your first one here. Intel has arguably had a really good start to the year. I think they're up like close to 30% just in 2026. Under a little bit of pressure today, but so is part of the market right now. You'll walk us through this pick.
Yeah, so this was an idea that I shared, you know, on the Big Three last fall when the U.S. government took a stake. You know, I'm very open about how much I love the idea of onshoring, you know, bringing manufacturing back to the U.S. I grew up in the Midwest, grew up in Michigan. I saw the exodus of the, you know, of the auto industry. Should have never left. And one of the biggest things that had bugged me for years is all of this discussion of, you know, these semiconductors can't be built in the U.S. And I was always like, they can't or they don't want to. And when, you know, via the U.S. government took that stake in Intel, loved the stock back then. You could pretty much see on the chart when that happened. And, you know, I think that this story is just going to continue to play out. Nothing has really happened yet. It's not like they're doing a ton in the U.S. yet. But love the chart, love the idea, and just a long-term American company bringing jobs and manufacturing back to the U.S. in semiconductor.
All right, Rick. So as we look at the tech,
which we need for everything.
Yes, we certainly do, and that case keeps getting made every time we get more earnings here. But as we look at the technical setup here for Intel, you know, do you love the chart? I see we've got an upward sloping channel, but we do have some movement, some volatile movement in that channel.
Certainly a strong push to the upside here. Already very strong even after the government announced its stake in Intel. Obviously, this is the point where that happened here. Up like, 90-some% since that point here. So perhaps a bit of a cool off during these past couple sessions here, but remaining above many important prior resistance areas that now stand out as support. For example, 44 right here, an old high point, that could be one area that we do see price retreat to potentially for the bulls to regroup. It's a common situation in trading that after a breakout, after the initial wave of exuberance dies down, prices fall back somewhat and to an old area of price importance and then continue in the trend. Certainly not a prediction, just a common situation that happens here. Also 42, another old high, and here, this level 36, which was a repeated series of low points and then high points after that. So when we do look at our moving average studies here, we have a pretty good distance between most of our moving average and the current price activity here, but our weekly 5-day EMA is roughly where we bottomed out today. That comes in around 46.84 currently, so this could be a short-term supportive area to be on the lookout for. If we do start to fall below this level, it could be a sign of a potential shorter-term trend shift.
Intel.
The shorter term the moving average, the less reliable it is and the more prone it is to fake out, so everything must be taken with a grain of salt in this situation here. So now we can see a bit of a slowdown in momentum as well. For our RSI study, we can see that we have fallen out of the overbought area and broken through our green trend line here, but not really a big collapse or anything yet, not really making new relative lows on the RSI either. So a bit of a question mark at this point. Will the bulls regroup and move further higher, or is this, perhaps the start of a bit of a consolidative phase or downturn? Not really a whole lot of significant volume. I guess the tiny little pocket right here is as best you can do close to current prices, near 48, but the standout levels are here and here, which are roughly 40 and 36, 37 around those general points. Notice as well, very heavy volume recently. Volume spikes above the 50-day average stand out at these elevated levels. It shows conviction.
Yeah, and for Intel today, down about 2% at 47.34 right now, but a really impressive start to 2026. This next company also has had an impressive start to the year, a really impressive last month, just up more than 30% in the last month. We're talking about rocket companies here, mortgages, obviously getting a boost off of some of the potential policy changes and lower rates here. Is that part of this play, Tim?
Yeah, excuse me. It's kind of funny, I went on that 5-minute monologue about how bullish I am space, and then I bring a stock that's a mortgage company but has rocket in the name. But anyway, Rocket Labs, Michigan company, really like this name. Like you said, very strong chart, and really, Marley, you kind of gave my whole thesis on this. It's just, the unbuying of the housing market, rates dropping. Looks like Trump's going to get his new Fed chairman installed that's going to, do what he wants to push rates lower. I think we'll just see a lot of refis, a lot of activity in the mortgage market, and based on the chart and that thesis, I think Rocket Labs is a solid idea.
All right, Rick, so as we look at the technical setup for Rocket Labs and we see that they've rocketed a bit to the upside recently, what's the setup here?
Well, Tim kind of mentioned that he brings similar setups often here, which, that can be a good thing here because what we have is a consistent breakout above price activity. This doesn't have to be rocket science. I was going there, sorry. But, we just look for the breakouts, obviously. So a similar theme here is we see a repeated area of resistance, then price broke above it, and we haven't even really retested that area just yet here. Now, the closest area to be on the lookout for would be this very small gap here, 22, or perhaps even closer here, these levels that we encountered near about 23.50. It gets harder and harder to do this with any kind of, conviction when you have such little time that has been spent in these areas. These are very fast-moving prices. These are just general points that you may be interested in if you're looking for potential support. But as we said, upside breakout, pushing higher here, making new intraday highs today, but backing off a little bit from that point here, still within the boundaries of our white channel sloping upward here. Momentum still quite strong, 75.5. We are a little bit below our previous peak on the RSI though, so a tiny bit of potential bearish divergence here, but really look for the crossover back below 70 and for the trend line to break in tandem with a price breakdown as well. That would be more of the bearish ominous sign here. For now, it's perhaps just a temporary pause. volume is the heaviest here at around 17, then also here near 19, and finally up here near 23, there's another pocket here, so that could be another short-term supportive area to consider.
All right, as we look at rocket companies, they are trading up 1.5% right now. But your next pick also rocket, but this one really in the space here. We're talking about Rocket Lab, and Rocket Lab, as I'm taking a look at them, new all-time high today, trading up more than 6%.
Yeah, so this is that idea, I think I know it was last week, and it's kind of following that old trading quote of if it does no wrong, you stay long. I think I'm pretty sure I shared this back last fall as well. And what I really like about it, I liked it back then, just as kind of one of those companies that is actually doing things in the space sector. There's a lot of hype around that right now. But then you add in the SpaceX IPO, and as soon as the SpaceX IPO was announced, a month or so ago, I just had countless people like, how do I get in? How do I get in? And what I recommended back then was to use Rocket Labs as a proxy until SpaceX goes public, and it's basically that chart is following the space hype.
RKLB.
So just again, as I mentioned, excuse me, if it does go wrong, you stay long, and until this chart pulls back hard, I would just continue to ride that momentum into the IPO.
We could probably go so far as to say this one's skyrocketing. Sorry, the puns are writing themselves. You did this to us to begin with today. Now, as we look at the chart here in the technical setup, obviously another significant move to the upside here. But what is it showing us as potential movements going forward?
Yeah, upward channel type shape here, and again, similar setup here. We had a strong breakout to the upside. This is a really good example of what I was trying to explain earlier, where we had this old peak area here near about 69. Then you can see that we had several strong pushes to the upside. We had this type of behavior here. You can see after the strong push, a brief period of sideways to downward consolidation in these cases here. The bull flag,
Well, that's one heck of a run.
Where we retreat back to prior resistance, which then becomes support, and then the trend continues. You can see it played out multiple times here during our rally here. Even here, kind of more of a pennant type shape where it was triangular rather than a channel here. But now, again, even more new highs, potentially pushing above this rather steep upward channel already. Stopping short just shy of the 100 level though. So interesting if we do breach that level. Typically, we don't just arbitrarily assign importance to big round numbers, but oftentimes they do represent psychological barriers or opportunities for traders here. We can also see RSI still quite high here, repeatedly crossing into the overbought area, still kind of grinding higher and higher as we speak here. We are seeing a bit of a lower high than this area here.
Rising wedge.
Relative highs in the shorter term, which I think is more important because it speaks to more of the current trend development here. Finally, volume profile shows that we had nodes here, right around 88 or so. Here, near 65, and then the big one down here near about 48 or so, pretty far away, but those are the closest ones. Finally, a little disappointed we didn't choose Rocket Pharmaceuticals instead of Intel. We could have had all three with Rocket.
We have a missed opportunity here. We could have had all three with Rocket, but Intel has had a really impressive 26. Rocket Labs also hitting that new all-time high today, so thanks for bringing that one to us. Tim, thanks for taking time out of your ski trip also to be with us for Victory today. That's Tim Bowen. Trade.com. And of course, Rick Ducat for always being my partner in puns and our tech master here on Schwab Network. Coming up next, we are going to spotlight the week in banking, as most of the major banks have reported earnings and regional banks reported before the bell today. Stay with us.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The platforms and tools webcasts are designed to help you broaden your knowledge of the platform features and resources available from Schwab. You'll learn tips and tricks to navigate Schwab.com, thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live
They came down
or watch
some,
on demand.
actually.
Head over to schwab.com/coaching and start learning today.
I got out of them, so blah blah.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab.
Sure.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Welcome back to Trading 360. I'm Marley Kane, live in our Chicago headquarters. It's time to spotlight bank earnings as we had a deluge of banks reporting this week. Joining us now to break those numbers down, Ben Makovic, founder and portfolio manager at Strategic Value Bank Partners. Ben, thanks for taking the time to be with us this morning. You know, stepping back from some of the headlines that we saw in terms of the bank earnings we've gotten so far, you know, what are some of your key takeaways from the earnings season?
Well, there was a lot of talk about rockets, and the bank stocks have not been rocket ships for the past year, more like an old Cessna propeller plane. But I think there's some signs that things could be changing for the banks. We've had a lot of the large money center banks report this week, and some of the regional banks, and I think the industry fundamentals are positive. And what that means is it should mean higher earnings per share, higher EPS revisions. And so some of the things that have happened is that interest rate cuts are starting to filter through to bank balance sheets and bank profitability. And so what we've seen so far from Q4 earnings season for the banks is the cost of funds is going down and the net interest margin is going up. And that results in higher earnings per share. The other thing that's been interesting is loan growth has accelerated. So far, and we're only 10% of the way through, so this is an early look at the bank earnings, but these are the biggest, most important banks in the country. Asset growth accelerated in the fourth quarter and is at the highest level in several years. And so that tells me that credit creation in the economy is strong. And so if you get more loan growth plus at higher net interest margins, that should result to higher earnings per share for the bank stocks. And at the in the third quarter earnings season, the financials had the best EPS revisions after earnings season. Analysts brought up their estimates the most for financials out of any sector in the economy. And while the bank stocks didn't have a great 2025, they actually had a pretty good end to the year. And that's as those earnings estimates went up, the stock prices went up. So I think the bull case here would be if EPS estimates go up following Q4 earnings, that should be a good thing for the bank stocks.
So if that's a good thing with net interest margins where they are, cost of funds where it is, we're seeing growth, particularly in the trading numbers, we're seeing an uptick in M&A activity. Does that set up a foundation for a strong 2026, or are we late cycle here, Ben?
I think it could set up a strong 2026 for the banks, particularly because of where they currently are from a valuation standpoint. So right now the S&P 500 trades at 23 times earnings. The banks, the money center banks, Wells Fargo, JP Morgan, Bank of America, they traded 13 times earnings. And then the next rung down, the regional banks traded 11 times earnings. So historically, banks have traded at 80 to 90% of the PE multiple of the overall market, which right now is 23 times. Yet the banks are trading at half of that PE multiple. So they're coming from a very low base. the bank index was up 5 or 6% in 2025, so it really was a laggard. So it's hard to say that there's a lot of optimism baked into these prices, and so I think if the banks can surprise to the upside with earnings revisions, and they're already at low valuations, I think it could be a year where the bank stocks outperform.
And where I have started to hear some optimism in conversation is in M&A activity for 2026. We've seen that pick up. We have Fifth Third's acquisition of Comerica. That was the largest bank deal that we've seen in years. What's your outlook for M&A activity for the industry this year?
So yeah, M&A is the other component, Marley, to why the bank stocks could outperform. It was very difficult to get bank mergers approved under the Biden administration, and under the Trump administration, there's been a real change in the regulatory tone and action of the banking system, and particularly that impacts M&A. And so you mentioned the Fifth Third merger with Comerica. We haven't seen a deal that big in many, many years. And then also Huntington doing deals. So we have not seen these larger regional banks doing M&A deals in a long time, because the fear or the view, and rightly so, is that they wouldn't have gotten approved by the bank regulators. 2 years ago, it took over 200 days to get a bank deal approved, and a lot can happen in 200 days. Now that's down to about 120 days, and the administration has said they'd like to get down to 90 days. And so if banks know that they can get deals approved, and they know they can get them done in a relatively quick period of time, that's going to increase the appetite for M&A. And we already saw that in 25, and particularly in the back half of 25. Bank M&A deals in 25 were 185 transactions, and in 2024 was 133. So it's about a 40% increase in 25 in the number of bank M&A deals, and 25 was not like an all-time high boom time. You know, we were still well below where we were just 5 or 6 years ago. So I guess my view is there's a lot of room to go with bank M&A activity. There's still a lot of banks out there. Bank M&A solves a lot of issues for banks, and consolidation's been going on for 30 or 40 years. And so with a better regulatory environment, I would expect to see bank M&A accelerate in 2026, which often is good for the shareholders, because it unlocks the franchise value of the bank, and M&A deals can be done at 20, 30, 40% premiums to prevailing market prices.
And you mentioned deregulation from the current administration, obviously a tailwind potentially for the banks here. But one thing that keeps being brought up as a major potential headwind here is this proposed credit card rate cap. It's clearly rattled the sector. It's been brought up on pretty much every earnings call. Last question, how real is that risk? And, who is the risk really to if it were enacted?
Boy, that's one of those things where there's a lot of unintended consequences. It might sound good on paper, but if you think about credit pricing versus risk, higher risk people need to pay higher rates, because otherwise the model doesn't work. And so if that's put into effect, then you probably cut off credit to a certain part of the population that needs it. And if historically, if that would have happened, then there's pawn shops or payday lending, or there's other things that are even more disruptive and destructive to people. So I don't know. In terms of bank earnings, I think most of that kind of exposure rests at the money center banks. Those are not the banks we invest in. If you think of regional banks or community banks, typically wouldn't have a lot of credit card type debt on their balance sheets. They might issue the credit cards but not actually own the assets. So I don't know that that's a big profit driver for the industry. So I don't know that that's that big of a deal for what we do.
Ben, we appreciate you taking the time to be with us to talk banks and the outlook for the financial sector for 2026. That's Ben Makovic, founder and portfolio manager at Strategic Value Bank Partners. Coming up next, we've got the Disruptors. We'll highlight Seagate after an upgrade over at Susquehanna. That's next.
Where's your coffee? It's sitting by your mouse.
The Schwab Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
And on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. It's time now for the Disruptors. George Tillis, our senior markets correspondent, here with today's company, Seagate, after an upgrade at Susquehanna. This was sort of an important one for Seagate, George, a little different than what we talk about. What makes this one a little different?
I think it's a little different in terms of the call by Susquehanna. They're quite a bit behind the curve, to be honest with you. If you look at their call for the name, they actually moved their rating on the stock to basically neutral from underperform, and they now have a price target of 280 from 150. And if you look at the current price, that's a significant reduction or level relative to where we're at right now. And I think their call is interesting in the sense that you have to consider the deeply cyclical nature of Seagate's technology. I mean, they are a global leader and provider of data storage and technology solutions. We know that storage solutions, including Western Digital, DRAM and NAND flash memory companies like Micron, which are all very deeply cyclical names, have really caught fire in the last year or so based upon the fact that the horizontals associated with artificial intelligence and data centers really demand their technologies. Everything from PC markets, server markets, data centers, hyperscalers, they need storage and memory. And effectively, that's why we've seen Seagate, Western Digital, SanDisk all just ramped significantly higher. And this is to be expected considering that earnings have increased substantially over the last year. And even if you look at Seagate going forward itself, in the next year, they're expecting $15.50 in terms of earnings. That's consensus-wise versus $11.62 for this current fiscal year. So that's about a 33% continual increase in earnings per share for Seagate estimates, consensus-wise, and that's why the stock continues to move to the upside. But there are some analysts, which again Susquehanna is one of them, that are still a little bit behind the consensus because of the fact that they are still looking at the company as deeply cyclical, which poses some risks, especially if we start to see the demand to wane significantly or marginally going forward, and prices start to settle down.
You bring up a really good point there, George, about data storage being notoriously cyclical, and that puts some of these sell-side analysts sort of on the wary side of that eventual downturn. But Susquehanna was the last holdout with a sell or sell equivalent rating. So now without it, 71% of firms saying that they see upside here, triple-digit gains in the last year. Year to date, they're up almost 20%. With these moves already, such substantial moves to the upside here, and some slightly different outlook here from the street, how would you structure an example trade?
So I've learned over the years, you don't find a trend. You don't go against it. You have to
Yeah.
If you do look at
George.
the Seagate, it's very strong. It's trading above its 10 and 20-day moving averages, also above the 50, which I use as a benchmark to structure a bullish trade. Got to keep in mind that earnings
George is full of shit.
Earnings for CDA is coming up on the 27th of this month. So I'm going to structure a bullish trade around that time frame or that event coming up.
So I'm going to structure a 2-week trade.
Well, the time I've known George, he's never told me that.
Very simple. I'm going to buy it in the money.
Never fight the trend.
I'm going to sell the 325 call against it. It's $10 wide. Essentially, you're paying around $5 a share or $500 a contract for this trade. So it's bullish. It has to hit in the next 2 weeks if you do hold it that long to 330, and it's a 1-to-1 ratio trade. You outlay $5 to make $5. You're capped at 335 because again that's where the short strike lies in case it goes beyond that. Now again, the reason I'm structuring this cap trade is because if you were to just place a outright call for 325 option, it costs you around $23, and you only have 2 weeks in time. So because of the narrow time frame in this trade, I'm capping it at that 335. So it's 1-to-1 ratio. It has to hit at least 330 if you do hold it to expiration in 2 weeks.
All right, George, we appreciate you being with us to walk us through this note on Seagate and also structuring that example trade for us. Seagate trading about 1.8% higher today on the heels of that note, an upgrade, and 326.17. And that's George Tillis. Thanks again. Coming up next, we've got our 360 round. We'll take a look at recent housing data and the outlook for the sector.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms
Came back and get me a salad.
nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock, and that could certainly be a short to near-term catalyst.
Next Gen Investing, 1 p.m. Eastern.
Only the Schwab Network.
Hey, Dad.
Matt.
Question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. It really started with nothing. He worked hard, and after he passed away, the torch has been passed to me. And my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
This is Fast Market, built for traders who want more than just headlines.
We walk you through trade ideas with structure, risk management, and a focus on execution.
From options to earnings to volatility plays, we bring decades of trading experience to every segment.
With real-time insight across products and sectors, we deliver what active traders need to stay ahead. Fast Market weekdays at noon Eastern, live on Schwab Network at schwabnetwork.com.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Hey, Bob. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, I had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I programmed that 20 years ago.
Jim's really been there to answer any questions I ever have. It makes a huge difference when you have someone that actually cares.
Welcome back to Trading 360. I'm Marley Caden. It's time now for our 360 round. Let's bring in our guest joining us to discuss housing data. Rogers Healy, founder and CEO of the Rogers Healy Companies. Rogers, great to see you. Happy Friday to you. You know, we've got some recent data. We've seen a pickup in both new and existing home sales as mortgage rates are starting to move lower. Do you think that this is the start of a durable recovery here in the housing market?
100%. Yeah, I think that we're going to see our first stable and kind of quote unquote normal year that we've seen since 2019. I think that demand is not dying; it's just recalibrating. And so I think to see the kind of data that we're seeing is really honestly healthy. And I think people have a tendency to think that the sky is falling or that it's all collapsing, but I think it's just normalizing. And I think that again we're at the very, very beginning. Front of what's going to be hopefully a really great spring market, but to have this kind of data in December, it is somewhat promising.
And Ben, I want to bring you into the conversation. Joining us as well today, Ben Ayers, senior economist at Nationwide. I mentioned those mortgage rates because we've seen the rates go lower. We're seeing the mortgage applications jump as these rates are easing. How much of this demand is being pulled forward versus how much of it's actually incremental?
That's a good question when you look at 2026.
That's too good of a question.
Pulling forward, but I also think there are a lot of people that have been sitting on the sidelines for all of 2025, waiting for rates to get down to the levels that we're finally seeing now. And now that we're there, they're jumping back in. And so we are pretty optimistic, at least for the first quarter, maybe the first half of 2026, that with these rates coming down, we're going to see a lot more home purchases. And fortunately, there's a pretty good sizable amount of inventory out there that people can jump into.
And Roger, if we do start to see these rates continue to fall here, does demand broaden, or do we just hit supply constraints faster?
Sure, right? Yeah, look, the easy answer is demand is going to broaden. And real estate, especially on the residential side, I'm sure Ben will agree, it's cyclical. And usually the spring and summer market kind of drive, say 60 to 75% of the year's, the demand and revenue. And I think that we've got enough inventory for the first time, in 5 or 6 years that it's going to make sense. And imagine what has happened from the interest rates going from 6.25% to 6% over the past, couple weeks. You couple that with the spring market, we're going to have a really, really healthy year. And I think the data backs it up, and we've seen this. And it was kind of hard to predict the future when the COVID bubble happened and people were, scrambling to purchase at, kind of record paces and record prices. But I think we're going to see really, really healthy demand from people that have been sitting on the sidelines for, up to 5 years. And that's just exhausting. And they're frankly probably tired of renting. So I expect a very, very, very healthy year.
And Ben, if we get this really healthy year where we start to see this demand broaden, do we then run the risk in 26 of also seeing prices reaccelerate?
I think that's one of the things we're keeping a very close eye on, because we need supply to keep up with this boost that we're seeing in demand. I think right now supply is in a decent shape, but if people really push for homes here over the next couple of months, we could be back again in a pretty good supply crunch. So we are a little bit worried that as we look over the year that this, without any accompanying boost from supply, we need more listings. We need more people to say, okay, rates are low enough. I've been locked into this very low rate for a long time. Maybe now is the time to jump into the market. We need more of that to happen this year to kind of keep that balance when it comes to the prices. So we are a little bit concerned that while this is a boost to housing affordability with having lower rates, that might end up being offset to a certain degree by rising prices, especially in some of those markets that are already relatively tight.
And Rogers, we got the home builders' confidence numbers this morning. They unexpectedly fell in January. If we do start to see this demand uptick, but sentiment still remains lower, who ultimately sets the prices in this market? Is it buyers? Is it builders? Is it mortgage rates?
It depends on the market. I think that in a city like Dallas, it's really still a seller's market. We've got the data to support it. But if you look at the top markets in the country, it's kind of the top markets we saw before COVID. It's upstate New York, it's New York City, it's Connecticut, it's where money maybe grows on trees. So I think that builders, they haven't gotten humbled, but I think reality has really started to set in. But we still have numbers that are up year over year, upwards of 20%. And I think anybody's going to look at that, whether they're real estate people or not, and they're going to consider that really, really healthy. So I think it depends on the market. I think we did see a little bit of a reset in Q4 last year. People that were very ambitious, kind of learned the hard way that days on market do actually start to add up. And I think that we've got, a realistic set of buyers and sellers moving into this year.
And Ben, last question to you. We are pretty tight on time, but I do want your perspective here. The administration has been signaling support for housing demand. Can policy actually move the needle here without addressing those supply concerns that you highlighted?
I mean, certainly it can move the needle for demand, and we've seen that just here over the past couple of weeks, but I do think to have that balance and really promote that great affordability increase that we want to see, it's going to have to be accompanied by some ways to help boost the supply of housing as well.
Well, we appreciate you both being with us to talk housing and the latest data. Rogers Healy, founder and CEO of the Rogers Healy Companies, and Ben Ayers, senior economist at Nationwide. Also want to thank all of you for joining us on Trading 360 today. I'm Marley Caden. You can download the free Schwab Network app in the Apple App Store, but stay with us. Fast Market with Don King Hall coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Oh, so it does have a highway.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell.
Looking at this house.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change
I
in
like
sales
this.
based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute. With shows
Lovely
built for
house
action, we break it all
right
down
off the
in
ocean
real time, with
in
speed,
Hawaii.
accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined
One thing's
way
missing is
here
a
going into
pool.
earnings.
So that would be a further
But I got
downside
that
area.
ocean, but I don't know if
Smart insights, actionable data,
I'd have to get a
veteran
world
traders, and trusted financial journalists streaming
I'd
live
do something.
and on demand. Schwab Network, streaming 24/7, any
Yep,
screen,
Jimmy likes.
anywhere, free. SchwabNetwork.com.
Hey, Bob.
Hey, Andrew.
Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, I had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's sitting with
Give him some vodka.
Jim, my financial consultant, I probably met 20 years ago.
Jim's really been there to answer any questions I ever have. Makes a huge difference when you have someone that actually cares.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Some vodka.
fast market here on the Schwab Network. I'm Sam Barnes in for the one and only Diane King Hall today. It's noon here at the New York Stock Exchange on Wall Street. Let's take a look at major averages and where we stand right now at this lunch hour. And of course, we have seen a pretty range-bound, pretty muted all day. It's been a nice day once again for the Russell 2K. We'll talk about some of that outperformance throughout the course of the program, but we are looking pretty flat as a pancake on the S&P 500 benchmark right now at 69.49. The Dow Jones slipping a bit, but all the sessions low, suffice to say there. We've got the Nasdaq still aligned to the upside as well. As we said, we saw a little bit of a late day fade yesterday. We would continue to see that today. So it feels like a little bit of a quiet old Friday as we approach, of course, this long weekend for the holidays. So here is the roadmap for today's show. We're going to look at example option strategies for NVIDIA after Jefferies raised the price target today there. The team from Lightfolio will join us with the latest consumer sentiment data in Expedia.
Dater?
Will join us to break down Seagate as memory software.
Did you say Dater?
But time to bring in my co-hosts today. Tom White in our Chicago studio and Joe Zoll, head trading derivatives strategist at Charles Schwab. Thanks so much, guys, for having me today. So obviously, as I mentioned, we've seen a little bit of a choppy old session this morning. Things have been pretty quiet. Tom, what are your sort of takeaways on the day so far?
It's a push and pull in this market that was
push and pull.
The last couple of weeks since the start.
Right now, we pulled back to the VWAP on the SPY.
Improving. The jobs numbers are still, firm and in line.
Well, at IWM had some pretty funky looking open.
Some better than expected manufacturing numbers from the regional side.
So today we've traded the SPX and the SPY.
You see the Atlanta Fed GDP now back above 5% for the current quarter. As far as estimates, you've seen some of the firms come out and increase their GDP estimates for the entire year up to 2.5%, close to 3% on some.
Where
between the geopolitical risk, the headline risks to the markets, along with improving data, even though the PPI data might not have come in where we wanted it at 3% on both core and headline. CPI data is still relatively muted, but still not down to that 2% level. I think one of the key things that we have to watch over the next
Randy never panics.
There's expectations for a rate.
That's because he's high on Demerol from the dentist.
Going into the meeting later this month. But if you look at the 10-year yield, it hit the highest level that was seen since early September, above 4.21%. If we continue to see that some volatility maybe come back into the yield, into the bond market at this point, that might cause a little bit of headwinds, but not surprising. We're only a couple, the S&P 500 is only down by 2% so far this week, just below record highs. The Russell's at record highs, so we've seen the broadening out at least. But hey, maybe some consolidation warranted as we get into the thick of earnings season over the next couple of weeks.
A little bit of push and pull beneath the surface, which is perhaps a function of, as you say, markets really vacillating. I mean, we're in, day 16, and it feels like we've had months and months of information just thrown at us, like drinking from a fire hose here, and we're talking to all of the guests, it's like throwing spaghetti at the wall with some of these policy announcements on everything from oil to obviously healthcare and defense and affordability, and just waiting to see basically what sticks. And then of course we have the power probe and the criminal investigation, another sort of piece of information that we had to sort of deal with this week. You mentioned the 10-year yield. I thought that's interesting actually. Thinking about 421 earlier today, I don't know if that constitutes a breakout at this stage, given that it's just been so sticky, so range-bound for so many months. But I suppose we have to wait to see the overall trend. But Joe, I want to get your thoughts here on what's happening with the Russell 2K. I mean, you and I have been speaking over the last few months about these brief bouts of outperformance. I mean, this has been an outperformer so far in 2026. We've really seen that rotation, that diversification in these markets, that broadening out. Just talk to us about how you think about things right now.
It was certainly one of the best trades I've made in a long time as I closed out a short vertical. I'm also because once that breakout occurred, I think we really started to pick up steam. It's been interesting kind of watching this rotation, as you mentioned, equal weight is outperforming the market weighted S&P 500, materials, energy, industrials, these are all very cyclical names. They're outperforming tech, communication services, discretionaries. It's a really kind of interesting time to see these rotations occur. mean, with the backdrop of all the kind of crazy macroeconomic news, let's not forget, we still have to have a budget resolution by the end of the month to make sure the government doesn't shut down again. I mean, it seems like that's probably going to happen, but you never know. So there's still the potential for a lot of volatility. I think the rise you saw in the 10-year today probably had a lot to do with President Trump's comments on assets and in terms of betting markets now taking him, or at least pulling back probabilities that he would become a next chair. So I think that was interesting, and there's these news dynamics that come out of left field every day, as you mentioned. It seems like they've been here a couple months, but it's only been a couple weeks.
Yeah, as you say, we've got the asset news that may not be the next Fed chair was the headline. Obviously, we are grappling with that this morning. We've got some housing numbers as well, 37 on the NAHS, that housing index too. Some Dutch remarks out from Bowman, and interestingly too, also ready to adjust towards the neutral rate unless the jobs market improves. But as Liz Sort has been talking to me about, this rally is not going to be linear. I mean, we are going to see these fits and starts, and a lot of that is going to be driven by some of the earnings that we're hearing. When we hear these beats from Micron, which really revived that tech rally once again, and then we saw that case sort of playing out again with TSMC this week as well. Interestingly, we're in sort of day 2 of this post-TSMC earnings sort of follow-on, and I was listening and watching the Asian session overnight as well, and you had names like SMIC over in China rallying, SK Hynix, Samsung, all the usual suspects. Interestingly, SoftBank, which is so tied to this whole chip and AI theme, sitting out of the rally, but it certainly helped local stocks. I mean, look at ASML. Tom, what do you thought about this?
Yeah, I think it's starting to kind of bifurcate here a little bit between the winners and this AI data infrastructure build-out and then maybe the software side, right? You've seen software, ServiceNow, CRM, Snowflake, those things underperforming severely. So the picks and shovels within this industry continue to do well. You mentioned the TSM, up 6% so far this week, up 13% in January. It's had a good run. And then you look at the flow over into KLAC, Lam Research, AMAT, and some of these semi-equipment makers. So it's broadening out in that aspect. I'm still curious to see what happens with the chip names, because we've seen that pullback in NVIDIA. We're going to talk about that later. NVIDIA from all-time highs. It can't seem to right the ship, even though it was having a good day earlier today. And then you look at AMD and some of those other names within the space. So it's getting a little bit bifurcated here. I think the underlying tone of what Taiwan Semi came out with 35% growth, they're basically at max capacity for what they can produce at this point. Their margins are increasing. They're at 60% now. Those have steadily gone higher over the last couple of years during this AI boom. And it's a good omen for, I think, investors in the tech space in general, because there's no pullback in CapEx yet. And you'll first see it at TSM, you'll first probably see it in memory chip makers, some of the equipment makers. You'll see it there first. That might be the canary in the coal mine, but right now it's all systems go as the demand kind of outweighs the supply at this point.
Yeah, absolutely. I mean, you and I were talking about that sort of capacity crunch as well over at TSMC. I mean, something certainly to pay attention to. I mean, Joe, was, we've had a good over 24 hours to digest these numbers and see it sort of playing out in global markets. Obviously Tom's point, the winners and the losers here, the picks and shovels obviously catching a bit as well. I thought it was really interesting to hear Stevie Way actually saying he's nervous about whether AI demand is real or not, which is obviously something to keep an eye on. But they set them up pretty high, obviously, with the CapEx numbers. What do you think about this?
56 billion, and the number keeps going up. So that's a big spend in terms of CapEx. But I think what Tom said about the margins expanding, I think that in my mind was the biggest driver of the stock performance.
Big driver.
Because we've seen a lot of companies talk about the increase in CapEx, but we haven't seen them talk about the increase in margins. You can have both. Wow, I mean that's a great combination for AI, and at least setting the tone for what looks like an improved cycle in 2026. So I think investors are at least looking at this point and saying, okay, well, who are the winners and losers out of this? And as we kind of go through the reporting season for earnings, you're going to hear more about that, but TSM really set the bar high. I think one interesting maybe side trade that is occurring today is taking a look at the energy sector, whether it's Constellation, Vistra, the news out of the Northeast that President Trump wants to maybe have auctions for some of the energy players out there. I thought that was interesting. So you're seeing maybe a little bit of a turnaround in some of the ancillary plays from the AI trade, but that's been an interesting trade to look at today as well.
Oh, yes, absolutely. Looking at that reliability and affordability in PJM. And obviously some of the optimism that we saw, particularly in the Asian session, has been off the back of this Taiwan trade deal with the US. Obviously, we're going to see hundreds of billions of dollars worth of FDI coming from the Taiwanese, coming from the tech companies. And in exchange for, hey, we'll cut you slack when it comes to the tariffs, Tom. What are your thoughts on this? Because I suppose it all just comes down to follow-through, implementation.
Yeah, and I mean, there's been a lot of promises made on the geopolitical front as far as investments go in the U.S. The hope is that these are all going to come to fruition. But I think, you know, if you take a look at maybe the 15% tariffs on some of the products, you know, that's lower than maybe some of the other countries, that's a benefit. But I think the administration has basically drawn the line here and saying, hey, if you don't start building out some of your infrastructure for tech, and the development of it and the production of it here in the U.S., hey, you might be susceptible to up to 100% tariff moving forward. I know
damn.
Howard Lutnick basically came out and stated that. So they're using it as a tool at this point to kind of repatriate some of this tech production here in the U.S., and that's probably a good thing. And then you throw on top of it the geopolitical implications of this, right? Everybody's expecting China to kind of go into Taiwan over the next couple of years, if not sooner. And this kind of solidifies that partnership that we have with Taiwan, backing them up. So probably a good thing for Taiwan, probably a good thing for us moving forward. And it's just kind of another additional investment opportunity that these other countries are giving to the U.S. at this point, because they realize that they have to be here to maybe push back on some of those tariffs and potential tariffs that might be you know, down the pipeline.
Yeah, it's de-risking, it's onshoring. It's interesting because, you know, it's not been easy either, because we've read about the sort of culture clashes, the difficulties and hurdles in getting that Phoenix plant up and running, of course, with some of the engineers there. Joe, what are your thoughts on this as we do look at this agreement, because part of that is obviously going to see TSMC potentially expanding, you know, obviously some of its footprint there in Arizona.
I think, you know, go back to kind of what I talked about a little bit earlier. What are the sectors that are outperforming this year? One of them is industrials. And if you kind of look through the industrial sector, it's something that would absolutely benefit from this type of deal making. So, you know, look for the companies that as you talk about the picks and shovels, these are the actual picks and shovels that will be going in the ground and building these mass data centers, building these chip and foundry plants. So, you know, there's plenty of opportunity maybe outside of what worked last year. And I think that's going to be a theme carrying forward, Sam, this year, is that maybe what worked last year, you're going to have to go to that maybe second derivative trade to find that. Perfect example is just kind of looking at the Mag 7 right now. I mean, it gets all of our attention, but yet it's not moving the market. We're finding other companies out there. You mentioned the memory stocks. I'm talking about industrials and materials. So there's a lot of other companies out there. I think it's a stock picker's market right now.
It certainly is, and that's why industrials and materials have been getting a look in, right? Because obviously they've been seen as sort of this backdoor AI trade, sort of adjacent to this whole tech theme and a different way to play it. But let's move on to the bank earnings. Obviously we've got a lot of information this week from them. Interesting as far as the reaction, Tom, I want to get your thoughts on, you know, did it depend on which bank and what they said as to how they reacted the next day? Because, you know, obviously we heard them in the morning, so during that trading day, but or was it something to do with the fact that the market was still coming around to this whole idea of the whole credit card policy thing as well?
My dear.
Well, I think that's hurting the money center banks so far this week. You've seen that pullback in JP Morgan, Chase, Bank of America, Wells Fargo, Citigroup. But then you've seen some strength in the investment banking side, whether it's Morgan Stanley and Goldman Sachs. So maybe that's kind of put a little bit of fear. But remember, going into earnings for all the banks, whether the money center or the traditional investment investment banks is the bar was really high going in to these reports. Now, there's probably going to be a cap on the money center banks until we get some clarity or resolution on the potential for a 10% cap on interest rates for credit cards for a year. Does that come to fruition? Well, that is definitely going to pressure the money center banks like the Citigroups and the JP Morgans, and I think that's what investors are kind of looking at to maybe took some profits. But at the same time, if you look at the economic backdrop that's kind of supported the good benefits that we got from them, whether it was the loan growth that we're starting to see is starting to ramp up a little bit, and then investment banking fees, those did pretty well. Net interest income continues to outperform as the yield curves normalize a little bit. That's been a benefit. But then trading revenue.
Been sitting around a little bit too long. I think she's going to do something soon.
Because we did see a lot of volatility in the fall, and that went straight to trading revenues, whether it was on fixed income or equity side. So we saw some good numbers. And like I mentioned, if you start seeing a continued strength in GDP expectations, deregulation, the benefit for tax cuts, and the consumer starting to continue to ramp up their spending. Retail sales came out this week. That was better, a little bit better than expected. This all bodes well for the front line of the economy, and that's these banks.
Yeah, Joe, obviously we started to hear from the regional banks as well today. I mean, what do you make of the performance and what they've been saying too?
I'm just going to sound like I just continue to copy Tom's script because he's really covering everything very well. I think it really all comes down to this. I think if you believe in the strength of the economy in 2026, you're probably going to be looking at interest rate policy that is muted. You're not going to see maybe more than one cut, as the Fed has ultimately kind of priced in at this point. Markets might be looking at two, but if you believe the GDP, as Tom was mentioning before, the Atlanta GDP now is pushing up around 5%.
Yep.
If the belief is that the growth is there, if the belief is that the tax cuts and the deregulation will help, you're probably going to see this yield curve continue to stay at these steep levels, which does benefit the net interest income of these larger banks. Now, on the regional side, that was
Reverse there, like I said, any minute.
It really does kind of play into, just like the name.
Within a minute and a half, boom.
You probably see a little bit more volatility in those earnings. Kind of given
How did he do it?
The K-shaped recovery, because not everybody is participating in the market highs and
Jim,
participating in the real estate highs.
we want to.
That's something to kind of.
Somebody here that's new to the room wants to ask you a question.
All of these new kind of edicts, if you will.
A question? Yeah, a question. Yeah, I'll answer your question.
Not allowing income investors.
You got out here on voice. And you said any minute we're going to have a breakout or something. Something going to happen.
Enforceable or beyond.
Could I
horizon? So it'll be interesting to kind of
get your speculation on that thesis? And then within a minute and a half, the sucker broke out.
Play out. How's that implement? That's probably why you're seeing some of that recovery in the major banks today.
Okay, we covered a lot of ground today, guys. Thanks so much. We're going to take a little
question.
breather and go to a break. Coming up, it's bull versus bear.
Now,
the guys will present their example trades for
after watching chart patterns for a long time and candlesticks and patience and having like a personal clock inside yourself that says, okay, man, this thing's looks to me like it's about ready to flag out and squeeze. We called it here earlier off the 200, correct, Mundo? Boom. So ever since then we pulled back, and then we created what you would call a 1, a 2, a 1, 2, 3. Yes, symmetrical flag. So we draw our pattern on the body of the candle. To that body. And then this body to that body right there. So as we broke out,
Whether you're an
I started seeing it do its pullback thing where it said it always retests the old resistance.
that's right for you.
So we had the whole body there broke out.
Trading webcasts are designed to help you.
You can see it right there, an inverted hammer.
Of technical analysis.
And then another hammer still above that trend line.
Best of all, you can ask questions.
And then it respected the 63 and the 21 right down here.
Interactive learning at its finest.
So I called this sucker out right here off the 21. On that candle right here on the spinning top.
And start learning today.
And then this other candle came in. Boom! Jimmy says, as we got into this, we're getting ready to go ahead and something's going to happen here soon.
Sometimes, you know,
because we already had the breakout, the pullback,
you could have done
and all we needed now was just we had the symmetrical flag.
Level up and invest smarter with Schwab.
So, I mean, that would be on the SPX scalp. Probably worth 20, 30 cents. And then you know that you hit that 50, and you know, everybody else sitting here with a thumb up their ass. The body didn't break the 50, didn't break the 50, didn't break the 50. But this is when the passage of time. For I am Kamala Harris's speechwriter.
What are your thoughts on this Jeffrey's note saying
the passage of time.
Yeah, I was doing a little bit of digging.
Now we're
here.
creating an ascending triangle.
This one for the coming year is down to 24. So
when trading stunks,
on a forward-looking basis, I believe
it all depends on the passage of time.
For Nvidia in the mid-teens as far
There's
as
different
goes. So we've seen that, and
kinds of passages. We have what you call the scalp, the day trade, and the swing.
Revenue grew over 60%. Their margins continue to do well. They're sold out of the Blackwell chip.
What was yesterday
even without any revenue generation
could have been today.
China, at least the legal kind at this point.
If I was in it yesterday,
demand's still there for their products.
Today would be tomorrow.
They're continuing to innovate, right? They've got Rubin coming out this year. We'll see how that takes off.
The passage of time.
Look at the chart here, and over the past couple of
so
months,
as we wait here, we get to going, oh God, is this thing ever going to break out?
Here a little bit in Nvidia, and it's just a head scratcher at this point because you've seen other segments within this AI.
Now we're forming an ascending triangle, so now I'm really starting to get bullish.
We're talking about the equipment makers at this point, the Taiwan Semis, Lam Research, and others, and this thing just catch a bit of a hold at this point. So that's a little bit of a head scratcher, even though those valuations have come down.
It is true. I'm now starting to get bullish as we form the ascending triangle.
Talking of head scratching, I've nearly got a hole in my head from scratching so much over the back and forth between Nvidia and China. Obviously,
are we getting ready to squeeze again?
Okay, they can go back in, they can't go back in, they can go
here we go back to the passage of time.
Then they can't go back in because customs officials
right here in Missouri, it is 11:24 and 12:24 in New York City. So the fat cats are at lunch. They've already left their desk.
Access to the latest Rubin, because of course this is something that the U.S. competitors are managing to get their hands on. I mean,
so I'd be less skeptical.
What Chinese companies want, and I think that's really
breaking out. Do you understand?
It's just going to be the icing on the cake here, because I mean they're reporting some good numbers ex-China. But Joe, what are your thoughts on Nvidia?
But I might prepare here for the next trade.
Tom talked about valuations.
For I'm Washboardjim.
PEG ratio on Nvidia.
Where I talk about chart patterns, moon averages, and being in the now.
Maybe even a little bit less.
Here we go.
Higher growth rates. This is a company, and I think Tom brings up an interesting point.
Jim, will you trade the SPX for us?
Maybe it has. Maybe
we've been trading SPY all day long.
Second inning of the AI trade, where this was that initial leader, and it's maybe having to share some of the spotlight now with the memory makers. So I think that's
get ready.
That's an important
get ready. Get ready. Get ready. Get ready. Get ready.
It's starting to maybe break out from its malaise that it's been in the last couple of months. But it is also, it did also rally back 100% from the lows that we saw in April and May. So I think,
Randy,
it looks like it's
will you please come pick up your baggage at gate 6? Randy. We have the 200 EMA, and we also have gate 200 SMA. And right now, I think we're going to bounce off the 200 EMA.
Constructing this trade, Sam, a couple things came to mind was the fact that we're in a really low implied volatility regime right now with NVIDIA. It's basically in the bottom decile. So what that means is that you're looking at things like time spreads. Time spreads are probably relatively cheaper than what they
The
might be,
SPX.
or what they might be when you're trading at a
As
higher
he tinkers in time.
implied volatility percentage.
I'd be looking at tomorrow on the
It's
SPY.
basically a
Get
call
away from
diagonal,
today.
and we're looking at the February 20th
Yes, sir.
expiration for
Or
our short
Monday,
strike
Tuesday.
and or excuse me, for our long strike and the January 26th expiration for our short strike. So
The
buying
695
the
strikes
selling the 195
at
call.
96
we were about
cents.
$11
Do you understand?
where it was when I initially priced it. And kind of what this allows
And
you to do is it's almost like a covered call without
today on
actually
SPX,
participate in the upside up to that 195. Now, why did I pick that 195?
There we go.
Well, 195 was actually a level that the stock kind of pulled back from when it started approaching.
the SPX
there
would be
just a couple
the
of weeks ago, maybe,
69.60s
potentially
at
the
$3
top part of
bucks.
that range. What I like about the diagonal trade as opposed to just the calendar is since it has that embedded vertical spread in it, gives you the ability, the flexibility, the optionality, if you will, to make some rolls along the way. This particular
So we're on the 200 and the 200 SMA.
expired and the long strike, right? That
Jack Frost nipping at your
before
nose.
earnings. So at that point,
You
you
time
kind of make a
Carol.
decision on whether or not you want to keep this, close
Benson
it out,
of
or
the
if you
line.
want to stay within that earnings cycle.
Joe, just taking a look at this trade. It's a bullish call diagonal here that you brought
There's
us.
the
but
EMA.
Buying that 180 call out in the February
Here's the
20th monthly
SMA.
options that expire in 35 days gives you that higher delta. It reacts more like the stock. It gives you Vega also as you're buying a longer term option. And then against that, in the January 30th weekly options that expire in a couple of weeks, sell the 195 call, $11 debit. There's your risk. $1,100 per spread on this one. And I think the key is, you mentioned, it's almost like a...
It could easily touch this double bottom. I mean, it'd still be a higher low and be very bullish. Could fake everybody out.
100 shares cost you nearly $19,000.
I mean, if I was new to trading, I'd wait for that 200.
Now, the thing is, you need a move to the
If you have a little
upside,
bit of
but
money
because
in the
you're buying
bank,
that in the money call, anything above
take
about
a risk like
187,
was in
188 is going to be potential profitability on this, because the ability that you have to adjust or roll that short option repeatedly over the next, maybe 3 weeks or so. That collects credits, that reduces risk, that increases
tried to
potential
tell them the other day,
profitability.
there's
On
285.
this one, you've got some assignment risk over that on that short option over the next couple of weeks here, so keep that in mind. But definitely a bullish trade. Tops out
Yep, there it is.
profitability at or near that 195 strike. That's where you want it to go over the next 5 weeks or so. But this is definitely a bullish trade, but you don't need, on a percentage basis, that big of a move from where we currently are, if any move at all, to start getting into some profitability on this bullish trade.
That feels going to drop a
Joe,
little
I
bit
flipped
more.
it where you mentioned low implied volatility levels. That
I'm gonna
ID
get in
percentile
here
rank
just to be
of
safe.
about 6%. We're in the bottom, 5% basically, 6% of what we've seen over
We
the
could
last
easily
2
drop down to
weeks.
the 200
So I
is
think
what I'm
it's like a
saying, but I'm going to
directional
jump
where
in
you
now
can take
to be
advantage of that low
safe
implied volatility
because I don't
by
want to miss
buying
this
something
trade.
on the
I've
bearish
been waiting
side
here
if
forever.
you think it's going to pull back. Or maybe if you're long the stock, it might be a type of trade that could be used as a potential hedge on a long stock position. But going out to the February 20th options, just like Joe's trade, I want to avoid that earnings event, which happens
If this don't work
a
out,
few days after this
you
expiration.
could hit the 200,
Buy the
then I
190
grab two
strike
more.
put That's in the money by a couple
One
bucks.
at 270.
That's got the higher short delta, and then sell
And two
the
at whatever.
175 put. So basically, a bearish $15 wide put vertical. You're paying roughly about a $570 debit for that. Might be a little bit cheaper than that, but the debit you pay is going to be a risk. Just like Joe's bullish call diagonal, the debit you pay on this bearish put vertical is your risk, $570 per spread. That can expand to 15 if we go below 175. Joe, give me your thoughts here on the bearish look at NVIDIA.
I think like both of our trades, it doesn't require a lot of movement.
Some
We're
money.
trading, what, 188 right
260,
now? So you get,
255.
A couple additional bucks to the downside, maybe push back down
Nope.
towards that 50.
There it is, the 200.
Slightly below.
Oh God, it jumped below it.
And it gives us stock an opportunity.
Oh no, double bottom.
So it's a cheaper way to kind of play the downside, or as you mentioned, you know, there's
what a
lot of
slap in the
shareholders
face.
out there if they're looking for a cheaper hedge. It's
Son.
a decent trade for that.
Yep, definitely need to move to the
dare you.
downside on that one. About 184.30 or
225.
is the break even.
Now I have 3 of them.
So there you go, Sam. We got the bull and the bear. It's your choice.
I said I'd jump in it, so I'm gonna give it a chance.
Okay, do I have to make a decision now?
Double bottom.
Okay. Well, we have to let Joe go.
How's he do it?
So I suppose that says it all, doesn't it? Well, yeah, that's the
The
decision.
squeeze went the wrong way that time.
Thank you very much, Joe.
See what I'm saying?
All right, boys. Thank you so much for the bull and the bear case, and thanks so much, Joe Mazzola, for
I think I
helping
see
do some
it.
heavy lifting for the first half of the show. Up next, it's Cash Tags. The team from Likefolio presents the latest sentiment data for Expedia.
Jimmy.
Fast Market. We'll be right back.
I tried my best.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you know, you could have done better. Same goes for where you invest.
We're at the 200
Level up
now.
and invest smarter with Schwab.
Oh, what do we have here?
Live from the New York Stock Exchange, when the
What
market
just
moves,
showed up?
we're on it, getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
It's sexy, James. Ladies and gentlemen, we have a hammer that just showed up.
Schwab is powered by Ameritrade.
It looks like it's got a very long leg.
Specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone.
Very long leg.
Platform chat. Trade brilliantly with Schwab.
Let's do this.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis,
We have a snake.
futures, and more.
Break out.
You can ask questions
Pull
by
back
with an education coach.
to a
It's
double
interactive learning at its
bottom.
finest. Tune in live
To a
or watch
double
on
bottom.
demand. Head over to schwab.com/coaching and
Let's
start
break the
learning
9. Uh-oh. What's she gonna do?
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
$2.90.
Welcome back to
$3. Ladies and gentlemen, Washboardjim.
Today alongside Tom White in our Chicago headquarters. It's time
How do you
now
do
for
it?
Cash Tags. For that, let's bring in our next guest. That's Megan Brantley, VP of Research at Likefolio. Very nice to see you today, Megan. Thanks so much for joining us. So we're looking at Expedia today. I've got to say, personally, I'm a big customer and a long-time customer of China's Expedia, actually.
Did you see that hammer?
Of course, is listed up the road in the NASDAQ. And
Oh,
obviously a great platform. They've been very good to me, but I'm just wondering how consumer sentiment in
sitting here,
Expedia does compare across the board.
Washboardjim today, and on my lunch break.
Expedia, this has been a stock that's had a really nice run.
It's about 12:34. I need to get back to work here soon.
A lot of this is Expedia.
He's live on
catch up to
YouTube.
other
And
peers, but we're seeing it do a really good job.
about 4 or 5 minutes ago, I was sitting here eating my burger, and took a bite of my French fry, and bit into a big old fat roach.
Whenever we look at overall consumer demand and these,
And then I heard Jim started that goofy laugh.
across all of its brands, from
Kind of like a hillbilly. Look where we are now.
We see some nice momentum. Overall digital traffic is up by around 13%.
$2.90.
This is in line with its probably, largest.
So I get in there, and first thing I noticed was that damn hammer he talked about yesterday. He was so adamant about.
Outperforming kind of individual
Put it
hotel names,
again.
but
and he mentioned
some
it.
key trends
So
that
I
we're
took out
watching
my
is just a
cell
strength in
phone
overall premium travel,
and
Expedia certainly has some exposure here.
messaged Jim and I said,
we're
"Hey,
watching a bit of an acceleration. So
did you say it's
if you
spinning
look at
top
this,
with
this is
Inside
not
Harmony?"
typically, you know, this
I said,
seasonal
"What?"
boost right now where we
And
are
the
in the
next
year.
candle
We start to see things really hit annual peaks
had an
in the
inside
summertime when
spinning
consumers are
top.
traveling, but we do see some nice momentum off of a strong
Ooh,
holiday
man.
season. So we know last quarter Expedia had a pretty nice quarter, beat expectations. Stock had a nice reaction, and we're seeing signs that
Boom.
it is carrying this momentum
All the way back up to the
into
50.
new year. Certainly
Uh-oh.
the bar is higher though, so we'll be watching this
Uh-oh.
over the next month or so. to
Can
see
we
how
have some
things
profit
play out,
takers here
but
today,
as of
please?
right now, we're seeing some
May I
nice
have some
momentum
profit
into
takers here
2026.
today, please?
Megan, when you guys look at you know the data that you guys have, you've seen some improvement from Expedia. The stock's up.
Ding.
53% from Virgo level, so it's had a good run.
350.
Looking over
Heart
that
attack.
time, but is this, according to your data, do you guys see this across the
How
travel
the hell does he
industry?
do it?
Because we've seen a lot of these
Randy.
stocks, whether they're cruise lines, airlines,
Take that to
travel
your
companies,
dentist.
hotels, they're doing all pretty
Tell him
well. At
clean
this
that
point.
cavity
Is
out.
this just maybe a reflection on what's going on with the economy as a whole, where, hey, people aren't going to pull back from traveling at this point?
Yeah, I think that we see overall some resilience in consumer spending. We see some prioritization of experiences at large. That's a theme that we saw emerging in 2025, and we see it continuing in 2026. But I think we also look at, you know, the brands that are performing the best.
Down the street with his old washboardjim, got a sneaky snake goes boom 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 boom, sneaky snake boom 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 boom, sneaky snake.
Coming back down to a 1, 2, 3. Doo-doo, doo-doo. Yeah, that's right. That's right.
Is trending about 13% higher on a year basis than last year. Last quarter, that number was about 10%. So you're seeing that continued momentum here, that continued improvement. But again, we are, you know, we're dealing with a higher bar than we were last quarter. So we'll see how things shake out. But it is promising on our end to see names like Delta and like Expedia that for now that high-end consumer is still able to do the heavy lifting. And so it'll certainly be interesting to watch in the coming months to see how that plays out and where that bar of expectations really sets when the company reports earnings.
That's kind of what I was getting at. They report earnings on the 12th of February. I mean, the stock's just off all-time highs. I mean, you look at the last year, it's getting a little frothy here. Would you guys be buyers, or would you wait for this maybe earnings event?
Yeah, we're probably going to wait a little bit. I would see a sustained or a bit more of a pullback that might make a bullish play more enticing. Right now, I think our signal falls upright into neutral. So we're acknowledging that, the share price is risen and our data definitely supports that. But at this point, we're starting to bump up into a pretty high bar of expectations. So a little bit cautious here. We'll see what the market gives us heading up in the next month, 2 earnings, to see if we start to see a bit of divergence that we would play to the upside.
Megan, it's been a great chat. I have a love-hate relationship with these segments because it just you want to open your tab and start perusing, don't you? Where can I go this year?
I really can't see it dropping unless the Iran deal, geopolitical.
Approach as far as an example trade on Expedia.
Yeah, as I mentioned, just hit all-time highs, above $303 a share. So I wanted to be a little more passive, and I mentioned that earnings event on the 12th. I want to avoid that earnings event. So if you have an assumption going into the earnings while avoiding it, this strategy may take advantage of it if you're maybe neutral to bearish on this one, where, hey, I can be wrong and the stock can still go higher, but I can still potentially profit on an example trade like this in Expedia. So I went out to the February 6th weekly cycle here, Sam. So just a few weeks to expiration on this one, 3 weeks. Selling the out-of-the-money 300 strike call. It's out of the money by about $11. And then against it, because I want to stay risk-defined, because anything can happen. This is a high-price stock. Buy the 310 strike call. So a short $10 wide neutral to bearish call vertical, you're going to collect roughly about a 240 credit. Might be a little bit lower than that, maybe around 210 right now. Stock has come in a little bit. But if you collect a 240 credit, that's what you can potentially make. $240 per spread with about $760 in risk, but that's all the way above the 310 level, which would be a new all-time high. Now, your probabilities of that short 300 strike being out of the money at expiration, that's what you want, because you've got a lot of risk to make less, right? But the reason is because you've got a better probability of success. That 300 strike's got a probability of nearly 70% that it'll be out of the money at expiration, which is what you want on a trade like this. So maybe taking the opposite side. They said they might be neutral like Folio, but this avoids that earnings event. I think that's key. But looking maybe for some further consolidation, maybe a further pullback. But hey, even if I'm wrong and the stock goes up to 299 or 300, I can still potentially be profitable as long as it stays below that break even of 302.40 to the upside here, Sam.
Okay, good look at Expedia today and across the sector as well with consumer sentiment and travel.
Not a bad day.
Coming up, it's time for the breakdown. We'll look at Seagate after an upgrade today. We'll be right back.
Dude. Oh, I need to. That'll probably be a good letter to get it. No, I gotta wait a month for my physical.
Stay connected to the markets, the Schwab Network. Tune in 24 hours a day,
for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand.
Oh, what we got here? Nice. Here we go.
Start learning today.
Right when I get ready. You can't trust this market. You really can't. It's been proven.
We're fairly muted, fairly range battle in these markets for this Friday. The S&P 500 is aligned to the upside. Dow Jones is moving in the other direction by about a similar amount. NASDAQ on the line to the downside as well. But we've got this Russell 2000 outperforming here as we continue to see this broadening out of this market, this rotation, and really we continue to see this push and pull beneath the surface with technology up. You've got industrials up, financials up, but we do have communication services, utilities, and discretionary lower on the session. All right, let's get to our next stock. Seagate higher today after Susquehanna upgraded the stock to neutral, raised its price target to $280. That is up from $150 in the nose. The analyst says its negative thesis on the hard disk drive industry has proven incorrect. Susquehanna expects strong growth trends in Seagate for years to come. So it is now time for the breakdown. So let's get to George Sillett, senior markets correspondent. George. Thoughts on this note? I mean, so nice of Susquehanna to join the party here. You wonder why it took them so long to prove themselves incorrect, but just walk us through your thoughts and obviously the reaction here.
Yeah, I mean, this is interesting. I think, you have to consider what they had said in the past relative to their movement now. They're still relatively conservative, irrespective of the fact that they upgraded the stock to neutral from negative. Their price target is still below the consensus median target. Their target is now 280 from, as you mentioned, 150. Consensus is around 3 1/4. 325.
Come right down to a 1, 2, 3 on that triple.
I can see their point, and this is one of the challenges with companies like Seagate, Western Digital, SanDisk, which we know all have moved higher. Seagate itself is higher by 250% over last year. Micron also in the DRAM and high-performance, high-bandwidth memory space. All these companies are deeply cyclical, and they're very challenging investments over long periods of time. But looking at what's happening from a demand-centric standpoint in the storage and memory markets, both the PC servers, data centers, high-performance computing needs, hyperscale demand build-outs, all these factors are huge impetuses to these names. But at the same time, again, I can see why Susquehanna was behind the curve, because just based on the nature of these businesses, which are again deeply cyclical, they can present some challenges, especially if you're chasing large-scale returns to the upside in these names. If you do look at the earnings estimates for Seagate in this coming next year, the estimates are around $15.50.
Gosh, and then you come back.
3% higher than the current fiscal year, which is still expected to be $11.62. And this number itself is actually double where it was last year. So there's clearly demand for underlying storage technologies across the board. That has caused prices to move the upside. But at the same time, I can also make the
Always keep an eye on the clock. When you see an eye for something, just automatically look at the clock and say, okay, it's such and such time, and then because there's different cycles to the market every day, I think, when it comes to trading. It's like right now, I really want to buy this for the rest of the day and just sit on it. Right here.
These rallied,
Real bad.
triple digits last year, some of these names. And obviously then you've got some of the South Korean counterparts also coming out and talking about, 70% price increases in Q1 as well. You know, I'm just
For $2,
wondering with
I'd grab a couple
supplies, higher prices as well, and
and
all
just
of
walk
this
away
demand that's coming from AI, and you know the data centers really sucking the
and see what
oxygen
happens.
out of this. What you're seeing as far as that
185.
bifurcation between the memory and say some of the more sort
Okay.
of hard. The
Badass is
stocks,
spoke.
because I've seen a lot of notes out discussing how this could have that sort
If
of
you don't know who I am, I am
Washboard
Washboardjim,
price increases there for your handsets,
the founder of the double triple bottom here, quad bottom.
Well, I think that at the end of the day, if you look at PC prices, they've been rising. as a function of
69
memory
60s
storage.
at
So
$2.
they're increasing prices over time. I
190.
think it's interesting right now. There's a huge bifurcation technology-wise. If you look at,
I got two of them.
the larger
$2 and
Broadcom,
190.
NVIDIA, they actually have not traded very well in the last few months. In fact,
I'm
I
just
looked
gonna
at
walk away.
NVIDIA yesterday.
If I lose it, I
It's
lose
really
it.
at these levels we saw back in August of last year. So it's still effectively in a trading range, but nonetheless, within the context of the verticals, memory and storage have taken up huge movement.
Yep, SPY under
because of
VWAP's
the
not a good sign.
Supply constraints, higher prices, demand, because at the end of the day,
Let's see if we hold this
artificial
support.
intelligence, queries need
This is a major
access
support.
on the edge
If
cloud
not, I should just stop
networks
out.
that, again, these
Probably
memory
best
storage,
bet.
companies
I
are
think this is a
supplying the
major
marketplace.
support.
So the other side is software too. It's kind of interesting as well. Software has not performed well at all in this last year. Salesforce, Workday, ServiceNow. So my point is there's a huge bifurcation in this market, and again, right now there's still huge demand and pricing power in the memory and storage space, and that's why Seagate and Micron and even SanDisk. This could
Brian
be the
Jim
upside.
Bro.
They certainly can move even higher from here, but you have to be mindful, and this is again why. I could see why Susquehanna has presented the case that they're still more neutral in that context, is because once the cyclical peak happens in these names, they can retrace quite aggressively. So again, be mindful of potentially, stocks falling on really good news, perhaps coming up in the next quarter or two in terms of earnings.
Well, the next major support is quite a drop. 69.39 something.
Break ground on another facility upstate New York, and
So I stay. Give it just a little bit more time.
To add some capacity here. I mean, you just wonder
Unless we do have the drop.
They can bring that online, if it's going to be in time to try to meet some of this demand that we're seeing right now as well.
69.40.
Look at the software semi spread.
That'd be your next support level.
So yeah, you raised a really interesting point there. Thanks so much for getting us across that one.
I don't want to hold it all the way down there.
Now, to give us an example trade on Seagate. So what's the approach here, Tom?
It's
big of a
not a
drop.
head scratcher because George mentioned this is a cyclical type of sector.
So I asked myself, do I get out here at even, or do I hold the position?
Based on a lot of pricing, right? But now we're in a super cycle for memory names, whether it's Micron, Seagate Technologies, Western Digital. Seagate's a little bit more on the
and
legacy side
Esther,
of the business with the
would you
HDDs
come over to my
and
room for a second and watch Washboardjim on YouTube?
Demand's through the roof. TSM's earnings kind of
He just jumped in this trade at $2 and 190, and it's at $2.15 right now.
Stock's up over 240%.
He's got two
from year-ago
contracts.
levels. This stock was trading $63, Sam, in April of this year when stocks kind of took a dip here. So
He's a big
it's had a
dog.
great
This
run.
guy's a big
With
player.
that in mind, I think a lot of people go, well, I don't want to buy it here, or I don't want to get into this stock, or I don't want to trade it to the upside here just because of the rally that we've seen. But the demand's still there, and they continued their valuations. They're growing into
And
those
Esther,
elevated valuations.
would you bring
So I
some
looked
of
at a
them, some of
strategy
them
that's passive
mashed
because,
sweet potatoes
and risk
too?
defined. Remember, this is a $330 stock. So I went out to the January 23rd weekly cycle. Now, why did I
Let's go.
pick that series?
Not that
for
way.
This example
After this
is
trade,
because they have
Washboardjim will
earnings
be going to
on
eat.
the 27th, and I kind of want to avoid that earnings event, which might be a big mover as far as a percentage or dollar cost basis on that. So I went out to the January 23rd weekly cycle, just 7 days expiration, and I'm going to sell it out of the money neutral to bullish put vertical.
See, we're bearish right now.
Kind of
This
the
is not a
flip-flop
good time
of
to
what
be
I
in
had
this trade.
Expedia, where I'm selling some puts on the downside, put vertical on the downside to take advantage of some consolidation, a move to the upside, or a move to the downside, but remain above
This
the
is
short
triple
strike
bottom.
put vertical, selling the
We need to
310
get above
strike
that
put,
bar
buying the 300
before we
strike
start
put,
becoming
short
bullish.
$10 wide, neutral to
And
bullish
get above
put
the
vertical.
200.
You're collecting roughly about a 210 credit on
EMA.
this. That's what you can make. The credit you collect is what you can make on this trade. If you collect that 210 credit, you got $790 in risk, but that's all the way back below the $300 level. I think one
No,
of
the
the
bald
keys
head
with
guy's on.
high-priced stocks like this.
Get
and
out
big
if you don't feel
movers that we're
comfortable,
seeing,
because it is kind
stay
of
risk
risky.
defined, right? You want to know what your downside is going in to any of these
Positions.
positions. If I collect that 210 credit, takes my break even all the way down to 307.90 to the downside. So I've got that cushion before I start getting hurt on this trade. I've only got 7 days in the position. The probability that short 310 strike in this put vertical will be out of the money at expiration, which is what you want. About 68% probability that will be out of the money. So we always talk about the trade-offs. Well, the trade-off is you're making less than what you're risking, but you've got a higher probability of success, where if the stock even does pull back to 310, I can
We're at
still
the
be
21.
neutral to bullish, short put vertical, Sam.
225.
Okay, good look at Seagate, an example trade for us now. We're trading about half of that, 1% higher. Although we do have Western Digital standards lower on the session. Really appreciate it, Tom. Thanks for putting up with me today. Really enjoyed it here at Fast Market. I'm Sam Butler, sitting in for Diane King Hall. Stick around here at the Schwab Network. Next Gen Investing is coming up.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With
Dar.
And trusted financial journalists. Streaming
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Hey, Bob. Last year, my dad had a stroke. Big shock to see this person that I've always seen as a force in our family be vulnerable.
Wait, I had a stroke?
Yes. Now we're in the car together almost daily. I started to realize, what can I pick up from my dad? He's been with Schwab for a long time.
Jim, my financial consultant, I programmed that 20 years ago.
Don't take advantage of that, old man.
Any questions I ever have makes a huge difference when you have someone that actually cares.
I don't trust your kid.
Actionable data and market-moving analysis. Schwab Network connects the headlines to the why in real time. Watch free 24/7 at SchwabNetwork.com.
Marley. Well, there's the knife. Dig it. I'm gonna drop the bucket on that one. dude.
Welcome to Next Gen Investing and happy Friday. I'm Jenny Moore coming to you live from our Chicago headquarters. As we close out the week of trading, and remember, of course, markets are closed Monday in observation of Martin Luther King Jr. Day. Here's what we'll be focused on throughout the next hour. We will run through several of today's analyst calls, kicking things off with the broader rotation we're seeing right now away from tech heavyweights into some of these smaller to mid-cap size stocks. And then we'll discuss the latest technical levels to watch in two of our Mag 7 names, Microsoft and Alphabet. With Microsoft actually higher today, but not pacing to close out this week down just shy of 4%. Alphabet did touch a new all-time high earlier this week, but has since seen some overall weakness right now, also trading modestly lower by about 1.3%, but still actually slightly higher for the week. For FOMO, we will revisit the continuous outperformance we have seen from these data storage suppliers and memory chip makers. Seagate Technology higher again today, and as we've seen, it's last remaining skeptic from the sell side, now actually waving the white flag and turning a bit more neutral. Continuing on with our tech focus, though, we'll dive deeper into 2026's expectations for AI, as we'll also discuss the IPO market and just overall fundamental expectations.
It came back pretty fast.
Ending this Friday on a bright note with David Buster's with benchmark analysts calling for positive same-store sales in its first quarter, breaking its losing streak for 13 consecutive quarters. But now let's check in on the markets and right now how we're faring, as we did kick off the session on a pretty bright spot. We gave then all of that back, now seeing some of that pressure easing in real time, as we are basically unchanged, and S&P's now. Dow's also pretty much unchanged. The Nasdaq is the laggard of the group, but modestly down about 0.1%. The Russell 2000 continuing to be out front about 0.4%, almost 0.5% now. So as we check in on where some of the strength is being seen, it's interesting because the heat map today, frankly, does not give a great indication of really any pocket of strength, as you're seeing still. Again, Alphabet being a major drag, NVIDIA higher today, now up about 0.4%. So that is also helping ease some of the pressure that we've seen again trickle into these markets intraday. But we're also still seeing some more firm footing in the financials, which of course would be the big drag on the overall markets earlier this week. Like JP Morgan today, a pretty bright spot, all things considered. But now
Very
we
good.
dive into some of the latest market action and everything driving some of the mixed performance today. I'd like to welcome in Kevin Green, Senior Markets Correspondent for the network. And so Kevin, first and foremost, wanted to get your thoughts on some of the volatility we've witnessed in just the first few hours of trading today, and really what stuck out to you when you look back at the week that was.
Well, good morning, Jenny. Yeah, I mean, at the end of the day, we do an options expiration, so a lot of activity happening in the background on the institutional front. And I think that's probably why we're seeing a lot of this intraday volatility. And you're right. I mean, when you're looking at the sector performance right now, we have real estate kind of leading us to the upside, up about 1%, which is a little bit unusual. We also have financials kind of reclaiming some of the losses that we saw earlier this week, and then industrials, which I know we'll kind of talk about that a little bit later. But overall, we have about 44% of the stocks in the S&P 500 in the green so far. And we have the 10-year Treasury sitting at around 4.21%. That's the highest level that we've seen since September. And I think that's also probably giving us a little bit of hesitancy when it comes to trying to get that 7,000 level in the S&P 500. Let's see how the market actually responds here after the breakout to the upside when it comes to yields. So overall, I think we should still expect some fireworks over the next couple of hours as we go into the close. But it's not a bad day for the intraday trader out there.
It's not, and I would say definitely looking a bit better than it did perhaps an hour or two ago. I just watched the markets really tumble. I was just looking at NVIDIA in real time just to erase all of its strength. But as we dive into some of these analyst calls today, I know that you've been an advocate for some of the strength that we can still see from some of these smaller names. And I think the small caps have become more and more interesting to the overall narrative of this market. Not to say we're starting years by any means a small cap, but Monster Beverage, not, I mean, like tech heavyweight by any means. And actually, to really give them credit, this name's been on a phenomenal run. BNP did actually upgrade shares today. I know there are a laggard of the group, but this has been, I mean, a technical outperformance that I think many would not have seen coming.
Oh, I gotta get gas.
Yeah, I would agree with you. I mean, it's a stealth mover to the upside, and sometimes these are the best stocks to kind of look for in this market that have relative strength compared to the S&P 500. Obviously, they did have a little bit of a bear case when they looked at the stock earlier, which is why they had that underperform rating before adjusting it. They believe that they could see some market erosion. We know that there's a lot of competition within this space when it comes to energy drinks and things of that nature, but they do believe now that they have favorable pricing. And Jenny, we might also see input costs for them to also kind of stabilize here. A lot of these metals like aluminum and things of that nature have run pretty aggressively to the upside, but maybe we are going to see that kind of roll over, and that could actually be a tailwind for them here in the near term. We also have a situation where we could have monetary and fiscal policy that's a little bit more favorable for the consumer, which can also drive sales. So from a technical standpoint, this chart has been making higher highs and higher lows. You get a little bit concerned if we see a break below that $70, which is about $7 away where we are at right now.
Okay, I'm gonna go get me a lunch.
Here's an announcement that we'll get from this company in the next couple of weeks.
Looks like I'm coming back here. I'm still in this.
That is a great point about its overall valuation. That was actually still mentioned by this analyst in this call, saying that the U.S. market share erosion and valuation are right now, that was really what predicated their bear thesis, now taking on more of that neutral sideline approach here. $77 price target, I mean, doesn't
Need to get out now, or?
any further optimism, but they did at least note this more favorable demand and elasticity to their pricing. So
He gave me a little gift.
and overall, just think of, hey, this name's outperformed everything with any sort of aluminum or steel.
We're at the pivot point.
Of drag for Monster Beverage earlier in 2025, but they have shaken that off quite well as a lot of these beverage exposed names have not seen this same strength. So high after high for Monster Beverage, a name after my own heart. I always have to give
Got
them
4
credit
contracts.
where credit is due. But our next same day, HPQ with a downgrade.
Could sell
These average shares to underweight from equal weight. Price target was also reduced to $18 a share from $24. I mean, the pain has been felt by HPQ, KG. Is this warranted? I mean, we've seen more and more analysts trickle in and say, get out of this name, and there's other names in tech that are just more consistent and reliable right now.
What are they, baby?
Looking at it from a fundamental standpoint, you can innovation phase that Barclays has right now. There has been some headwinds in terms of the PC market as well as the printing market as a whole. The PC market, we just have not seen a real refresh pretty much since COVID-19, and I think there's been a lot of optimism of artificial intelligence and these CPUs that they can put into a lot of these laptops and computers and things of that nature is going to drive a lot of the demand. We are just not seeing it right now in the market. Now, they also have printing exposure. We know that has been kind of a dying business over the last 10 to 15 years or so. Input costs as well as going up on printers, especially if we're looking at printer ink. I just bought some like 2 days ago, and it was like $40 just for some printer ink, which is actually crazy here. But obviously, we do have some cyclicality, some issues, and some pressure.
25, yay!
That being said, technically speaking, if the stock is down around $16.50,
230.
Jenny, you could make the case that that's the consolidation low.
69.60s.
A lot of the stocks that we have seen outperform over the last 2 weeks have been trading at their COVID lows, and buyers have been able to step in here. Maybe that's going to be an opportunity for HBQ here in the near term, but at the end of the day, their legacy businesses have been failing, to say the least, when it comes to consumer demand.
Yeah, and I mean, I can speak to that. Like, anytime you ever need any type of like hardware update for your computer, it is so expensive. I know that's just like the theme of our overall consumer world right now, but it does feel particularly egregious when you have to buy something like printer ink, which I do know is so expensive and it's always been expensive, but it's gotten, again, particularly egregious, it feels like as of late. Now, our next same day is Yeti, which is not one I frequent the chart of, to be quite honest with you, but I am floored to see, first of all, near 3% jump today. We're up now about 15% since the start of this year. And I mean, anything that is just resilient, and this is an expensive product. I mean, the Yeti coolers are a best-in-class product, but they're not cheap. So, I mean, perhaps signaling some of the overall themes we're seeing with the K-shaped economy and this more affluent consumer willing to spend. But Yeti, I mean, just frankly astounding me, and also gaining some further traction today from KeyBank. We saw nothing but analyst praise for this name throughout the week. I mean, UBS as well as Canaccord also with some pretty optimistic notes.
Oh yeah, there we go. Jingle bells, he did it again.
back in April of last year, and we have seen the stock move up ever since. The neckline that you're really kind of focusing on, though, Jay, for a true breakout is going to be $53.80. Let's see if the momentum is going to continue when it comes to this name. Now, I don't know too much when it comes to the drinkware space, but I do know that they are very
Ladies and gentlemen,
moms out there. I know that we just spent a bunch of money on a Stanley.
we are at $2.50.
Still strong demand here.
We do have a higher resistance to hit,
product offerings here. I mean,
but I am going out to lunch. I got my trade in.
And their ability to potentially continue to take market share. It is an expensive product, though, but a decent looking chart if you're looking for one of these
Prime Washboardjim.
Breakout here over the next couple of months. That could be the potential when you're looking at this name.
Okay, and I'm so glad you mentioned Stanley because I
Out
have been
before
saying for
everybody
years now
else
that
gets
was
out,
going to be
and then they're
just
going,
a huge threat
"Ugh."
to Stanley's market share. I mean, based on the chart, not really though. Even though you see Stanley's, I mean, like the cup culture is one that I'm not part of. I'm not a water consumer, to be quite honest with you.
Did you
but I do
do
know that people
it
are willing to shell out top dollar.
to
so
me?
Still has not revisited its all-time highs quite yet, but making a pretty nice run here to show that, again, strength of these pockets of consumerism. But last name today, GEV, as we are seeing some news of this Trump power plan. And so this has also been another phenomenal standout. I mean, this name's up now 5%. No, 6% just in today's session after the Trump administration announced plans to lower overall just electricity costs. And I know we both have our eye on the grid and the restructuring.
My girlfriend
and evolution,
just
frankly,
came through
that
the
needs
door
to
and she
happen
heard
to
somebody
the US
singing.
to be able to accommodate, I mean, data center growth.
She dropped her
everything
purse
tied
and
to AI.
dropped her
So
glass of drink
Supernova
and
has its hand
couldn't
in all of
believe.
that. I mean, walk us through
She
your
was
thoughts
like, who
here.
was that?
Yeah, so this is something that has been on the radar for
No,
the
that
last
was the
year or
Washboardjim.
which has kind of been one of the reasons why utilities have been moving a little bit higher, but you could also make the case that the traditional ones were not getting as much love as some of those small modular nuclear reactors. So this deal...
Question is, can we hold support here? Now I sold at 250, so I'm going to take a break. But I think this is tradable. As it comes back and retest the 200 EMA.
To the grid of 13 different states. We don't pay PJM. They just manage
On
the
1 minute
wholesale
time
electricity
frame.
market.
And run back up and fill that
capacity be
to
put
triple
into
top.
the market, so wholesale prices can go a little bit lower. And the additional capacity is going to be obviously brought on by.
I don't want to put gas in the car, but I better go do it.
Energy and GE Vernova provides a lot of those generation products in order to put that power into the market. So you are seeing a lot of those stocks related to utilities as well as electricity just in general moving aggressively higher here. And this is probably going to be a theme over the next couple of years, Jenny, not just months. And we'll see if these prices are going to come down. But the small modular nuclear,
Why it's a little warm.
some of the names like Constellation Energy, they're pulling back here just a tad.
39
bit.
right
The
now.
application's just a little bit different when you're looking at electricity powering a lot of these data centers.
And I think you make a great point. This is not going to be something that we see, I think, in the, I mean, I do think they could still be a beneficiary in the near term, but it's going to be much more of a longer term story as we continue to watch just the overall energy and electricity demand evolve in real time. I mean, it's going to be a massive shift, I think, that we'll just continue to see, as you mentioned, for years to come. So
That's right.
I appreciate all of that insight and helping us break down some of the top movers that we're seeing today, as well as all of the analyst coverage throughout some of these equities. Kevin Green, Senior Markets Correspondent for the network. Appreciate it. Now coming up next, we will dive into the charts and example trades in two of our Max 7 stocks with some different performance today. Actually, Alphabet shares down about 1%, still a pretty big drag on right now the overall Max 7 space. But
Are you overpumping it?
Higher, actually facing close out this week down about 3.75%.
Both of them channels pump stocks, I noticed. But this one doesn't as bad. It at least backs it up with analysis and then technical analysis. CNBC used to chart, but they don't do that no more. So I don't know what got up there, but they should get that back on there. I'd do it for them. They'd have to pay me a good salary, $1 million a year. I'll get on there for an hour a day.
connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something for Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing
Technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you want to catch the latest market action on Morning Movers with me, Diane King.
Anybody stuck in a trade?
At the New York Stock Exchange, only on Schwab Network.
Is anybody stuck in a trade? Anyone need any help in a trade?
Definitely a fade, and I think that the kind of phases that we've seen in this chart were from this quarter to this quarter, we had a nice rally from earnings to earnings. Then, once we hit the earnings in late July, we hit those highs near 555, but from there, mostly a sideways period, range bound between about 495, and some highs mostly were between there and 530 or so. Then, the next earnings event that we had has triggered more of a decline. So we've seen kind of this M-shaped pattern with our double top and with this supportive area that formed around 495 or so. So some pretty clear levels to keep an eye on going forward. For now, though, 448 stands out. Our darker green line here, that matches up with some old highs that we saw here, as well as a subsequent low that we saw during our rally. So that remains a point to watch out for to the downside. Meanwhile, our pattern is more of a falling wedge type shape. Our two trend lines are converging toward each other, both pointing down with price traveling in an increasingly narrowing range here. So we would be concluding this pattern one way or the other soon, because simply we're just running out of room. That doesn't mean that a breakout will happen. We could just travel sideways beyond it. But you'd just be looking for some kind of significant push beyond either of those two boundaries to trigger the resultant cascade of orders and breakout price activity. So now, if we were to look at our moving averages, we can see that after this sideways drift, things have started to take a bit of a turn to the downside. We have our fastest 5-day weekly exponential moving average here in this darker blue color. It's starting to cross below its slower moving counterparts here. So now, notice as well that price is trading below all four of these moving averages as well. They mostly are coming together between the 475 mark or so, around 475 or so. That would be a general point to watch out for to the upside. RSI, our measure of momentum, trending downward still. We've managed to stay out of the oversold area though, so that would have been more of a bearish development, not really a great clear trend line here to encompass our recent price activity or momentum activity on this indicator though. Finally, if we were to look at our volume profile study, we can see that the heavy trading areas that stand out would be here to the downside, right about here near current prices, and here to the upside, which are about 430 here, 455 or so, and about 480 to 490. So those are the standout areas in terms of heavy trading activity.
Okay, and so with a name that, like Microsoft, as large as it is, and just the drift lower, I mean, a lot of times, obviously, we use standard deviations and various, of course, technical tools to measure this, but broad picture here, what really could give you a strong signal that we are seeing a reversal in the recent weakness we've
I'm
seen?
not that bearish. I am, but I'm not.
Well, a strong
got a
reversal
short
type
week,
of signal would be when you see now that we overlay everything on each other. This area here near about 450 or so, we've got some technical indicators that are starting to line up. So if we were to kind of bounce off of that area with a big push on heavy volume, that could be one sign of reversal.
I'm gonna go get my lunch.
But as we look more toward an example type trade, we'd be thinking here for the February 20th expiration. And the reason so is that's our orange box here. You can see right about here. That gives us some pretty clear boundaries that line up with our technical levels. Here near 424 and here near 495 or so. That pretty much is our support and resistance lines that we drew that line up with those boundaries here. So the trading question would be -1 February 20th, 435, 430, put vertical at a 125 credit here. So we've had our downturn. We're coming in near support. We're identifying a key supportive area that the bulls would be looking to hold on to. So here we can see that our max profit on this trade would be our credit received, $125. Max loss, $375. Notice that it's the 3-to-1 risk to reward ratio. Commonly, traders look for. It's a pretty common example type of setup here. Now, the thinking behind this trade would be that this is kind of the last stand before price could fall off a significant cliff. So the thinking would be that the bulls would hold on and regroup and price would continue to the upside. But even if we do fall off the cliff in the coming 35 days or so for this monthly expiration, we have a risk defined, so we could hold on, and the most we would lose would be that 375 figure here, even if things really do start to turn the other way. Break even, 433.75, 5.9% to the downside. Expect to move a little under 8%, Jenny.
Okay, and this would of course then also encompass their earnings, which I believe are expected on January 28th, so that is not next week, it's the following week, but that will be a very busy week, I'm sure, as the tech titans tend to report very similar times, and we know that then our next name, Alphabet, does report on February 4th, so we'll be here before we know it. Alphabet has been a very different performer, though, as we've known. I mean, we saw all-time highs are made earlier this week, and it's had some really strong partnerships. I mean, Gemini is everywhere, and it's also getting huge praise from some of these major executives for being really a best-in-class type product. I will say, if I'm using all of these various LLMs, I mean, they're basically all really just to me the same, but I guess the fact that they're integrated in our lives and they're already ready to be monetizable, that's a huge win for a name like Alphabet, which has been really leading a lot of the Mag 7 strength into the end of 2025 and so far in 2026. So walk us through the key differences, similarities that you see from these names.
I'll be back in a bit.
Somewhat in tandem, and now Alphabet is completely broken out.
Yes, a quick piggyback on your thought. Think of how you can train large language models with everything on YouTube. That's what Google Alphabet owns. Don't forget that part too.
So true.
Exactly. I mean, how many millions of hours of content is that? But yes, a very different chart than we looked at with our last chart here. This one is one that has held up much better than much of the rest of the tech sector. Microsoft is more kind of a typical type of tech chart at this point here, but Google, Alphabet just kind of chugging upwards still. We can see that in this case, our shape is more of a rising wedge. We have a steeper trend line going across the lows, but you could also connect these two high points here to give you this more moderately sloping boundary where, again, our two trend lines are converging toward each other. We're kind of near some possible conclusion either way here, though. But this is typically regarded as more of a bearish type of setup here because we have increasingly anxious buyers and sellers who are remaining more consistent here. The expectation, if you do look for a type of trade based on this pattern, would be that you'd be looking for a breakout below the trend line that's going across those lows. If that were to happen, one area that kind of stands out, 292 or so, a high point here, kind of a breakout point, and then maybe around more 290 to 295 would be a more general supportive area. Because we never quite tested that level, even though we did experience highs a few times around that point. We never fully retreated back to that point. If we were to look at our moving averages, here we can see that in this case, price is starting to slip below our shortest term, our darker blue weekly 5-day EMA that comes in near near 331, so it closed below that level. Could be the signs of a potential early warning for trend shift here. Our teal monthly moving average is just below that 321 or so. That's pretty close to our trend line. So some major breach of this confluence would be noteworthy as signs, again, of potential trend shift here. Our RSI is showing more of a triangular shape here, a symmetrical triangle type shape, more going sideways, where we have a downward trend line and an upward sloping trend line here. So momentum's still pretty high, but we are on the verge of breaking below our green trend line here, and we are out of the overbought area. So a bit of a cooler reading on this momentum indicator. Finally, if we were to look at volume profile, we can see that our heavy nodes, one is right about here near 320 or so, and one is right about here near 280. Those are the big standout areas here. Notice as well the very heavy volume, all the volume spikes here after we had our big push to the upside recently, suggesting heavy conviction on the part of buyers. So this area, again, remains a key supportive point to watch out for going forward, and whether we remain above it if we do get our downside breakout.
And I will say that I know that we're lower today in alphabet shares. I'll be curious to know where we close though, because as we watch markets in real time, we're actually now green in all four of our major averages. I'll be very curious to see where alphabet closes. It's one right now where that dip buying appetite is still very readily available, and it helps that Wedbush's Dan Ives also gave a pretty positive note earlier today on these U.S. big tech names into earnings. So with that being said, as you think through now trading alphabet for example purposes, I'm sure a bit different than how you're looking at things for, say, Microsoft.
Right, so if you did have perhaps more of a short-term or kind of neutral outlook here, as I said, we've been really taking a strong push to the upside here. Things are starting to slow down a little bit. We've had a chart that's held up a lot better than the other ones. And if we do start to perhaps make a consolidated phase or a downturn, this would be a trade that would be targeting February 20th, 35 days out. That's our orange box here. You can see that these levels near about 355, 360 or so, and down here near about 300. These line up with some other of our technical indicators here. For one, we have our quarterly EMA and our linear regression line, our line of best fit based on closing prices. Those come together. So it's an idea of kind of fair value in the longer term to the downside there. Then below that, we start to get our heavy support. But to the upside then, we have our plus one standard deviation channel. So one standard deviation above that linear regression line then lines up with the upper edge of that expected move. So kind of this gives us a pretty easy set of boundaries to think about when we're structuring a trade. In this case, the trade would be -1 February 20th, 360, 365, 300, 295 strike iron condor at a 175 credit here. So we're selling a call spread at 360 and 365 to the upside. We're selling a put spread to the downside, 300 and 295. So this gives us two break-evens. Then we want this trade to be more neutral. We want price to kind of stay within these boundaries here. 298.25 to the downside, 316.75 to the upside here. So roughly about 9.5% or so to the upside or the downside. Expected move 10.8%. So a tiny bit bigger than that range here, but you know, it's all proportional. The risk and reward kind of lines up more attractively around this general point. If you go too far out, you have a large amount of risk without collecting too terribly much credit at all here. So our max loss 325. In this case, we're more like 1 to 2 roughly in terms of our risk versus reward here. 35 days out, you know, for this particular more neutral type of trade.
Yeah, and some duration also with this trade is, you know, as you mentioned, 35 days out, so a bit more longer term than, you know, just looking at, say, like an earnings pure play, utilizing that first week of February. So have a bit of time to see the dust settle and maybe parse through all the volatility that we're expected to get, at least from the next several weeks of earnings. But appreciate that, Rick Ducat, for all the technical help, as well as breaking down some example trades today in our Chartmaster segment. Now, coming up next, we'll discuss another pocket of strength that we are seeing in big tech, and that is everything tied to memory. We're continuing to see these memory chip makers really take off. We're seeing technology right now is up 16% so far this year, and adding to that strength today, up another percent after a Susquehanna pretty positive note.
for instant reactions, earnings breakdowns, and hot takes that teach you about stocks and markets. Follow me on X at NPetalides and connect with me, Nicole Petalides, on LinkedIn, Facebook, and Instagram.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me. And my advisor, Jennifer, she was with me with the journey, helping with the estate distribution, the two grandchildren, planning for their college educations. Someday it'll be their turn.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on the guidance. I'm not saying a rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Welcome back to Next Gen Investing. It's now time for FOMO. Today we're looking at really the hot spot in tech right now, and there's everything tied to memory as well as hard to disk drive flyers and anything with really exposure to that high bandwidth memory, which is, I mean, our real leaders of the space right now, Micron, Seagate, and as well as Western Digital. I mean, they just continue to outperform. And joining us, of course, is Marley Caden, host for the Schwab Network, for some insight on what's driving some choppiness, I will say, because it's not necessarily being widespread. We know that there's more volatility in Sandus, but now seeing some of that earlier strength of race, and so there's definitely volatility still to be had. But I mean, you look at like Seagate and Micron, I mean, they're real standouts right now of the broader tech trade.
Yes, certainly. And there's a reason behind the Seagate move. We also saw a nice upside move in Western Digital as well. They've since given back some of those gains in this choppiness that you mentioned, Jenny, but it's coming off of a new note from Susquehanna that removed the last holdout, the last bearish analyst on Seagate into neutral territory. So now no sell or sell equivalent ratings on Seagate in all of the companies and all of the firms that cover it. Now they're saying that demand for the company's hard disk drives, our favorite thing to say, is just that strong. It's so strong that they basically issued this mea culpa note out of Susquehanna. They said they moved it to neutral from negative, new price target of $280 for Seagate. That's up from $150. Now it is trading at $323 right now, so it is to the downside, but a significant pickup from where they were before. The mea culpa comes in the form that the firm says its negative hard disk drive industry thesis has proved incorrect. They just came out and said they were wrong. They also went on to say that Seagate has executed quote-unquote near flawlessly on its heat-assisted magnetic recording ramp. That that migration to that newer technology is forecast to increase capacity per drive by 30% according to Susquehanna's analysis. As a result, even if average selling prices decline from these current heights that we have them at right now, they say unit costs should decline and profit margins should expand. So for Seagate, we are seeing them still holding on to some gains. They're up about 0.8% right now. Was higher earlier in the day, but we've seen some seesawing in the space. Western Digital also a part of this note, citing those same things, that incorrect negative outlook thesis on hard disk drives. They reaffirmed their neutral rating. They were already neutral. New price target, though, of 205, up from 135. Western Digital is under some pressure. They're down about 0.8. Susquehanna is saying they see the total market for high-capacity hard disk drives growing at about 25% annually, Jenny, through 2028. So that's where some of this optimism is coming from. That previous estimate for them was 20%. They say that next peak in shipments won't come until mid-2027. But it's important to note, I think, whenever we talk about these companies and you cited the volatility and choppiness we've seen, is that data storage is notoriously cyclical. This is a very cyclical industry, so it does leave a group of sell-side analysts who are wary of the eventual downturn. So the fact that we saw Susquehanna back off of this and be no longer there are no bulls on Seagate, there is still one on Western Digital. Baptista Research has an underweight rating on the stock, but that stance is obviously getting lonelier as we see these memory stocks just shoot sky high. We saw Seagate up 219% or something in 2025. Western Digital was a top performer in the S&P 500 last year. They were up 282%. Year-to-date, up 27% for Western Digital. As we look at Seagate year-to-date, just in 2026, we're talking up 18%, and we're just a few days.
I know. I mean, you look at some of the outperformance of these names, like speak to that. I mean, Seagate now on a at least 52-week basis up 240%. Micron also up another 245%. Western Dig up about 353%. I mean, these numbers are ridiculous. And I believe Western Digital was one of, I think, the S&P 500's best performer last year. Yeah, so I mean, just continuing to see that strength trickle into this year. But then I tend to have skepticism because we know it's constantly in rotation even within this tech space. I mean, is there any, I know this was the last real standout or holdout of that more bearish conviction from Susquehanna today, but is there any concerns about valuation? Because I have heard whisperings that, these stocks have become very expensive.
Sure, I think there are always concerns about valuation, especially in this space, especially if we've seen the run-ups like we have, these triple-digit gains in a 12-month period, obviously lead to that. But I want to throw this into the mix of this conversation. You mentioned Micron hitting that new all-time high. That is in part because an industry veteran, a former Taiwan Semi executive who's on the board at Micron, actually just bought up about $8 million in additional shares. And to buy $8 million more in shares, Jenny, at near all-time high prices only indicates an extreme level of confidence both in the company and also more broadly, I would argue, in the space, because you're not going to buy at a high. This is not a buy the dip opportunity here. Micron was already sitting near all-time highs. They just moved higher now to a new record high on this move after Mark Liu bought these shares, but clearly implying that he thinks that this rally has legs.
Absolutely, and I think what's so interesting also about this entire story is we've seen, the clear benefit from this insatiable memory demand from, companies that are, it even benefits, some of these smaller ancillary companies, but the lack of participation from NVIDIA, which I say that tentatively, I know it is slightly higher now on the session and still on the week, but NVIDIA has, of course, direct exposure to these memory chip makers as it's a huge component of its products, but yet NVIDIA left out of this conversation because it's more of that GPU data center type player. And that's what I think is so interesting, because everything goes hand in hand, but you're going to see, I think, again, these emergent pockets of strength that just continue to generate favorability and, again, have this dip buying appetite that we're just not seeing in NVIDIA anymore.
Well, I think people keep waiting, right? They're waiting for the dip to come to get back into some of these names, like particularly SanDisk. We've seen, I think SanDisk has been one of the best performers of the year. Let me pull up their chart. But you know, right now they're up only 1%. Year to date, they're 70%. I mean, year to date in 2026, we're in mid-January. What is it, the 16th?
I know, I had to check my platform to make sure I was actually seeing that number correctly, because I was like, something must be wrong, it's supposed to be a glitch, but no, I mean, it's amazing. It's been, I mean, really since we saw last, like early January, it has been basically a straight shot to the upside, ironically, of course, the exception being today, as we're lower despite all of the enthusiasm tied to the rest of the space. But it's been a fun area to discuss, as it's been so consistently bullish, and I do appreciate the analysts now waving a bit of the white flag, saying, we're no longer taking on this bearish thesis. I guess price won here.
Eventually, I think when the bandwagon starts to get that full and there are no seats left, people start to jump on. I mean, it's like George Tillis always says, you don't fight the trend. And clearly there is a trend in these memory names right now, and that trend is to the upside.
I know, and I understand the concern over valuations, but you look at some of the standouts in the market, even outside of memory makers. I mean, like Palantir, CrowdStrike, they have high valuations, and hey, you went with that mindset, you would have been on the wrong side of price for just, I mean, several years at this point. So really appreciate that, and great conversation surrounding the hottest spot in tech right now, everything related to memory. Marley Hayden, host for the Schwab Network. Now coming up next, we will continue our broader AI discussion, as well as dive into some of the expectations for IPOs in 2026, as well as just broad-based fundamentals.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please. But there's a Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab. Schwab, a modern approach to wealth management.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Welcome back to Next Gen Investing. It's time to discuss some of the trends we're seeing in broader AI, as well as expectations for 2026 from an IPO and fundamental standpoint. As we know, tech has been one of the most scrutinized and also just heavily followed areas of the entire market. Now, as we approach the new year, a lot of expectations have been reset, and we've seen different types of outperformance from varying spaces, like, of course, what we just discussed, everything tied to memory. But for some more insight on this conversation, I'd like to welcome in now Jeff Rinzel, founding partner and managing director of Fuel Venture Capital. Jeff, thank you so much for being with us on this Friday. Really excited to get your thoughts here on how you're parsing through all of the hype with AI versus finding that actual value as we, of course, go into this year with new expectations for new volatility.
Yeah, well, thanks for having me on, Jenny. It's always good to be on the show. I think it's a great question. I think lots of investors are actually focused on that right now. We believe 2026 is simply the year that AI is going to stop being a story and it's going to start being a business. I think you just said it just correctly just a few seconds ago. The last 2 years have rewarded ideas, and the next 2 years is going to reward revenue, adoption, defensibility. Investors are looking for real value. That value shows up when AI is embedded into companies that are leveraging the technology in their workflows, in their infrastructures, and most importantly, cost reductions, not just demonstrations.
So do you see any risk to that? Because I know that right now the concern is the ability for these companies to monetize a lot of the expectations that they promised for like years to come. I mean, do you see any risk for supply chain to be continuing to execute, as well as just these companies actually showing proof of where this mass CapEx is really going?
I think a great example, just in the last 48 hours, Jenny, right? All of our iPhones, all of our feeds coming in on Replit. If you're familiar with Replit, they're raising it a $9 billion valuation right now. That valuation isn't about hype, which is what you're referring to. It's about millions and millions of developers around the world that are using AI every day to build. Usage in AI at scale creates gravity. Gravity creates value. In all of investing, doesn't matter if it's public or if it's private, if it's AI, whatever it is. So I think that investors just have to be careful. I think by the end of 2026, it's going to be clear. We're going to understand which AI companies are real platforms and which ones are just PowerPoints.
Yeah, and I do want to switch gears now into some of the broader U.S. economic news that we're seeing. I mean, private markets right now, are you seeing that as an area of potential innovation and further growth in this new year?
Yeah, well, that's the $1 trillion question, right?
Right.
I spent 21 years in the public markets. I left to come into the private markets because I thought that it was just multi-generational wealth building for me. So I think that today the most important innovation happens long before a company goes to New York to ring the New York Stock Exchange bell. Right? Companies are staying private much longer than they ever have before. They have capital, they have talent, they have global scale, and they don't have to deal with the public scrutiny. What that does is it creates shifts in the creation life cycle from public investors to private investors. I think the biggest insight from an investor's perspective in 2026 moving forward over the next 5 years is the big question: do I have access to get my fair share?
I definitely think that is something that's, again, this is the $1 trillion question, of course. And curious your thoughts on the IPO market expectations now into this year, as we did hear some pretty positive sentiment from the big banks. I know it wasn't necessarily a straight shot to the upside by any means as far as earnings reactions this week, but like Morgan Stanley was one that signaled a lot of enthusiasm tied to all things M&A, and I think that is definitely being maybe underappreciated right now in this market. But for IPOs, what are you watching and what do you expect to now go of course public in 2026?
Well, first of all, we've all been waiting since 2022 for the IPO markets to come back online, right? So anytime someone like Morgan Stanley has positive things, I'm a buyer in all of that. However, I don't believe that IPO markets reopen all at one time. I think it opens up with leaders. There's, I think, somewhere around $3 trillion of private company value that's just waiting for the right window to go public. I think the dam breaks when one or two category-defining companies go public successfully. You just asked the question. We have companies like OpenAI and SpaceX that continue to signal that they're going to go public. That resets confidence, and that's once that confidence hits, it's the permission for the next wave to really start. And to your point, we do have some macro concerns economically that we have to keep an eye on. There's a lot of craziness going on in the world, as we all know. But I'm a big believer that markets should move on earning visibility, not on headlines.
Okay, and we know that there's a substantial, I'm saying also just backlog of companies that are expected, or at least maybe hoped to go public this year. Some of these include like SpaceX, OpenAI, Anthropic. Is there anything in particular that you are set on watching or sort of predicting when they could actually go public?
I think OpenAI has been very confident, and I really do think that is a high probability that it's going to go public. Anthropic is the second in line. SpaceX, I think we're all kind of waiting for that. But we also know that Elon isn't necessarily the biggest fan of the public markets. I know there has been talk. I have not yet seen the actual listing. So until I see that, I think that I'm cautious on it. Obviously, the whole world is waiting for that. be something. If we see SpaceX, OpenAI, and Anthropic all go public in 2026, it's a mic drop. Just hold on to your head, Fred, because it's going to be a huge starting of the IPO markets, which we've been waiting for quite some time.
I mean, I even think Tesla, we heard whisperings of SpaceX going public. Even Tesla benefited from that because it's basically just right now a read on Elon Musk and all his companies. So that will be definitely exciting and perhaps could be even a bright spot for a name like Tesla. So I'm excited to watch, hopefully, the return of these IPOs this year. We've been calling for it, as you said, for years now. So the appetite is definitely there. But so appreciate your time today. With all of that breakdown as we reset our expectations into 2026. Jeff Ransdell, founding partner and managing director of Mule Venture Capital. Now coming up next, last but not least, it's time for Under 30. Today we are discussing all things Dave and Buster's, one of the best tickers out there, being Play. Shares are up today, now very modestly, but expecting to close out this week up almost 12%, as we're continuing to see some more analyst favorability and perhaps some positive inflection in their same-store sales.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, SIBO, and beyond. From earnings to economic data, we cover what matters as it happens. Streaming 24/7, anytime, anywhere, free on SchwabNetwork.com.
Morning movers, be the first to find out what's shaping early market action. Check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Stay connected to the markets with the Schwab Network.
Tune in 24 hours a day, 7 days a week on SchwabNetwork.com
and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Stay connected to what moves markets. Download the Schwab Network app and get live coverage wherever you are.
I'm Nicole Petalides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Welcome back to Next Gen Investing. It's that time to dive into Under 30. Today we are looking at Dave and Buster's, ticker symbol Play, greatest ticker ever. And for some more insight on some of the sell-side expectations and just reset into 2026 on this name, I'd like to welcome in now George Tillis, senior markets correspondent for the network. And so George, benchmark with an upgrade today. Shares are initially a bit higher, but have given back some of that strength in real time. So walk us through this note and sort of the broad-based expectations you see for Dave and Buster's, of course, as we approach earnings and hopefully some positivity from a same-store sales perspective.
Yeah, it's actually just looking at the multi-year chart on a weekly basis. I mean, this stock has been down, looks like around 46% over the last 5 years. 2023 was a level in which it was trading at around $66. And so I think this is potentially a recovery play, to be honest with you, considering, some of the news associated with Dave and Buster's as a turnaround story. If you look at benchmark, their call is essentially improving trends for same-store sales and top-line sales for the underlying business. The stock has been structurally challenged because if you look at their call as well, the last 13 quarters, essentially same-store sales just have been declining. And so with that said, price action in the stock has also been to the downside as well. And they're looking at improving trends, at least coming up in this year, 2026. Everything from cost mitigation, lower expenses, improving traffic on an incremental basis, but also promotional pricing to get consumers back in their outlets, which they have over 100 entertainment and dining outlets nationally in the United States. So Interesting enough, if you do look at the price action, it looks like it maybe at some sort of an inflection point. It doesn't have earnings anytime imminent, so that's something you got to keep in mind. So this call is basically perhaps improving traffic trends that the company is denoting alongside the analysts, which are becoming a little bit more constructively bullish on Dave & Buster's.
So we know Dave & Buster's is been undergoing this turnaround strategy where they're trying to right-size some of their food and beverage offerings. They're trying to bring back that foot traffic. And I don't know if we've yet to see this evidenced by some of their earnings and fundamentals, but as far as that narrative around these turnaround strategies for these companies that are facing right now varying consumer, I'd say, perception, I mean, how does a company like Dave & Buster's navigate then the ongoing debt level and just navigating profitability right now? And frankly, they have not looked to be operating from a position of strength over the last several quarters.
Yeah, so that's a good point, and that's the thing. So the stock is down. Like I said, if you look at the last year, down 20%, last few years, down 45%. So that does reflect the challenging earnings environment, which, again, from an earnings standpoint, the earnings have been decelerating, but so has the price. And that's where you have this matching mechanism of downtrends and declining earnings. I did notice that if you look at the EPS estimates for this fiscal year, they're expecting 50 cents on an adjusted profit. Next year, 97 cents. So that's a pretty significant improvement expected by consensus analyst estimates. And I can see why Benchmark is also raising their target on the same, with the stock trading around $19.30. Again, so they're looking at a potentially 50% increase, at least the next 4 quarters in this name. The short interest in the stock is very high. It's about 27 to 28% of the free flow. And you did mention an important factor, Jenny, the debt load. If you look at the debt load based on last quarterly numbers, $3.8 billion on only $670 million in market cap. So the debt relative to market cap is quite high. But one of the things I did notice, and this is important because even with $151 million in interest paid on the debt last year, they still eked out a profit of about $300,000 in net income. Now, it's not a lot, but it does give you an idea that irrespective of that debt load and the servicing obligations, they still are maintaining a profit. So any improvement in same-store sales, traffic, profit trends, we may end up seeing an inflection point. So again, the debt level is one thing, interest expense is another. And if interest expense is causing losses, that's a different story, but it's not the case, or at least the last 4 quarters for Dave & Buster's.
Yeah, and hopefully seeing some of this right now upside strength, or just strength modestly in the session, continue to firm up throughout today as we're seeing overall markets still hang on to at least gains as it stands right now. We'll leave it there. Appreciate it, George Tillis, Senior Markets Correspondent for the network, for that breakdown. We do end the show still in a pretty bright spot tentatively. Still have a few hours left in this trading session, of course. Thank you all for tuning in to Next Gen Investing today and all week long. We have the watch list coming up next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With
shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years through purchasing houses, opening up our business, having children. They've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Happy Friday to you. Welcome to the Watch List. I'm Nicole Petalides. It's 2 p.m. Eastern Time. We're coming to you live from the New York Stock Exchange in the corner of Wall and Broad. A busy day, some back and forth action for stocks, and we'll cover what top investors like right now, from infrastructure and AI-driven value plays to gold and real assets in a sticky inflation world. Then we'll talk about a growing crisis in wealth management as a wave of advisors consider exiting just as trillions of dollars change hands. And our panel standing by to talk about the global oil markets. What are we seeing, and why are we at $62 and now at $59? Oversupply, geopolitics, what it means for your portfolio. In the meantime, it's back in action. Stocks are down for the week. We did have record closes yesterday for the transports and the Russell. In fact, I saw the transports hit a record today during the day today. And right now, we are seeing some up arrows. And also the Russell hit a record today. The S&P, NASDAQ, and Dow, not so much. The S&P 6950, that's up 6 points. The NASDAQ 100 right now, 14 points, 25,561. The Dow is gaining 14 points, 49,456, and the Russell hit a record today of 2692. Right now it is at 2687. So just off the record. And oil and gold. Oil is at $59.86 the barrel. Gold is down $35 today. US dollar at 99.22. And the 10-year bond yield, if you rub your eyes at that, this is the highest we've seen in, I'd say, months, 423. Bitcoin, 95,000 and change. Kevin Green is with me, senior markets correspondent, to take a look at some of the big action that we are watching closely. Of course, the talk of a big deal with Taiwan and the U.S. and an investment trade deal, to be more specific. Hi, Kevin Green.
Nicole, yes, this is a trade deal that was kind of inked actually yesterday. It was $250 billion that Taiwan is committing to building out fabrication facilities here in the United States, or to invest in companies that are going to do so for semiconductor production here. And they are also, when you're looking at the Taiwanese government, is looking to actually provide a guarantee or a backstop for $250 billion credit in order to do so. Now, the result of this particular deal is going to see the reciprocal tariffs for the U.S. actually reducing those on Taiwan by to 15%. That's down from 20%. There's also going to be zero reciprocal tariffs when it comes to generic pharmaceuticals, as well as their ingredients, aircraft components, as well as select natural resources. So this is actually going to be a boon for companies like Taiwan Semiconductor that already actually has an Arizona facility, but it looks like they are going to be purchasing and have purchased some land in order to expand that. So the AI trade is alive and well. It seems like it was a cornerstone for this particular trade deal, and we will see some other industries also benefit as this deal kind of rolls out over the next couple of months and years.
All right. I mentioned that the transports had a record close yesterday and a record today, not J.B. Hunt though. Let's hear a little bit about this trucking corporation.
Well, we've seen a lot of volatility for J.B. Hunt since the earnings yesterday after the close. The stock's only down about 0.8% at this point in time, so this is actually a pretty decent recovery. Pre-market trading was down about 5%. The company reported mixed earnings, to say the least here. Revenue came in at $3.1 billion. Street was looking for around $3.13 billion, so a slight miss there. And the adjusted earnings per share came in at $1.90. Street was looking for $1.81. They're still seeing some pressures when it comes to inflation, and there's also still seeing some weakness when it comes to volume. When you're looking at intermodal volume, that was down 2% on a year-over-year basis, and transcontinental volume was actually down 6%. But they are seeing an expansion when it comes to truck loads, if you will, and taking market share from other logistic companies. So once again, gyrating at this point in time, not a really big mover when it comes to earnings, but the last earnings announcement, obviously, we did see a pretty rapid reaction to the upside because of some optimism for the business. So we're all kind of holding up after the earnings here, Nicole. Let's see if it's going to be able to maintain at these current levels and try to break out above this 210 level, which has been a key area of resistance over the last couple of years.
All right, and last but not least, look, we talk about options expiration, rebalancing. Traders seem like they're preparing for this close, for sure. What are you watching in the last 2 hours of trading?
Yeah, we are kind of preparing for it. We are seeing already some options contracts are getting close to that 100,000 level when it comes to volume. So we are expecting volume to actually increase into the close here. Right now, we've been trading around the 6950-ish area. That could be a pin area for the market here today. But the weakness that we saw early on, we had some buyers really try to step in. I'm looking at the 6970 level as the key area of resistance. If we're able to kind of break above that for the week, I think that would be, for the most part, a little bit of a win for the bulls, and then hopefully we're able to hit that 7,000 level for next week. What you do not want to see is an unwinding of a lot of this positioning that we've seen throughout the week, especially this broadening out trade, when we see some selling pressure and we flush going into the close. And if that's going to happen, Nicole, and we do see some selling pressure, I would actually look at that 6,900 level as a key area for the market to go. So for the most part, we're gyrating, maybe a little bit more bullish, but if we see any type of cracks, any news items, 6,900 could be on the radar today.
Yeah, and by the way, for anybody who's looking for S&P 7,000 or whatever, and the hats, you don't get the hats until you close above that level. So even if we were to hit 7,000 intraday at some point, which we've been close but haven't been there, it has to close above 7,000. Then the hat's been out. Superstition, okay? Kevin Green, thank you. Let's take a look at the big picture. Patrick Kennedy's with us, founding partner, All Source Investment Management. Thank you so much for being with us. How are you feeling about the big picture here in 2026?
Yeah, thanks so much for having me on. I think that the North Star this year is going to be the equal weight. So we want to make sure that there's a broadening out, and it's just not the top tech firms driving the market. So going forward, we're going to be laser focused on the equal weight S&P to make sure that more cyclical sectors are partaking and not just big cap tech. One good sign we saw for that is we saw financials, industrials start to participate late last year. We want to see it continue over of that into 2026 to remain bullish on the overall market.
All right, so at the same time, there's this feeling that because we're seeing, and yesterday we really saw Taiwan Semi committing to more spend, $56 billion and all that. And that gave a meaningful sort of change to the AI bubble rhetoric. People felt like it was more real, not bubble. What do you say?
I think that the secondary movers are going to be really important this year, right? So what AI does for, say, financials, or what AI can do for healthcare, within the markets that we haven't really focused on yet as far as the AI impact goes. So obviously, big cap tech is going to be a beneficiary of AI, semi, so on and so forth. So those were all kind of the first movers of the AI theme. We're now focused on the secondary movers. So banks is a perfect example, right? So AI should be a great thing for banks, not only internally to help automate a lot of their processes and make them more profitable, but to fund the actual AI boom itself. So one reason we like financials a lot right now is we think that AI is really going to make an impact on their earnings this year. Secondly, we like healthcare a lot for the same reason. So healthcare, we're starting to see M&A pick up. In fact, biotech, you're seeing massive momentum in that space. So I want to say the XBI was up over 35% last year, and then year to date, we're up close to 3% as it is. Again, a lot of that is fueled by AI and what AI will be able to do when it comes to curing rare diseases and things of that nature. And then a bigger bullish view on the M&A sector. That I think a lot of that also has to do with AI. People feeling more confident in the market, more CapEx spending and things like that. It's starting to broaden now into some of the more secondary areas other than just big cap tech.
And you like gold still, right?
We do. So we made a bullish call on gold in 2022. It's worked out very well for us. We've continued to trim the position, but we haven't sold outright. The reason why is this is just the perfect environment to own gold. You have central banks buying it, which creates an institutional floor for the asset class. That really makes it, in our opinion, a buy and hold asset class rather than a tradable one the way it was in the past. On top of that, with geopolitical risk and now inflation risk rearing its ugly head over the past 3 years, those are all the key drivers on why investors would want to own gold and continue to stay long in 2026, in our opinion.
From a lot of the financials right now. So tell me a little bit, when you talk about how AI can help financials, we heard a lot of reports this week. What kind of financial names do you like specifically?
Yeah, so we stay away from picking individual stocks. We let our managers do that. But one thing we like seeing a lot of within the private realm is we're seeing a lot more capital be called by private equity, right? And typically, when we see that, that's a telltale sign that bank activity is also picking up within the M&A world.
Okay. I was really thinking, large money center banks versus regionals versus fintech versus credit cards. And then biotech was in there as well. You mentioned, right? For tech, you're more in biotech than software, for example, or hyperscalers?
Yeah, so going back to banks, we would buy the XLF, right? We don't want to make a concentrated bet. If one of our active managers is long money center bank, that's great. When we focus on kind of looking at our managers and making sure they're long on the themes we like, we do want to see large money center banks within there. And then we like some of the private equity names as well, like a Blue Owl, like a Blackstone, just because we can see on the private side that the deal flow picking up. And usually that leads over to earnings. Within healthcare, we like biotech in particular, simply because that's usually affected a lot more by an M&A cycle than the large healthcare names are. And again, we're already seeing the momentum build up from last year with a 35% year in the market for the XBI, and now this year already up close to 3%.
What do you think of the fact that the 10-year bond yield has gone to 4.23? I mean, it was just at 4.16 this morning.
Yeah. I heard you mention that in the prior guest, and I think it's key, right? A lot of investors this year were hoping on several rate cuts for different stories to play out within the market. I don't know if we're going to have lower rates, much lower rates this year, the way most folks expect. I mean, we just had a GDP print above 4, right? So in our view, the economy is still strong, and there's no reason to cut rates. We haven't had a major pullback in markets yet because of it. That's one of the reasons why we're focused on more value-oriented sectors, more cyclical-oriented sectors than we are growth, right? Because some of those growth names, while they're driven up by AI, they're also driven up by the thought that, we're going to have lower rates and therefore the growth in the future will be worth that much more, so we'll price the stock up today. If those rate cuts don't come through, that could be a problem for those companies. We're already seeing that within the software sector, right? So software has some of its own problems when it comes to AI replacement and things like that. We still like certain parts within software, but that's a sector that could be affected big time by rates not going down this year the way most investors expect.
All right, Patrick Kennedy, thank you. Founding partner, All Source Investment Management. Nice to see you. Really appreciate it. All right, coming up next, Options Corner. Tom White is standing by, and he'll join us and highlight unusual options activity that he's seen from this day, from news, NVIDIA, Fastenal, Target. We'll be right back.
you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our Investing Webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters, Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Welcome back to the Watch List. I'm Nicole Penalese. Glad you're with us on this Friday, and then you have a 3-day weekend, Monday off for the holiday. Also, Options Corner right now, analyzing unusual options trades that we are seeing throughout the day. Real trades, Tom White, hosting Fast Market here on Schwab Network, takes a look at 3 names and actually found some bullish trades for us. I saw NVIDIA got a price target hike today. The analysts have been pretty positive on this name overall, and you found a bullish trade.
Yeah, Nicole, you know, I think a lot of people are scratching their head why NVIDIA is still, 11% below its all-time highs. It's been consolidating just below this 190 level. It hasn't really made much inroads. You mentioned that price target hike it got out of Jefferies up to 275 from 250 today. And they talked about valuations. If you look at it on a forward valuation, just for this next fiscal year, it's only about 24 times. That's the cheapest it's been in a couple of years. If you look at their last couple of earnings events, the stock sold off a little bit despite soundly beating numbers and expectations, guiding higher. They're sold out a lot of their chips. Demand's still out there. Their supply is still constrained. They asked Taiwan Semiconductor to increase production. They can't do it because they don't have the capacity. So it's bad problems to have, but good bad problems to have at this point. And then you've got all the back and forth between China allowing the chip sales of the H200, the U.S. saying that they've got to vet them, the Chinese government coming out saying they don't want their companies to use it, but Chinese companies want to use it. So that's been a battle in itself. But the stock's kind of consolidated. It has had a decent week so far. It's up nearly 2%. So far this week, up about 40% from year-ago levels. But this consolidation, kind of worrying, I think, for investors. But did see some unusual option activity, really short-term positioning in here. This was out in the January 23rd weekly cycle. And this was early on in the trading day. On the 190 strike calls, trader bought over 20,000 of those early on. Paid an average debit of about $2.60 for these calls, so the break-even of 192.60 over the next 7 days. That's only about just over 2% above the current share price. Now, when I was looking at this, I mentioned it was early trading when they kept piling into this position on the 190 strike. Over 115,000 calls have been traded on just that 190 strike today. So there's a lot of interest, short-term interest, going into next week for NVIDIA on the strike. Remember, the stock traded above 190 earlier in the session today before pulling back towards this 188 level. So, yeah, a lot of conviction on that. That's going to be the biggest open interest position in that January 23rd cycle. But this trader thinks it's going higher, and obviously a lot of other people do too, because a lot of call buying on that strike.
Yeah, as you said, a lot of conviction there, seeing that volume, telling the story. What about Fastenal? You found a bullish trade here.
Yeah, stocks had a decent run so far this week, up about nearly 4%, up about 9% so far in January. I think the key here is that they report earnings on Tuesday in the pre-market. The option market's pricing in about a plus or minus 6% move in either direction. That's on a one-day move. They're that major distributor of industrial and construction supplies, largest fastener distributor in North America. Expectations starting to grow. Revenues expected to grow over 12% from year-ago levels to about just over $2 billion. Last November, they did come out with a mid-quarter update. Sales were up 6.2 from the year-ago period. and daily sales were up over 11%. During that mid-quarter update, but we did see some bullish activity. This is uber bullish activity going into that report on Tuesday morning. They did a combo trade, a bullish risk reversal, where trader bought 15,000 of the February 20th monthly options that expire in 35 days. They bought 15,000 of the 45 strike calls, and to help finance the purchase of that bullish call, they sold 15,000 of the 40 strike puts in February. So on this risk reversal where they're buying the call, selling the put, those are both bullish, right? They paid an average debit of about 65 cents for this combo trade, and that takes a break even to 45.65 over the next 35 days. That's about 4% above the current share price, well within that one standard deviation move that the option market's pricing in post earnings on Tuesday morning. Big, massive option volumes for Fastenal. Typically, we don't see big open interest positions or big trades in here, so this is a big, massive one where put volume is about 40 times normal daily average volume, and most of that volume is on this one trade. So yeah, somebody buying this bullish risk reversal with the expectations we're going to see some good results come earnings on Tuesday morning.
Also, you're going to have a CEO change, and maybe they're betting that the outgoing CEO wants to sort of show his stuff, right? And end with a top, and so maybe that's also the bet there. You have that CEO change, which is effective in July, but it's already been announced. So we'll see. I saw a $52 price target from Jefferies, but that was about a month ago. So we'll have to wait and see. Those earnings will be exciting, so thank you for that preview. Last but not least, Target, a bullish call.
Yeah, Target, a little bit of a resurgence here, Nicole. It's up about 13% so far in the month of January after just a couple of weeks of trading. And it's up about over 30% from those lows that we saw, multi-year lows in November, and hit 10-month highs this week also. So a little bit of resurgence. Somebody thinks that maybe we're going to see that turnaround story finally come to fruition here. They're getting pressure from activist investors. The latest is Tom's Capital Investment Management. They haven't disclosed how many shares they own, but they're trying to pressure the board at this point. Retail sales number earlier this week was better than expected. That's a positive. GDP continues to ramp up here, and expectations are starting to grow there. The consumer's still doing okay in this K-shaped economy, but this is all about the turnaround of Target, right? They relied too much on discretionary items, didn't pivot quick enough to the grocery side of the business. They're getting market share taken away. They've had 12 consecutive quarters, Nicole, of negative or negligible sales growth. That's pretty spectacular because the stock was hitting all-time highs just about 2 or 3 years ago. But seeing a little bit of a reversal here lately. Morgan Stanley raised their price target to 125 yesterday from 112. Keeps an overweight rating, so maybe something coming down the pipeline. But we did see some unusual option activity in here, and this was all the way out in the June monthly cycle. So this has got about 153 days until expiration on this position. Trader bought 5,000 of the June 130 strike calls, paid an average debit of about $4.10, so that break even of 134.10 over the next 153 days. That's about 21% above the current share price. So while they're giving themselves 6 months in this position, you're going to need a pretty big move on a percentage basis to get above that break even. But maybe this trader's betting that this resurgence that we've seen in the shares this month and this week is going to continue into June expiration by summer.
Yeah, look, 10-month highs, but still down 17% year over year. It's great to see that resurgence. Exciting for Target because it was sort of left aside for a while. And as you noted, the higher price target that was announced yesterday from Morgan Stanley. Just a quick thought on why we saw buying yields at 4.16 this morning and 4.23 now. What do you think?
Yeah, I think that's been one of the caveats to help support equities at this point, Nicole. We haven't seen any volatility in the yield market and the bond market, and that's actually been a good thing. You know, the market's getting comfortable with yields where they were tracking between 4% and 4.2%. Now we're at highs that we haven't seen since September in the yield. If we start to see some volatility, and that's probably why you saw equities pull back here a little bit, they're getting a little bit concerned here. but they're still at relatively consolidated levels at this point. I just think it's starting to pique up some people's interest in, if we start seeing yields continue to rise, remember the data's been good. Right? PPI was a little bit above expectations. CPI is sitting around 2.7%. So if we see that consolidation where we're not getting that pullback in inflation towards the 2% mandate, that could add some volatility. So watch the bond market for additional volatility that might create headwinds for equities at this point, because it seems like a lot of the optimism's returned in the equity market. Data's been pretty good. Jobless claims were below 200K. So if that volatility comes back, that might throw a thorn in the side of maybe the optimism in the equity market in the near term at least, Nicole.
Very interesting. We have gotten some good pieces of economic news, no doubt. Schmidt yesterday said he's more concerned about inflation, not about cuts. I mean, you heard that. And today, President Trump, at one of his speeches today, said that he wanted to see maybe Kevin Hassett stay where he was in the National Economic Council, which really puts Walsh back. I saw some of the odds are now at 60% for Kevin Walsh. So we have to see who's going to be our next Fed head. Tom White, thank you. Always great to see you. Appreciate it. And folks, we expect to have a busy close. It's options expiration. We have rebalancing. The traders are all lined up ready for this closing bell today. In the meantime, we're looking at artificial intelligence. And not all of the companies can survive. And AI may be making some decisions about what wins and what doesn't. We'll explain.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals. You can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to the Watch List. I'm Nicole Petalese. We're live on the floor of the New York Stock Exchange. Joining me right now, Luca Rusignon, Global Head, Capgemini Research Institute for Financial Services. Thank you so much for being with us. So we are now expecting a transfer of wealth in a big way as those baby boomers, that generation is going to be transferring wealth. At the same time, you know that the research is showing 1 in 4 advisors plan to leave in the next year, and some are retiring and some are not happy. What's going on here?
Nicole for having me. And yes, we see an $83.5 trillion wealth transfer happening in the coming years. And what's undiscussed, I think, is the talent risk behind it. Capgemini researchers were hinting at shows 1 in 4 advisors planning to leave their firm within the next 12 months, creating a serious continuity issue just as well as transferring at scale. And I think this is a capability crisis, not an engagement gap. Half of the advisors don't feel sufficiently empowered, and nearly a third cite poor digital tools as their biggest frustration. And that gap is concrete. Advisors today spend the majority of their time on non-client-facing administrative work. The advisor role has grown more complex, but firm platforms and workflows simply haven't kept pace. And the structural risk, we think, is even as this advisor expertise may not fully translate to the next generation's needs, they still hold the current generation's relationship and trust. And when they exit now, firms lose relationship custody at precisely the moment they need to facilitate the generational handover.
Okay. About 50% of them plan to retire by the year 2040. I mean, that's not that far away. And you said there's a sense of frustration, they don't feel recognized by the managers, and they are uncomfortable with digital tools, inadequate digital tools as a key frustration for wealth managers. I almost would have thought they would have had more tools with AI. Why the digital tools a key frustration?
I think it's a matter of timing and a matter of expectations, right? At the end of the day, what we see really is when you break down the majority of time spent on non-client-facing work, onboarding, compliance, documentation, well, this is where some of the benefits of technology haven't yet fully come to play. There's been significant investments, of course, but the translation into day-to-day activity is yet to come. And when highly trained advisors spend most of their day on administrative tasks rather than advising client, job satisfaction erodes significantly. And at the same time, client experiences slower responses and less proactive guidance. Their expectation is set by other technology-driven industry, and that's exactly what digital native inheritors are telling us they are not getting. So I think that the opportunity there is really to scale up and to free up some of that time through AI and automation, not just to improve efficiency, but to fundamentally expand advisor capacity to grow relationship and revenues.
So if, my dad says, listen, this is my advisor, Joe Schmo, he's the best, he's been here for 30 years, I want you to work with his team. That's what you said, people feel comfortable with their family's advisors and they want to go there. But you also talked about the frustration of them sort of dwindling away. So what is somebody to do when I come into my millions, what do I do with it?
That's a great question, right? And I think that the shift is really that proactive approach, right? From an advisor standpoint, they have the relationship with your dad, but the next generation is different, right? We're seeing different life stages, different time of getting married, of having children, of thinking about career. So the opportunity really, I think, is to look at how you offer proactive outreaches, real-time personalization, and better behavioral guidance. And that I think is what really matters, right? When we ask high net worth individuals in particular to tell us what they seek is advisor guidance and the help in navigating behavioral biases, especially in volatile market. And I think that's where the commercial case is very clear, right? Proactive client engagement drives better retention, higher share of wallet, and stronger fee income. And the opportunity is to position AI investments as revenue enablers and cost reduction tools. When advisors are, if you like, empowered, both dimensions delivers returns. And that's where wealth firms are seeing the most compelling ROI.
All right, so last but not least, what are some of the AI tools that you think do help advisors? I mean, it's really evident this is good for advisors. I mean, we can't come on here and say, this is a disaster, they're all leaving. I mean, they're not all bad. Something's got to be good here.
Absolutely. And I think that's what we're seeing, right? We see two clear patterns in firms that are ahead. First of all, AI embedded directly in advisory workflows. We saw some of the large US wealth managers rolling out AI-powered dashboard and Gen AI assistants that give advisors real-time market intelligence, portfolio insights, but also sentiment analysis, not as separate tools, but really integrated into their daily workflows. Second opportunity there is really scaling up communication across the organization. Other banks are deploying agentic AI across digital, branch, and contact center operation to automate routine tasks while maintaining human accountability for decisions. And I think both approaches share a common principle. AI amplifies what an advisor can do, and when advisors are properly equipped, they become more proactive with clients, they can sell a larger book effectively, and they create genuine competitive differentiation in retaining both advisors for the firm and client relationship going forward.
All right. Luca, thank you so much. Some really interesting data and research there. Luca Rosignon, thank you, Global Head, Capgemini Research Institute for Financial Services. Still ahead, watching gold, silver, the miners that have been around some record highs. Let's talk a little bit about this group going forward.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Real-time market moves, earnings breakdowns, and trade-ready insights. Follow me on @XM_Violet and connect with me on LinkedIn or Instagram for more.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Welcome back to Watch List. I'm Nicole Penalty. So glad you're with us. David Strzelecki is here, CEO of Sound Planning Group. Thank you so much for being with us. We'll get to gold because I know that was something that you liked a long time ago. So we'll definitely have to talk about that and the run we've seen. But you're talking about investors' positions in their portfolios now with a remodel in progress. What's the remodeling? What needs to be done?
Well, great to be with you, Nicole, as always. You know, so an analogy of where we're at right now is it feels like we're remodeling a house while also still having the lid in it. You know, like roughly 1 year ago, President Trump took office and began to structurally change the economy. This is structural, not cosmetic. So capital right now coming back to the United States. Foreign nations are going to be investing. They're preparing to deploy capital here in America, hire in America, produce in America. I grew up at a time when
I live in America.
In America, that's going to happen.
I live in America.
So this is really bullish long term. You know, but everyone who's gone through a remodel knows that it's noisy, it's messy, it's uncomfortable before it gets better and looks better. So we find ourselves in a time right now where things look mostly optimistic. It seems like things are in control, the markets are doing really well, but you know, the average consumer today is still under a lot of pressure. Inflation has not gone away, it's just slowing down. Prices on essentials at the grocery market, on insurance, utilities, services are up about 29% since we started talking about this stuff in 2020. And so the Federal Reserve is kind of boxed in right now. And obviously all eyes are on the Fed. You know, massive national debt, exploding interest, and the risk of cutting rates and reigniting inflation. These are all a big setup potentially for volatility here as we enter into 2026, although I am mostly optimistic about where things are going to be going.
All All right, understood. So you're mostly optimistic, and you still are a believer that you got to have some metals and miners in your portfolio, right? Like which ones?
Okay, well, first, we have to recognize that central banks around the world have been buying more gold than they have treasuries, which is a massive, massive, massive change in how they've been doing things. So I really like silver, very specifically, but also gold. And so, buying indexes like GDX or SIL are a great way to get allocated to many different producers. You don't have to select an individual name, and you can get a lot more of this upside growth. Now, here's the thesis behind it, and that is that the metals right now have been on a tear and they've gone up. I believe that they're going to go far higher than where they actually are right now, even in a short time frame. But the point here is this: you can't just print gold and silver. You've got to actually mine it out of the ground. This takes a lot of time. So producers that are producing have a whole bunch of ounces that are sitting in the ground right now for maybe a couple of bucks or a fraction of what the price is above ground. And when you don't see the input costs of what it you have to pay to an employee, how much diesel costs, getting different permits, etc. When those prices are not going up as much as the price of the metals, I believe that these are going to be some of the most profitable companies that we could be investing in, maybe over the next 3, 5, and even 10 years. Very specifically because the world needs these metals. They want the gold as an alternative to the treasury right now. But more importantly, silver has a physical application inside of all the data centers, all the electronics, all the AI. These are, and solar panels. These are things that are not going away. They're going to pay whatever price it takes in order to continue to progress with the technology. And we need far more silver than we actually have. And so this is why I am personally very invested in physical silver, but the metal miners as well. And I believe that this is one of the most important things that we can be paying attention to as my personal price targets over the next year or two are that gold gets to about 6,000, 8,000, and that silver is going to go to 150, 250. And I know that sounds probably crazy to a lot of people listening to this right now, but here's the reality. It's supply and demand. The math is the math is the math, and ultimately it's going to manifest.
Well, you were on this from some time ago, so you were ahead of your time with it in the beginning. Let's turn our attention over to energy demand, and then you talked about small modular reactors. Tell me more about that and how investors can get in that part of it.
Yeah, so SMR is just a ticker that can be allocated into this. So the point is that these are nuclear generated energies. They can keep the base load going for the grid, and ultimately they have a smaller footprint, faster to deploy to support all the AI manufacturing and everything that's needed here. So the point though is that with all this AI and data centers, we need more energy. We've not really had the conversation about NVIDIA chips or some alternative to say who's the most efficient, like we think about our cars, the miles per gallon as an example. But we're going to have a real challenge as we continue to go forward into the future because we don't have enough energy. We've got EVs, we've got all this demand, even Bitcoin mining. It takes a lot of energy, and so small modular reactors are a way to come in a faster, more efficient, and they're also relatively safe. At least that's what the studies are saying. So SMR is a way to play that, and I think that it's time to probably trim some of our heavy tech positions and allocate into some of these ideas that are going to really position portfolios and harden the balance sheet here for where the economy is headed next.
And we're looking at fiscal policy pertaining to taxes and Roth IRAs. What are some of your tax tips?
Okay, well, as we start out 2026, it's kind of important to look at, if you're going to fund a Roth IRA and you didn't do it last year, well, you can make your payment by April 15th prior to filing your taxes, but you just need to write on the little bottom portion there in the memo that this was for 2025. You can also fund 2026 at the exact same time. Obviously, Roth IRAs are important because you want to have a diversified approach to the income that you're drawing out of your portfolios in retirement. And so you don't want just all money in 401k. You need dollars that are going to be tax-free as well. And so this is an important idea, but let's just talk about taxes in another sense too. January kicked off the big beautiful bill, which I like to refer to as the Tax Cuts and Jobs Act 2.0. And so right now taxes are on sale. They are lower likely than they will ever be in the future. And so when would you rather pay taxes? Now or at some point in the future that it could be higher, in fact much higher, especially because of the debt loads, etc. Or would you rather pay them now at a time that's known and you can ultimately plan your future forward? And so I'm very, very big on tax diversification, not just asset diversification. I just want to make the distinction there in those points. And so for people that have not funded those Roth IRAs, do it. If you don't know the right math as it relates to how much should be going in versus not going in, that's just a mathematical answer of the 101 different withdrawal strategies that you could possibly employ to create the most tax optimal income for retirement. And so as many people are facing retirement here today, I think it's incredibly important that they're looking into tax diversification ideas like this and taking advantage of the opportunity with lower taxes here with Tax Cuts and Jobs Act 2.0.
And that will make sense. Say to folks who say I'm working now, so I'm probably in a higher tax bracket than when I'm a senior citizen. That's the first thing. The second, those of us who make under $160,000, those of us who make over $160,000. Don't you have to only make a certain amount of money to be even eligible for a Roth IRA, or no?
To be able to fund it, yes. There's also backdoor IRAs where you put it into your IRA, and then you're willing to pay the tax to move it over to a Roth IRA. That's a conversion. Anybody at any income level can actually do that. And so there's a math and science answer based upon your age, when you're going to retire, what's your burn rate, how much you're spending monthly, and then ultimately that gives us the information that we would need as financial planners that are specifically doing income planning to ultimately determine what's the required rate of return in order to, with a specific distribution strategy to determine, can you actually make it with this portfolio? Should you be saving more? Should you be retiring later? When are you going to be taking Social Security? So there's a lot of factors that go into this, but to answer your point simply, anybody can actually put money into a Roth IRA. Younger people, for sure, should be putting it in right now. You are correct that in retirement, you'll likely be in a lower tax bracket based on ordinary income, but here's the point. If you still have a mortgage that you're funding at, I don't know, $3,000 a month, and you're in a 20% tax bracket, well, that's an extra $600 every single month that you got to pull out in addition to that $3,000 just to fund that mortgage. So what you want to do is you want to approach this thing from the standpoint of I'm looking at my income needs, I'm looking at that burn rate, and then I'm ultimately figuring out how much from my after-tax account, dividends, etc., how much from my tax deferred account, 401k IRA, how much
Netflix is at 87.
to do in order to.
I mean, I really want to go long and in.
And so this is something that an income planner, not just someone who allocates to a portfolio, but someone can help you to plan for that income here in the future, to position you better even through the remodel that we're experiencing.
Yeah, good, clear answers. David Josefsky.
Nicole.
Planning Group. Thank you, David. Always great to see you. Appreciate it.
I love you.
Coming up next, we're looking at oil prices. Which way are they headed and why? We'll be right back.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions.
From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close.
Here on the floor, I bring you real-time sentiment from traders driving the action.
And in Chicago, we break down the data, technicals, and trades you need to see before the bell rings.
Live coverage of the close every single day.
This is
Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. no matter the hour. You can trade brilliantly with Schwab.
Hey, investors, you know the market moves. And Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Sam Varnas, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reactions, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Welcome back to the Watch List. Our panel's ready to talk all about oil. It was just a couple of days we saw it at $62, down to $59. What's going on with energy from Venezuela, Iran, and all the energy that we need for AI? Ted Parkhill, co-founder, CEO, Incline Investment Advisors, and Brandon Wynn, wealth advisor, Alternative Investments, Cairn Financial Group. Thank you both for being with us. Ted, I'll start with you. You're watching oil closely. Are you looking at the supply and demand? Is that the story?
Yeah, I think supply and demand is absolutely part of the story, but and what really factors in here is the geopolitical events. And that's something we're really focused on because that's increasing the volatility in the markets. As an oil trader, we have a number of positions across the energy sector, so we remain short oil, nat gas, gasoline, etc. at this time because we really feel like the demand is still weak. There's a pretty much an oversupply in world oil markets, and with the latest news in Venezuela, that just increases the access to available oil.
Right. Yeah, more oil from Venezuela. That seems to be the plan. It's going to take some time. I know it's a good grade and quality and all that. But there are also concerns about disruption of oil from Venezuela and or Iran. But again,
exactly.
Those are smaller portions. Brandon, your thoughts?
Exactly.
Yeah, I completely agree with Ted. In
I agree with Nicole.
When you have Venezuela, you're looking at more of an uncertainty story rather than a surplus story. You have very heavy and sour oil that is difficult to manage. The United States does manage it pretty well, but it really depends on how quickly the United States is going to be able to get political stability back up and transport the oil outside and refine it and then put it back into the global market. So it's really an uncertainty story, and the timeline and the investments all matter in this particular case. And so short term, Venezuela doesn't mean too much other than headlines, but long term, it could play a significant impact, especially when we're talking about surpluses.
What oil companies are you watching specifically, Brandon? Ones that could do better than others, and why?
In terms of specifics, I can't really get into it, but if you're looking at oil, you're looking at a lot of the infrastructure play in Venezuela is huge. So anything that can really support bringing the Venezuela oil industry to the modern times is what we're looking at. You also have larger players that also are looking to return into Venezuela after being removed in the past decades or so.
What kind of companies are you watching, Ted? I mean, you have like the midstream pipelines, you have obviously the biggest guys like Exxon and Chevron. We actually have a deal that was brewing in Devon today, I believe. What kind of names are you watching, Ted?
Well, I actually agree with Brandon in one sense, and that is, I think the big firms are the ones to be watching, the ones that can go into Venezuela and actually take advantage of rebuilding the infrastructure. Those that are willing to do so, because I think there is a political element to it as well. So that's something to watch. I think the junior oils won't probably perform as well because of the volatility, and it goes back to sort of overall price in general. So I would be watching some of the big firms like Chevron, ExxonMobil, Valero, and so those are some of the firms that we have an eye on. They've done well year to date, and I would expect that to continue unless we see a weakening in price when things settle down. They had, markets have not settled down in terms of volatility recently because of all the more recent news with Iran.
So at this point, too, you also mentioned, I was saying about disruption of oil, and you said instability in Iran in particular could impact oil prices in the medium term. Ted, what kind of range do you think we could be in the next month or 2 or 3?
I think we're going to continue to see sort of the $2 to $3 range bound trading that we've seen since the Maduro arrest, and so I think that's going to continue for a while. But I think overall the trend is going to continue down. Oil was down almost 13%, in the 13% range last year. I think that there's an oversupply. I think there's still generally weakening demand, and so I think that we'll see a slight tick down below 60, and it'll stay there for a while.
And Venezuela, one of the reasons why folks are saying that we're really trying to grab Venezuelan oil is so that it doesn't go to China. China's still a very big story, Brandon. Why?
Well, China's a huge story because, of course, it gets a lot of oil from Venezuela, and it also gets a lot of oil from Russia. But Iran is the big story this past week, right?
Yep,
and so
there goes lunch.
Iran actually supplies about 80% of its oil to China. So the Asian markets, that's about 1.3 to 1.5 million barrels of oil to China every day, and the Chinese teapot refiners leverage this because they get it at a steep discount, almost $8 to $10 less than the Brent. So if China gets affected and Asia is affected, it's going to have a huge ripple in the overall oil markets.
And do you have a favorite name for powering AI? Either one of you? A type? Is it a type of company? I know you're not really naming names. Is there any sort of final AI thought quickly?
Well, Nicole, before we move on to AI, I'd like to add Brandon's thought about Iran. Iran is, if it settles, Brandon's right about China getting the oil from Iran. If the Iranian situation changes and the sanctions are lifted, that could just be more oversupply of oil, and we could see further price drops. So that, to us, is something we're watching very closely. The AI thing is, it depends on the country. It's a little more nuanced than we probably have time for, because oil does impact energy, but it depends on where those AI centers are located.
Thank you, Ted Parkhill and Brandon Nguyen. Thank you, Ted, Brandon. Nice to see you. Thank you for being with me, friends. Have a nice long weekend. Of course, I'll catch you on Tuesday. I'm Nicole Pedalides every day at 9 a.m. and 2 p.m. here on Schwab Network. Keep it right here. Market on Close is next.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists, streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
Mom, when my grandparents moved here, did they know what our family would become?
I don't even know if they could envision it, to leave everything behind, literally come across the entire world. I think that we totally met what their wishes were. Schwab has been with us for almost 25 years. Through purchasing of houses, opening up our business, having children, they've always been there for us.
I want to invest with a company that can help me give my family a happy financial future.
Stay connected to what moves the markets. Download the Schwab Network app and stream anytime wherever you are.
Friday. It's 3 p.m. on Wall Street, and this is Market
Coming down. I was calling us a bow flag. And
Chicago headquarters.
gonna wait for that third dip.
At the New York Stock Exchange. Let's take a look at what is coming up on today's show.
She just went down below it.
Hitting a new all-time high as the memory chip rally continues. We'll discuss the biggest winners and losers of the week. The battle for Warner Brothers continues as Paramount launches a proxy fight right ahead of
SPX.
earnings on Tuesday. And we'll wrap up the first week of earnings by looking at some of the regional banks, including PNC, which hit a 4-year high today. But for now, Molly, take us through what you're watching today.
Keeping a close eye on memory stocks, Sam. Seagate bringing that whole group higher after the lone bear on Wall Street changed his rating to neutral from sell. Susquehanna upped the company's price target to $280. That's up from $150, saying that its negative hard disk drive industry thesis has proven to be incorrect. And you hinted there Micron having a great day. They hit a new all-time high after an industry veteran and a board member over at Micron bought nearly $8 million in shares. Now, this purchase near all-time high prices signals that he may believe this rally continues to have legs and will continue to the upside, giving a boost to the stock today. And Novo Nordisk shares jumping about 9% after reporting strong early rollout numbers for its oral Wegovy weight loss treatment. In its first week on the market, the pill accounted for about 1.3% of all Wegovy prescriptions, signaling solid initial demand for the product. Now, lots to talk about today, but before we get to that and more, let's see how the markets are shaping up as we head into the end of the trading day. We've got a bit more of a mixed picture than earlier this morning. The S&P 500 trading up marginally. They're at 69.49.48. The NASDAQ up as well, 25,559. On the Dow, we are slightly below the unchanged line, 49,409. And the Russell 2000 a quarter higher at 2681. On the 10-year, we have continued to see it rise. We're up to 423. The dollar at 99.19. Gold slightly lower on the day, 45 at 94. That's down more than 0.5%. Crude
Now power hour.
59.38 a barrel. And Bitcoin managed to get back above 95,000, but still off of some of those closer highs we saw that were getting near the 100,000 mark. We're at
Power hour.
95 right now, down about 0.25%. I do want to check
I don't
in
know
with
what to think of
Sarah
this.
and see what top stories caught her eye today. A very busy day, lots of strong performances, analyst movement. You know, what was sticking out to you most?
Yeah, plenty to chew on today, Molly. Look, patchy performance for the regional.
I do see a support
Earnings. PNC
right there. So if you knife there,
the 4-year high after meeting those expectations thanks to a rebound in deal making, net interest income growing to a record 3.7.
if we pull back to around 69 above 45, I think
A bit of a different story though for Regions
that's a good
Financial,
spot.
missed on the top and bottom line and net interest income as well. Also issuing some cautious guidance. Wells Fargo also downgrading the stock today to underweight, saying this is not the time to buy the most.
We're around 67.45.
Unless they're a takeover target or have extras. Energy stocks, meantime, are all over the place today after the Trump administration announcing push to get energy companies to, I should say, tech companies to power new plants amid increasing AI demands and rising electricity costs. So those in the business of utility infrastructure have been higher today. So think your GE Vernovas. They have been some of the best performers on the S&P 500 today, while independent producers have been going in the other direction. Constellation Energy and Vistra have also been
Didn't I put an alert there?
Today. Now, you mentioned that 10-year yield of picking up to over 420 at 423 right now. I don't know if this constitutes a breakout because, of course, it's been very, very range-bound over the last few months, but it came after comments from Trump earlier today that Kevin Hassett may not be the next chair. As I mentioned, the 10-year has been really stuck in this range for quite some time and has failed to break out. So we're obviously going to be watching to see that overall trend, see where things go. But for now, Marley, I'll send things back over to you and Jenny in Chicago with some of today's top stories.
Thanks so much, Daniel. We'll check in with Kevin Green at closing bell to see his thoughts on the 10-year and if it's broken out of that range. But like you said, a lot of top stories to get to today. Jenny, one of the big ones here is this memory rally that continued, has really continued from the start of the year, but got some nice notes today that continue to favor this demand isn't going anywhere, particularly as it pertains to hard disk drives.
Yes, if you are waiting for some of the really phenomenal price performance to slow down, you will have to wait, it seems, because even
definitely a different kind of week.
Bearish analysts did change back. As we saw, demand they noted for the company's hard disk drives is just that strong. So
kind of like capitulation.
Upgrade Seagate to neutral from negative, lifting their price target to 280 from 150. And a note earlier this morning, also reiterating a neutral rating for Western Digital, but did bump up their price target to 205 from 135, saying that they acknowledge that their earlier, more negative hard disk drive industry thesis has been proven incorrect, particularly to Seagate. But the story has been, of course, a boon for investors. I mean, Seagate surged 219% last year. Western Digital, top performer of the S&P 500, was up 282%. Now, data storage is notoriously cyclical, but that does leave a minority of these sell-side analysts more weary of this eventual downturn, as we have seen. I mean, this was a recovery story for a lot of these names, but Susquehanna's was really the final holdout for at least Seagate in particular. Now, why change course right now? Demand we've seen for these commercial scale drivers has turned out far better than expected, and they did note that their transition to the next generation of magnetic recording technology has been executed near term pretty flawlessly. So as pretty much optimistic as a tone I think you'll get from someone that was so skeptical on the space. They do believe that peak shipments likely won't come until at least mid-2027, but that right now they see the total market for high capacity hard disk drives, which say that 5 times fast, growing at around a 25% annual clip through 2028. Now, when you look at these names, because we oftentimes group them together, because how could you not, frankly, I think it's important to differentiate that Western Digital has exposure to AI for both HDD and SSD demand. Now, the difference is Seagate is really a pure play into hard disk drives. So both suppliers to overall just the cloud hyperscalers both benefited from hard disk drive really demand, but STX is a bit more of that pure play, which is why I think we're also seeing a bit more of this favorability, at least into this year, as right now hard disk drives continue to be the topic of all AI conversation.
Yes, certainly do. And we've seen this like roughly 2%, 3% move for Seagate for most of the day. Western Digital also turned itself around. They were higher pre-market, then fell lower, now looking like they're going to close potentially in positive territories around the backs of these sympathy moves that we're seeing. But also Micron a part of this conversation, not necessarily moving off of this note. It has some headlines.
Comes the pullback, get ready.
A part of the memory conversation when we're talking about Micron hitting a new all-time high today.
Yes, but they also have a pretty sizable exposure to like DRAM, NAND type of memory, so they're also obviously in the broader memory world, but Micron is seeing, as you mentioned, some different news today. Is their Taiwan Semi's former CEO and now the current Micron board member, Mark Liu, did just buy up Micron stock at a time where it's essentially never been hotter, frankly, implying that this rally, though, could still have some legs. So he just disclosed his purchase of roughly 23,000 shares, with his buying taking place on Tuesday and Wednesday, when we saw two sessions of more mild declines for Micron shares. But per the Thursday filing with the SEC, the open market purchases amounted to roughly $7.8 million worth of stock, now bringing his total ownership to roughly 26,000 Micron shares, worth just shy of $9 million based on Thursday's closing price. But again, shares of Micron have been on a blistering run, rising just 75% in the last 3 months and surging over 247% in the last year. They've been able to dramatically boost prices for both dynamic and random access memory, and through flash memory, some analysts analysts, though, again, hopeful that the trend signals long-term structural changes in the memory market, which again has been long time seen as very cyclical. And so anyone knows from looking at Micron for years and years, it was a pain point for quite some time because they could not figure out their supply and demand balance. They've seemingly gotten that right. They will have to continue to deliver, though, and execute. But one thing that is amazing to me, just checking in on it, its forward-looking PE is 9 times. I mean, we look at competitors are in the same space. AMD trades at 41 times, Intel 117 times. I mean, I don't remember the last time I saw a stock that has outperformed this significantly with this much growth baked in. It's traded at 9 times forward PE. It's ridiculous.
It is wild when you just sort of look at this space and some of the numbers. You'll even just to have a board where you've got triple-digit gains in a 12-month period for every single stock that's on here, and they're all in the green today. You know, looking like they're going to close out this weekly rally, really this yearly rally so far for 26, again in positive territory. Jenny, thanks for breaking that memory story down. I want to get into a different sector here. Talk about energy and utilities here. President Trump making a push for tech companies to actually pay for some of the energy that they're using, and we are seeing a pretty wild reaction in terms of the infrastructure players, the energy companies themselves today. Some moves to the upside, some significant moves to the downside.
Yeah, and I mean, really following this political plan to get more power plants built for AI data centers. As we know, the electricity area of the U.S. grid has been in focus, though lifting these energy equipment makers like GE Vernova, while pressuring power plant owners like Vistra and Constellation. Constellation actually pacing towards war stay now since April of 2025. But this was spurred by news that President Trump and the governors of some of these eastern states plan to announce a proposal to encourage the construction of power plants on these AI data centers. They want to keep the nation's largest electricity grid operator, known as PJM, to hold a special auction for big tech companies to buy power. Now, this could come as soon as anytime today, but Trump had teased the news earlier this week in a post on Truth Social. The idea is that companies like, say, Microsoft, Alphabet, will pay for power contracts that could last as much as 15 years, incentivizing power companies to build new plants. Now, if tech companies do foot the bill, regular consumers will not have to fund that new capacity. So theoretically, this move could help two problems at once. We could see it ensure enough power for AI data centers. We could also see it spare consumer from higher bills when electricity prices have been rising. But Constellation Energy and Vistra in particular are two of the largest owners of existing power generation in the PJM grid area. So they benefit from the tight power supply and high prices in PJM. So Constellation being the biggest right now U.S. nuclear operator, Vistra has a bit more exposure to gas-heavy merchant generation. So Constellation loses a bit more because its business, frankly, thrives on tight capacity and scarcity premiums. Vistra's hurt too, but has a bit more flexible economics. I mean, both names seeing pretty substantial moves to the downside today.
Yeah, so real pressure here, and this story is sort of unique in that a lot of these conversations I think we have about the AI build-out and the data center build-out are more in theory, or they're not really here yet. But they're saying that they're already knowing they're 6 gigawatts short of their reliability requirement for next year.
Well, that ain't good.
This is a near-term problem here. That's the equivalent of 6 large nuclear power plants. So it will be interesting to see how we go about getting that power when it doesn't appear to exist. But this is an actual real-world currently existing problem, not a far down the road 5 to 10 year out issue.
And one that I think is almost underappreciated by like the broad rally we see behind everything AI. It's like, well, wait a second, if you believe in these companies executing, monetizing, which is everything that the street wants to hear, this has to happen first for a lot of the build that we've been promised and sort of trading on expectations of.
Absolutely, and this was not the only commentary we've gotten from the administration today. Another major headline involving who our next Fed chair might be. The president coming out and saying that he would prefer that Hassett stay where he is, which I think was wildly unexpected. And you know, just walk us through this story, what he said, and sort of the reaction we've seen so far.
Yeah, so Trump publicly saying he prefers to keep, of course, the National Economic Council director, Kevin Hassett, in his current role. Now, I will say, it was very positive. He was very much praising his work, but this does suggest that Hassett, of course, will become less likely to be the next Fed chair After Trump spoke, though, traders on prediction market sites did change their bets pretty substantially. Like Kalshi raised their bets to 60% chance now of Kevin Warsh getting the job, compared to just 16% for Hassett and now 14% for Christopher Waller. Now, traders on Polymarket expressed a very similar dynamic, which I always think is encouraging. Warsh leading Hassett by 16% to 15%, Waller again at 13%. So as of just 2 days ago, Hassett and Warsh were nearly tied, making again this a pretty major shift. Markets do tend to view Trump's comments as influential, though not necessarily definitive. As analysts have noted that Trump often sends these mixed signals, but seems to enjoy more of the drama and the volatility that has followed the selection process. But still, it's the first moment that we've seen Warsh really emerge as that major frontrunner. And to quote our other Kevin here, of course, Kevin Hings, who is always saying it's the Kevins, it really is. I mean, I know that the 5 finalists also include Christopher Waller, Michelle Bowman, Rick Ryder, but right now the odds are pretty low for basically everyone outside of the 2 Kevins.
How some commentary can change what we saw a month ago in December. It was 75% odds that Kevin Hassett was going to be our next Fed chair. So very interesting to see how quickly it can all flip. Thanks to Jenny Horn, the host of Next Gen Investing, for breaking down some of those top stories that we saw today. I do also want to check back in with Sam, though, and find out what we have coming up next in the show.
Well, Molly, we'll have the latest on the fight for Warner Brothers, one of your favorite stories. We'll look ahead to Netflix's earnings as well next week.
Hey, investors, you know the market moves. And Schwab is here to help you move with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. Sounds nice, right?
I'm Nicole Bettolides, live at the New York Stock Exchange, and this is the Watch List. Your midday view into the trends driving the markets with a sharp focus on technology, innovation, and companies leading the next wave of growth. Big movers, real-time interviews, and insight from analysts, founders, and market voices you trust. The Watch List, 2 p.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or
Oh, nice.
Head over to schwab.com/coaching.
There you go.
Start learning today.
Now we're too far out of the money, so I got to move it up 55.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com. Welcome back to Market on Close. I'm Sam Bartas on the floor of the New York Stock Exchange alongside Molly Kate over in Chicago. Let's just check in with where these markets stand because they haven't moved much. We've seen a pretty flat performance as you look at the major averages today, all but the Russell 2000, which continues to outperform for us. It very much has been a big week for the small cap trade. So we have seen very much the S&P 500, the NASDAQ, and the Dow all just sitting on that unchanged line. In fact, we just have the Dow Jones dipping further into the red. But Of course, we do see some push and pull beneath the surface as to why we're seeing this performance here when you come at an index level.
120.
Very much has been one of rotation, and that's why we continue to see some of the small caps are outperforming. That very much has been the broader theme of the week, as we've got so much information, of course, starting with the Power Probe, and then a lot of earnings, of course, out from the banks and the TSMC, reviving that tech rally once again, but losing a little bit of steam here when it comes to tech. And obviously, we continue to see some of this bifurcation with, of course, what is playing out in the memory space, obviously with the chips, and then also the softwares, which continue to get smoked throughout the course of the week, with that sell-off accelerating as well. Here's a maybe mega caps tech stocks, and of course, we continue to keep our eyes on these, given some of that rotation that we speak of. It, you can't get more mixed than this, really. I mean, it just looks candy striped right now, with Amazon higher, just fractionally, Meta up just a smidge. We've got Apple, which is lower, and then Alphabet is also lower by about 1%. If we can check in on the futures products as well, because of course there's been a lot of attention on this 10-year yield, which has actually managed to break out of this 6 weeks range that it's been in. We're looking at 423 right now on the benchmark, and of course coming off the back of the fact that we got this announcement around Hassett potentially not being the next Fed chair. We've got the US dollar picking up right now. We're at 99 on the Dead Sea crude oil quarter bid today, up 59 bucks a barrel. Bitcoin losing some steam though. We're back at 95,000 and change. But yes, as I said, look at that 10-year yield. We're going to be focusing on that 423 right now. And if we take a look at some of the sectors, if we can, because I did say that we have got a bit of a mixed picture under the surface here today. Technology is holding up fractionally there, but as I said, this looked like a bit of a mixed performance. The winners and the losers off the back of, day 2 post-earnings TSMC, the bifurcation we're seeing between softwares and chips, that chip v software spread. The communication services down, discretionary lower, staples also down 0.7% here. So this is where some of the drag is coming from in that sort of push and pull environment that I was talking about. If we flip the boards and take a look at some of the other sectors on the move, obviously a big focus on some of the utilities today off the back of some of these announcements around tech companies putting the bill, of course, with respect to PJM, and what we're seeing playing out between some of these electricity and energy companies. Real estate high today, one of our best performers, up 1.4% as far as the sectors are concerned. Industrials also high. They continue to catch a bid on this whole backdoor AI trade. Financials are up thanks to some of the regional banks. It was mixed performance. Of course, we'll be digging into that later in the program with one of our guests. Energy just fractionally higher there, 0.2%. And healthcare, it just hasn't really caught a bid this week. Down again, 0.6%. So that's a quick snapshot of what is sort of moving in these markets. About 40 minutes left to go in this session to close out the week as we head into the long weekend. But let's turn our focus, I should say, to the latest of the Warner Brothers deal and the saga that continues. So let's bring in James Sanowski, who's the head of Emerging Tech and Consumer Choice Centre. Thanks so much for joining us, James. Look, obviously it's never a dull moment in this drama. Just tell us the latest and what you're thinking about this story.
Thanks for having me. You're absolutely right. It definitely feels like a telenovela. With the
everything just gone kind of blah blah
here with this latest deal with Warner Brothers Discovery and the ongoing battle between Netflix and Paramount over this. So one of the most recent items was that Paramount announced that they were going and doing a lawsuit against Warner Brothers Discovery over trying to get around how they were valuing their cable division. And unfortunately for them, the Chancery Court in Delaware
21 after
down, saying that there was no evidence to suggest that they were going to get irreparably harmed if Warner Brothers did not go and disclose that in no more respect, right? So really now what's going to come forward here is that we're going to expect to see a proxy battle go and take place, which is a very costly proposition, both for Warner Brothers Discovery to defend against it, as well as Paramount to go and execute it. It's really an ugly turn for this battle. Voters have until, I believe, January 21st to go and cast their vote as to whether or not they are going to accept the amended offer from Paramount or stick through with Netflix. Though there has been some reporting that Netflix may be considering amending their offer that's outstanding too, and that would go and add yet another ripple to this. But at the end of the day, it doesn't really matter who wins out in this battle, because both companies are going to face pretty extraordinary pressure from U.S. and foreign regulators in the antitrust field. So that's something we'll have to keep our eyes on.
James, Marley here. I'm so glad we have you today. This is arguably, and I'm not secretive about it, one of my favorite stories that we've got going right now. So I want to talk about this legal ruling for Paramount. This was the latest in the saga or the soap opera or telenovela or whatever we want to call it. Do you think that this ruling out of the Delaware court in any way materially weakens Paramount's position here, or is this still very much a live fight?
It's still very much a live fight, Marley, because that was just one legal maneuver that Paramount was exploring to try to position themselves better for making their case to shareholders as to why they should accept the amended offer that they submitted back in late December. But at the end of the day, it doesn't necessarily leave them weaker. It's just one hurdle of many that they're going to face. Now they're in the full-fledged proxy war that we're going to see getting executed out here as they try to curry favor with shareholders to get them to accept their offer sheet. So are they weaker as a result of the Chancery Court ruling? No, I would just say that more than anything, it's just an added wrinkle into what has already been a pretty messy process in trying to get this merger kind of approved here.
So as we know, Paramount hasn't been, obviously taking this without fight. I mean, it hasn't been sort of lying down here. But, at the end of the day, Warner Brothers came out with obviously this note to shareholders talking about the fact that they think that this deal hinges on a lot of debt, which raises risk. So what are they going to do to change Warner Brothers' mind? I mean, is it fair to say that that's just how they see things? And I don't see how they're going to sort of reassure Warner Brothers of anything different here. But do you see something else?
I think you're absolutely right. At the end of the day, there's really only one way to go and solve for this, and that's to go and increase the price and put more money on the table. That's really, I think, the primary concern here. When the board of directors for Warner Brothers recommended against the latest amended offering from Paramount, they said that they had done nothing to go and really address any of what was in their view, the staggering deficiencies that had already been there, nor did they go and actually increase the price that was being offered to shareholders. So they didn't really feel like that deal had changed in a material enough way to go and change their mind about being lukewarm or even accepting of it. At the end of the day, there's still, I think, different twists and turns they have to go and see. Like I mentioned at the outset here, Netflix might be going and changing their deal too, which might force pressure on Paramount to go and increase the price per share that they're looking to go and offer with their
nice get a little bitty knife
on the table to shareholders. So again, a lot that's still out there that remains to be seen, but it is definitely something that's worth to continue monitoring.
And James, if we do see Netflix come forward with this sweetened deal, we're hearing reports that that deal may be all cash. That move as a setup looks like it may be to really expedite this whole process. I don't think it would expedite it ahead of that proxy meeting on January 21st, but if they do see that all cash deal come before that proxy meeting, how does that change the game?
Yeah, I think that's a great question, Marley. At the end of the day, what I think happens is if Netflix does move forward with an all-cash kind of offer to shareholders, it puts pressure on Paramount. Like I mentioned before, that they have to go and, again, look at re-amending their deal so that they can go and up the price to go and justify why they might be better than perhaps the Netflix offer that's currently on the table. And on top of that, too, I think one thing that Netflix did put out into the ecosystem to try to reassure some people that had concerns over the streaming giant potentially winning out here was they did put out an informational blast out, people saying that they were going to honor a 5-day exclusivity window that normally goes out with theatrical releases and then to television before then going and putting it out into the Netflix streaming service apparatus more broadly speaking. So I think that they're responding to certain pressures that they think people might be responsive to, but at the end of the day, if they come in with a cash offer here, that's just all cash, that puts a lot of pressure
watch 6950s here. It's coming right to my number. I just wasn't even a minute ago, a couple minutes or so, we think we might get a knife. All of a sudden, boom.
Able and willing to sort of just park this
excuse me.
know that obviously it's percolating
Hiccups.
on the back burner here.
Last trade of the day, and he gets the hiccups. He's not in it yet. If we go down and hit close to this number, I'll get in it.
To what we hear from the earnings, rather than this being an
Promise you.
overhang, or do you think that
Right now it's 69.50s.
as far as skewing what we hear
Should grab
and
one
the
for
reaction we
$2.
see on that day?
Yeah, that's a great
Yeah,
question.
then
I
we
don't
get that
think
chance
it's a
again.
distraction insofar as that
There it is.
shareholders, I think, have already baked in whether it works or doesn't work. I don't necessarily think that that's like the primary motivating factor for why they might be interested in investing in Netflix. They're still looking at some of the other deals that Netflix has going on. I know I've been in the program in the past talking about their deals in the sports arena, getting WWE, FIFA, World Cup, all that kind of stuff.
Come on, baby.
That's still very promising. And then just today, Netflix announced that they were getting a new licensing agreement with Sony's Pictures Entertainment, worth $7 billion to go and get their titles onto the streaming platform after that exclusivity period. That's a massive jump from when they did this last back in 2021,
We're watching
where
close.
the estimated reported value of that licensing deal was only about $1 billion. So again, this is another opportunity where, regardless of what happens here, I think Netflix is still looking for more ways to go and bring value to the subscribers and then by extension shareholders. So while this is certainly impossible to ignore in many respects, I don't think that this is the be-all and end-all for investors if they're trying to consider what to include in their portfolio here in 2026.
And James, while it is fun to sort of break down the internal fighting between these three companies and how it's all going to play out, I want to take a step back here because there is sort of a broader question as we look at this deal more widely in the industry itself. Is this fight actually less about Warner Brothers Discovery specifically and more about the next phase of consolidation that we are going to see in media? And I guess the follow-up to that is, do you expect this to be the first big deal among many once and if it goes through?
That's a fantastic question, Marley. I think that really is a signal about a transformational portion of the entertainment ecosystem. We're so used to seeing traditional media kind of go and play out in a particular fashion, but then over the last 10, 15 years, as we've seen the rise of the new media ecosystem and streaming giants like Netflix and Amazon and others go and really, and Paramount too, to their credit, get their foot into the water here and really, I think, kind of change the way that entertainment is getting produced and delivered to the end user. I do think that this merger opportunity does reflect that inflection point where we're going to go and see
Right when I say it, we do.
the way into this new era of
Let's get a little more.
And where Netflix
Okay, get ready.
kind of, I think, really go and step into the sunlight. And I think that it is going
Randy.
to trigger some interesting conversations around what the market's going to look like in the future for this space. But at the end of the day, for the end user, for the consumers, it is
at $1.25
because you're getting sports delivered to you in new
There it
ways that
drops.
weren't previously possible, and your ability to get connected is better and easier than it ever was before. So I think that we would expect to see some more consolidation, but at the same time, some more innovation around
You
the
guys
kinds of
nuts.
products and services. And
My name's
entertainment
Washboardjim,
packages,
Ryan the
perhaps,
Nutty
that are
Singing
gonna
Day
keep
Trader,
consumers, doors in the future. So a lot to be excited
SPX6950s.
about, in my view.
James, great chat. Thanks so much for joining us. Really appreciate it. Have
Close.
a great long weekend. James Janowski there, head of Emerging Tech, Consumer
At
Choice Center.
1.25.
We will discuss the issues facing
And we're
the
at
US economy this
145,
year,
man.
including
Shit, come
tariffs,
on.
the Fed, and the housing market.
Come on, Jackie. Randy. Randy. Had 155, but I didn't do it. 130.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 1,100 of the most
Always
popular
clean as
stocks and
Jim.
ETFs, plus a wide variety of futures markets. all with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react, we are live with analysis that matters. Watch now, only on SchwabNetwork.com.
Sometimes, you know, you could have done better. Same goes for where you
Need a
invest.
good reversal here, please.
Level up and invest smarter with Schwab.
Welcome back to Market on Close. I'm Marley Caden alongside Sam Bottis in New York. Shares of Novo Nordisk are on the rise today after reporting a strong early rollout of its oral weight loss drug Wegovy treatment. In the first week on the market, the pill accounted for about 1.3% of all Wegovy prescriptions. That signals solid initial demand. Also, the UK approved a higher dosage of Wegovy for patients that would now be eligible for triple the prior approved amount. That would be administered as 3 separate injections per week. The UK also set to make a ruling on the pill form becoming available on the market in the UK shortly. But let's see how some of these pharmaceuticals are shaping up. Like I mentioned, Novo, strong move to the upside, seeing them up 8.5%. Eli Lilly also in this weight loss space, up 0.5%. Pfizer is on the lower side today. They're down 1% to 25.64. And Hims and Hers, also a big part of this semaglutide conversation, trading about 0.4% higher here. I do want to shift gears here and take a more broad look at the market, some of the things that may be impacting us this year for 2026, what we may need to be focused on. Bring Sam back into the conversation and introduce our next guest. Joining us now, Christian Briggs, the CEO of Hard Asset Management. Christian, great to have you with us on the show today. You know, we've gotten some new data, some delayed data so far this year. We've gotten the beginning of earnings season. From everything we've gotten so far, you know, what's your outlook for 26?
Well, first of all, thanks for having me. The outlook's looking really strong. The earnings, the PE ratios are going to continue to expand. What we're seeing is probably about
We've lost Christian's audio. They're having a bit of technical difficulties. We will.
I like get $2 or $3 if we break. Here we go. Go, 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 go.
Christian Briggs, CEO.
694485. There we go.
Yeah, I'm back.
Now it's got to break to 9.
All right. We were just talking about the data that we get. We're getting a flow
Can you
of
do
data
it?
once again.
That's
Obviously,
close.
we're seeing the markets vacillating with all these announcements that we've been getting on everything from the energy to the oil to the defense to the affordability and housing.
I think you can.
How are you thinking about things right now?
I think we're in one of the strongest GDPs in 40 years in the United States. What I'm seeing right now is at least a 4 to 6% GDP growth by the third and fourth quarter. You've got energy that's been pretty strong. Oil's staying around that $55 to $65 in that range. You've got earnings that are going to be at least 2 to 3 times better than what was previous estimated a year ago. And on top of that, we're seeing strong growth in both AI adoption, which is now creating more efficiency, more productivity, and it's lowering the labor costs. So you're going to see somewhere between $800 and $900 billion in profits that'll be generated in the next 12, 18 months from corporations. So it's going to be a win-win.
You mentioned AI there and some of this AI in terms of the labor market conversation, which is one that keeps coming up. As far as your viewpoints on AI, you know, some people argue that it's actually going to take jobs away from American people. Other conversations we've had say it will just reallocate them to different places. You know, what's your thought on that and how best to approach AI from that perspective?
That's a great question. I mean, that's really well said, because what people are doing is they're fearing something that really isn't going to take that many jobs. There will be some transformation, especially in the hospitality, maybe it's the fast food industry, but really what it's going to happen is those people will find new jobs within AI. And what AI is going to do is lower the cost of what would be otherwise companies' cost of manufacturing, cost of distribution, cost of sales, and it's going to increase that productivity, but it's also going to increase their profits. A lot of the companies are already talking about
there we go.
repurposing
170.80
or employees that would have been
I'll take that.
Laid off or
And right when I sell it, it'll
eliminated
pop.
because of robotics or AI software integration. and they're being put into other areas to maintain the AI, and in some cases to expand robotics.
That's what they like to do.
Amazon, they've got 1 million robots working in a lot of their
237.
their warehouse fulfillment centers. And as those robots continue to be manufactured, you need people to make them, you need people to customer service them, repair them. So believe it or not, it's not about losing jobs. It's about companies increasing productivity and efficiency, and the employees will be shifted to new areas, and those jobs are actually going to be higher paying than current ones.
You know, obviously it seems like the government is trying to test the waters right now, particularly in a sort of midterm year with a lot of policy announcements, see what sticks, and the markets have been trying to react to all of this. And then obviously a lot of it has been around affordability as well, which sort of ties into your conversation around jobs here too. But I'm wondering if you had any thoughts on the latest announcement, particularly when you talk about AI and energy and what the Trump administration is seemingly trying to do here to try to get the technology companies to foot the bill to, I suppose, address some of the affordability challenges at a household level. Because my question is with that, if you had any thoughts on it, is that if there are fears of an AI bubble and then technology companies get involved, does that not bring the US energy infrastructure into the AI bubble?
Okay, let's talk about that. You know, they always say if you need more security, you have a problem with crime. Rather than put more security around your place of business or your home, you should get rid of the problem. So what Trump's trying to do is to mitigate the damage that we've had little or no energy policy. We want to drill oil, we want to make natural gas, we want to make nuclear energy. But the problem is that it's not a Republican or Democrat, it's just that fell through the cracks.
Does have a kind of wall.
Quickly accelerate energy policy. And yes, there may be some costs that these data centers are going to increase down to the consumer level. There's no question about it. They are a hungry machine for energy consumption. However, while he's doing what you just said, which is true, passing along some of the costs over to some of the companies that are building these centers, he's also deregulating the energy sector. He's fast-tracking natural gas production, and he's also fast-tracking nuclear energy, whether it's a pre-existing nuclear energy facility, like 3 Mile Island, for example. I'm just using one in Pennsylvania. Retrofit that. If it's a new one, cut the tape, get the permits issued, get these things up online, and then all of a sudden the costs are going to drop. So yes, you are correct in what you said and the question, the way you phrased it, but it's not Trump's fault that he's having to kind of work from behind to get ahead. He's playing catch up. But at the end of the day, cutting regulation, getting the permits issued, getting nuclear online, we know what's happening because the precious metals that create the fission to the fusion, like platinum and palladium, they've doubled in value the last 12 months. So his policies are going to work. It just takes another year or two to really see the fruits of that labor.
And Christian, another place I guess you could make an argument that just sort of got forgotten is the housing market here. You know, it's really been struggling for years. President Trump has made no secret that the affordability crisis in housing is one of the focuses of his administration, and had a similar approach here, throwing out some ideas to see if they might stick. Things like 50-year mortgages, crypto-backed mortgages, the government buying mortgage-backed securities, not letting large-scale institutions buy up homes. You know, as far as that approach, do you think the housing market will make any sort of meaningful comeback this year, either because of these policies and if they get enacted, or just because they're set up for one?
Okay, housing market is going to come back. I'm not so sure it's going to come back this year in the same way it would have come back after the 08 debacle. You know, it took about 2 or 3 years. And it's really not about, and you bring up the word affordability in the last question. I also want to make that part of this, and you bring it up. Affordability is a big key component right now. It's not just the interest rates. Housing is expensive. If you look at the top 600 communities in America, the average house is $1 million. So what he's trying to do is lower the interest rates to at least kickstart it. But at the end of the day, you've seen housing starting to come down, and it will come down a little bit more, get to that sweet spot where people can have the affordability, where housing prices merge with interest rates. We're not there yet, but like anything else, we survived 08, 9, and 10. We're going to survive this. It's not a catastrophe. We have strong growth in the GDP, and wages are going up. It's going to take a little time for what I call a readjustment of understanding, or really what's relevant is pricing needs to come down, and it will. Interest rates are going to come down, and they are. The road will definitely be a lot brighter the second half of this year, and I think 27, we're going to have a fairly robust housing market. I'm not counting like 14, 15, or 20 or 21, but it will kickstart the market later this year for 27.
Great conversation, Kristen. Thank you for the insight there. That's Christian Briggs, CEO and founder, Hard Asset Management. Please enjoy your long weekend. Coming up next, we've got Options Corner. Rick Ducat will join us here in our Chicago studio to take a look at United Airlines ahead of its earnings report. The stock just hit a new all-time high. We'll check out the chart next.
Kick off the morning with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk.
243.
Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
I'm Kevin Green, and I track options flow daily, identifying who's buying, who's selling, and how it's going to impact the markets. Watch live on Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Welcome back to Market on Close. United Airlines are set to come out on Tuesday post-market. The airline stock hit a new all-time high on January 7th. The Street expecting EPS to come in at $2.98 on revenue of $15.38 billion. Investors will be looking to hear about consumer and business travel demand and what lower fuel costs could mean for the airline industry. It's time for Options Corner now. Rick Ducat, our lead market technician, joining us, of course, to break down the technicals and some of the options action we're seeing in United Airlines ahead of their earnings report. Now, Rick, as we look at United, more broadly against the market, how has it been faring? Because we've seen some mixed performance in the airline stocks.
Right, and if you were to look at it versus the XLI ETF, the industrial sector, that's not really the greatest proxy, even though that's the sector to which United and the other airlines belong. With that, XLI performing the S&P 500, 21.7 versus
looking at this other thing.
on the year. UAL down about 7.6%.
Knife.
If you were to look at the airlines more
UAL.
here, United is kind of
Well,
near
that
the
sucked.
top of the group here. Delta closely in tandem with it, moving very tightly correlated to them. But then American, Alaska, and JetBlue are all faring quite a bit
35
worse
cents
here.
now.
So an interesting
Sector to be sure.
But United particularly, price target bumps
Well.
from Goldman Sachs, DBS Bank today. Also recently Barclays, Wolfe Research, Susquehanna, Evercore, Argus, Morgan Stanley, etc. There's many price target bumps recently. Just the general vibe seems to be that the travel demand is still quite strong here. Holiday travel was record-breaking here. It seems like things could be faring up pretty well for this particular group portion of the market.
Yeah, and certainly, as you talked about we've seen these price target increases ahead of the earnings. As I'm taking a look at the breakdown of analyst recommendations, overwhelmingly strong in the buy or buy equivalent camp when it comes to United. We did already hear from Delta. So as we look at the technical setup for United coming into their earnings, which will be the first day of trading after this because we're closed on Monday, what does it look like?
Yeah, some big swings in this name here. We've more than doubled off of the lows that we hit around that tariff news announcement shock here in April, which was the low point for so very many stocks here. But from there, a rapid resurgence here that touched on a prior resistance area. If you were to backtrack here, you could see this green line represented some old highs near the 110 level. From there, a bit of a pullback here that solidified near 89. From there, we hit the highs 119.21. Now, we have retreated back to this old resistance area that is now support near 110. So for now, that seems like a notable downside level to be on the lookout for if things continue to deteriorate, if the bulls kind of don't get what they're hoping for with this earnings announcement. So if we were to look at some of our other studies here, our moving averages that we follow, prices right about on top of our weekly 5-day EMA, our darker blue line here, our teal monthly EMA, just below here near about 113 or so. So in the shorter term, that could be another level to keep an eye on. RSI, our measure of momentum, shows some stagnation here. That's pretty common heading into earnings, though I wouldn't make too terribly much of that. There's a known event risk situation on the horizon here, so traders would be increasingly unwilling to make any big moves here heading into that type of event here. Finally, our volume profile study shows volume concentrations here at these elevated levels near about 115 or so, but really the notable concentration area is down here at the point of control near about 104, and things start to get a lot heavier around 110 or so. So 110, 105, that's the heavy volume.
Go, I need a little more.
To be aware of.
Yeah, and right now trading right near that 115 you highlighted. We're just at 114 and change right now, even with this slight move to the downside. As we look at the options action, though, ahead of the earnings event, has it picked up at all?
So today's sizzle, the activity versus the 5-day moving average, came in at about a little under 2 when I checked here, so about twice as active. For looking out, our expected move, February 20th, 35 days out, 5.5% roughly here, but not the most active name, about 30,000 options. Traded hands when I checked last here, 58% of them were puts. The most active month for open interest, as is with the case with many other stocks, is today's expiration here, but not much can be done with that at this point. The next most active month for open interest is actually March. That's about 14% of the total. Active strikes are the 110 level stands out.
One more. There you go.
110 in particular for high open interest areas.
Well, Rick, we appreciate you being with us to preview United. Also, the options action that we're seeing ahead of its earnings. Tuesday, but I do want to send it back to Steve in New York and find out who they'll be talking about for overlooked stocks today.
Well, George Tillis is going to talk us through Rocket Labs today, which hit a new all-time high, Marley, and has rallied 40%.
I got lucky.
He'll break down the news about that.
And I married you.
Coming up next on Market on Close.
Out at a buck.
I'm Jenny Horn. We go beyond the headlines.
I'm done. I thought I was really cooked on that one.
And fundamentals shaping the markets in real time. This is Schwab Network. Subscribe at schwabnetwork.com.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing
Oh, gosh, there they go.
Carl.
There they go. No, only got $1.
A modern approach to wealth management.
Huh.
Stay connected to the markets with Schwab
$1.10.
Tune in
15.
24 hours a day, 7 days a week on
That's pretty good.
schwabnetwork.com
and on all your favorite streaming services. Schwab Network.
Available anytime, anywhere, on any device for free.
I'm done. That's for sure.
Welcome back to Market on Close. I'm Sam Vardis on the floor of the New York Stock Exchange. Shares of Rocket Lab hitting a new all-time high today after an upgrade over at Morgan Stanley. So that's the subject of today's Overlooked Stocks. George Sillis is joining us now, Senior Markets Correspondent, to talk us through this. So what went into the call, George?
Well, I think it really comes down to the prospects of what's going on when it comes to space. We have to think about the catalysts that are involved, and it's not just some of the Department of Defense aspects of things like the Golden Dome or even imagery, which again, these are catalysts, but the other context of what's going on in space, it's not about traveling to Mars per se, it's really about low orbit satellite communications. This is a technology that's been evolving. Right now it's complementing 5G cellular technologies, 5 and 6G. And you think about the demands for these kinds of communication satellites, which Rocket Lab launches into space with collaborations in the commercial as well as the government sector. These low orbit satellites are complementing communications technologies which are going to be needed for seamless communications for things like autonomous driving, robotics, and all of the artificial intelligence, secular trends we're seeing
there
right now.
There it goes. Watch it take off
stocks,
now.
ASTS Mobile, Rocket Lab have done extremely well in the last year. There's a trend. There's certainly a major catalyst going on there. This stock is higher over the last year by nearly 300%. 5 years, it's pretty remarkable, up 800%. And they still, provide, those seamless services like launch services. They have a 100% success rate. This is, again, very positive. Also spacecraft design and manufacturing. But I think their satellite launches are really key. Allies include the United States, Canada, Japan. These are, again, friendly nations. And again, like I said, the government commercial space technology race is very large going forward. Now, Morgan Stanley is still on board with Rocket Lab, irrespective of the fact that the stock has performed extremely well in the last year. They upgraded the stock to basically overweight from equal weight. Price target now is 105, so it's again higher from the current price relative to 67. They still see gross bookings essentially, and of course backlog, making the company well positioned to continue with these secular trends we're seeing in this field. Again, I think the defense aspects of the business really help the stock move back, off of its 200-day moving average. If you look at it since October of last year, it's basically nearly doubled from that level as it still continues to move to new all-time highs.
Yeah, I'm seeing this has really shot up, pardon the pun, almost 300% over the last year or so. So as you say, gaining a lot of traction here. As far as some of the price targets, I'm seeing the ranges between, the lowest price target in the 40s, the highest above 100 to your point. Across the analyst consensus here, no one seems to be in a sort of underperform or sell camp. Many are in a buy camp, but you do have a lot of those analysts still in the hold. I'm just wondering, what's still keeping some of them on the fence here? I mean, are we just waiting to see how this whole space thing sort of materializes?
Well, I think that's part of it. I think going forward, I think that the aspect of materializing profits on those sales, that's really where the conservative aspects of these analysts are. I can see their point because this is certainly a growth company. There's no doubt. I mean, if you look at the sales estimates for fiscal year 25, which they'll be completing coming up as we report earnings soon, $600 million. Next year, for 2026 fiscal year, they're expecting almost $900 million. So this is a 50% increase even from here in terms of sales. But the challenge is...
Yeah, they're 10 cents now.
Year, the last 4 quarters are around $580 million. They lost $200 million. So again, those losses have to be financed, and they're going to be through secondary offerings of equity. That's why you're seeing more analysts come on board. They're underwriting secondary offerings. Not a bad thing to help capitalize the business, but there is competition too, which can create some, apprehension to move their targets across the board higher. Again, some of them are at 105. That's the high side where Morgan Stanley is. The low side around 47. So that variance is quite wide from high to low. And that comes down to competition. I think competition is something you have to be mindful of because SpaceX, Starlink is very big, potential for an IPO. And then you have to think about other competitors out there which are very well funded, like Amazon's Blue Origin. So with that said, that can present some challenges going forward that you have to consider as an investor. But nonetheless, as a trader, longer-term trader, like I said, it bounced off the 200-day moving average. It seems to be respecting that in the last 4 quarters, and at least in the short term,
3 minutes. I don't think I can get in 3 minutes.
The stock, and I use myself the 20-day moving
Okay,
average,
well,
respecting that with a positive trend. So the trend is still positive.
we got stuff done
It doesn't
today.
necessarily mean that it can face some exhaustion, especially with this sort of January effect that we're having in specific areas of the stock market, including space right now, and of course some of the periphery AI names, not necessarily the core AI names like Broadcom and NVIDIA, which have been actually struggling in the past few months.
Yeah, absolutely. You raise a very good point there.
We'll be shutting this down right when the bell rings.
Higher by about 6% right now. Thanks so much, George. Have a great long weekend. We'll catch you next week. I'll send things back over to you, Molly.
Thanks so much to Sam and George for that. We are nearing the end of our market session and the end of our trading week. We'll be bringing in Kevin Green to break down the levels he's watching on the S&P 500 as well as today's action. That's next on Market on Close.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are.
Back here on Market on Close, I'm Sam Barnes, here on the floor of the New York Stock Exchange. Alongside Marley Caden in our Chicago headquarters, there's just a few minutes left today in this session, so let's welcome in Kevin Green, Senior Markets Correspondent, to help close out the final session here for the week. Kevin, obviously it's been a bit quiet at the headline, but nothing but, I should say, far from quiet under the surface, particularly when you look at chips and obviously software. But just talk us through some of the levels that you're watching into the close right now in the final few minutes.
Yeah, obviously we
Final minute.
Earlier this morning, we had some volatility hitting the market, but we've been pretty much trading in a 10-point range, sitting there around the 69.50.
Really, not much at all.
Time, but under the surface, we did see a little bit of rotation, especially for this week. And what I'm looking forward into the close is pretty much staying within this range, 69.40, 69.50. 69.50 would be a pen risk area that we have to be mindful of here. But I think this is actually a pretty easy
more knife.
if you are a stock picker and not really so much if you're an trader, which is obviously
I'm out of here.
Around the 69.60.
Wish everybody a great day.
To 7,000.
We'll see you Tuesday. Be safe. Don't drink and drive.
Sam had highlighted just earlier in the show today the yields, and if
Bye-bye.
they have in fact broken out of range, or if you still view them as range bound. We only have a couple seconds here, but I'd love